right, good morning, everyone. Thanks so much for joining today's broadcast. My name is Greg Lewis. I'm the marketing manager here at MetaStock, and today is the December Traders Summit 8-hour mega marathon event. And if you're here, you're going to love it. If you're not here, you're not going to love it because you're not here. Hey, today we have 8 delightful, educated, and great speakers, and I'll show them to you here real quick if I can figure it out. Our first up today is Vince Vora. Then we have Martha Stokes, CMT, Price Headley. 1 o'clock Eastern, we have Alex Cole and Tyler Wood teaming up. And then we have the unstoppable Mr. Oscar Carboni, our own Jeff Gibby, Jake Bernstein talking about artificial intelligence or absolute insanity. I'm actually interested to hear what he has to say about that. And then Tyler Wood will be capping it off with his talk about why technical analysis works for every investment process. So it'll be great to see all the speakers. Hey, we are today, the studio dogs are going nuts. We are today coming at you from Texas. Jeff will be coming at you from our headquarters in Salt Lake City, and I don't know where all the presenters are coming at you from. I believe Vince is in Southern California. Everything right now is going great. We hope to have no technical difficulties. If we do, we appreciate your patience. We do, of course, that's what I meant to say. So we are MetaStock. If you haven't heard of MetaStock, I've got a brief little presentation here for you to watch right now.
Hi there, Greg Lewis, MetaStock Software. As the marketing director, I get asked all the time, what is MetaStock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you. MetaStock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of MetaStock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love MetaStock's OptionScope. OptionScope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And MetaStock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar Oscillator System, or simply known as the RMO. And as you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about MetaStock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
All right, thanks so much for watching that. Hey, a couple things. If you are just watching us on YouTube right now and you have not yet actually registered for this event, I mean, that's okay. You can still watch it, and that's just fine. But if you're registered, then you're able to participate in the free bonus items that most of the presenters offer, and they're only available when you register at metastock.com/traders/summit. The easy way to get there is just to go to metastock.com. There's a big banner on the top. Click on that, register, and you're done. You can watch us today on YouTube or on GoToWebinar. If you register, we'll send you the GoToWebinar link. It's pretty much the same experience, but again, if you register, you're available. Excuse me. You'll have the ability to get those free bonus items. Also, Jeff is reminding me that we should tell you to go ahead and like and subscribe. I mean, if you don't like it, don't. But if you do, go ahead and like and subscribe and click on that bell so you'll be notified every time we have a live event. We usually have a live event a couple times a week, and then we have a marathon extended event like this at least once a month, and then once a quarter we have a multi-day event, which is called the Traders Conference, and you never want to miss that. But today is the Summit, which is an 8-hour all-day event. We have 8 speakers coming right up. In about 2 minutes will be Vince Vora. He's a great speaker, and I know you're going to enjoy what he has to say. I believe he's going to be talking about his victory method. What else shall I say? Oh, please, we really encourage participation. Give us comments, give us questions. The speakers aren't always watching the YouTube chat, so if you chat in a question there, definitely Jeff or me will pass that on to the speaker or the presenter so that they can have an opportunity to answer. We just ask you to be patient in that regard. Sometimes it takes a little while for that to get through, and they don't always have time to answer all of your questions. We also just ask that you be respectful. Comment. We like to be as transparent as possible. If you have something to say that isn't necessarily going along with what the speaker is saying, that's fine, but please just be respectful of them. They're here for you. All right, we have about 1 minute and 15 seconds. I'm going to go ahead and let you listen to some jazzy jazz music while I make sure that everything is copacetic and ready to roll. So we'll see you in about a minute. Oh, one last thing, you may have noticed my cup. Your video is not backwards. My wife crafts these cups, and this was a practice one, so she got Noel both upside down and backwards. So don't adjust your screen. You're fine. All right, once again, thanks for joining us, and we'll be starting here in about 10 seconds.
Good morning. I hope you're doing well. It's me, Jeff Kibbe from MetaStock. Thank you for coming. It's so good to see you. I hope you're doing just great. I'll be reading a legal disclaimer and kicking us off today. We have a really, really good lineup. So it's good to see you. Thank you for coming. And let me get to that legal agreement or that legal disclaimer I promised. So today's demonstration should be is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. It's also important to note that MetaStock does not endorse the purchase of any security, nor does it paid for the promotion of a security. No information contained in the presentation today should be construed as investment advice or a solicitation to buy a security. So hope you enjoyed that. Welcome to the room. It's really, like I said, it's really good to have you. As you're coming in, make sure to say hi. It's good to see all of you. Good to see you, Kelly. If you're coming in through YouTube, it doesn't hurt to like and subscribe. In fact, it helps a great deal, and we do appreciate that. I want to talk about two of the sponsors we've got today. One of our sponsors is Stocks and Commodities Magazine. We appreciate them. They've been sponsoring the event that we've been running for over a decade here. I think next year will be 11 years that we've been running the Online Trader Summit, and they've supported, I think, almost every single one of them. So we really appreciate them. If you're not familiar with Stocks and Commodities Magazine, they're a magazine. They've got 17,000 articles on their website that you can review at any time. Got about 1.3 million subscribers, and they've been actively publishing since 1982. So if you're watching us on YouTube and you want to get a free issue of Stocks and Commodities Magazine, you can go to metastock.com/traders-summit. If you already registered and signed up for the free magazine, well, it's on the way. So thank you Stocks and Commodities for sponsoring the event today. We appreciate that. Also want to say thank you to CMT Association. CMT has been an avid supporter of the MetaStock events that we do here for a number of years. They're a great organization. If you have assets under management, if you're interested in kind of having assets under management, or if you're interested in kind of growing your assets under management, CMT Association is a very, very well-respected, great organization that can actually help you with getting a CMT behind your name. So if you're interested in that, find out about them at cmtassociation.org. You can also call them 646-652-3300. So how are we all doing today? All right, and of course, we're MetaStock. So if you're not familiar with MetaStock, I'm glad you came into the event today. We're going to be using MetaStock for almost all of the charts. We've been rated #1 by the readers of Stocks and Commodities 30 years in a row. We can help you scan markets, test trading ideas, forecast probable price movements using some pretty cool statistics. And pricing on it starts at about $59 a month. We'll be talking about it today. Great software program. If you haven't tried it, you should. We're offering a really good extended trial where you can buy a month and get a second and third month for free. Hello, Reginald. Gouda. Good to see you. All right. Our first presenter today is a great presenter. He's a great trader. He's a great system designer. We've been friends and partners for, a long time now. I don't even want to put a number on it because I don't know how long it is. Vince, though, what I really like about him is his system design, his eye for simplicity, and his ability to kind of really talk about some concepts that are hugely important in a very straightforward manner. So we're going to go ahead and kick it over to him. Vince, how are you doing today?
I'm great, Jeff. How are you? Thanks for having me on.
Of course. I can hear you. I just sent the screen share over to you. I can see you. I'll let you know when we can see the screen, and I'll get out of the way. Cool. Perfect. Coming through. Everything's good here. Do you have anything you need from me before I let you go?
No, not at all. I've got the chats open, the question boxes for both YouTube and our GoToWebinar here. But if you can just keep an eye on the questions and interrupt me if there's anything that you think we should cover, I'd appreciate it.
All right, sounds good. It's all yours.
Great, thank you. Thanks again to Jeff and the team over at MetaStock. As Jeff said, they've been great partners of ours for many years. Just a great group of people. And welcome, everybody. I'm certainly happy to be here with you today. The one thing I'm here to talk to you about is our victory method. It's something that I designed back in 2019, I believe it was, and have been using it ever since. It's my baby. I'm happy to share it with you here. Let's go through this. First of all, my name is Vince Vora. I'm the head trader here at Trading Winds, and I've been in this business for a very long time. Actually, now it's getting close to 40 years that I've been doing this. As Jeff said, I've designed many strategies and systems over the years, but one of the things I've enjoyed most is coaching. That's what I do a lot of these days. So I'm really happy that you could join us. Remember, trading can be risky. So please don't trade with real money until you are completely comfortable with the system that you're using. Now, that's enough for the slides for me. What I'm going to do today is I'm going to first show you the add-on, show you what these arrows and circles mean, et cetera, on the chart, what you're seeing. I'm going to sort of change things up a little today. Usually I tell you what you would get with this add-on if you decide to trade with it near the end of the presentation. I'm going to do that just after I show you what these arrows and little dots mean. And it's for a reason. I want you to understand our methodology. I want you to understand how we do things and how we sort of walk our students through the process here at Trading Winds. And then we'll get back to the charts and hopefully be able to go through dozens and dozens of examples. So if there's a certain chart you want to look at, if there's a symbol that you prefer to trade or in a trade right now, or just want to see how it would have performed, type it into the chat and we'll try to get through as many as we can. All right. Now, here's a chart of the SPY, the SPY, the S&P 500 ETF. And this is on a monthly time frame. Now, I'll start off by saying that this strategy is based solely on technical analysis, nothing to do with fundamentals. Of course, you can couple it with fundamentals. You can do your fundamental analysis, find a list of really strong companies that you like, and then try to time your entries and exits using something based on technical analysis like the victory method here. But I'm starting off with the monthly time frame just to show you what these mean and to show you that you can use it in many different ways. You can obviously use it to pinpoint entries and exits on individual stocks. It works on anything really. So futures, forex, crypto, equities, anything you can draw a chart on, any exchange anywhere around the world. I'll show you some of the international exchanges. We've tested this over in India with the Nifty 50, in Australia, UK, Canada, US, you name it. It's just technical analysis, works the same across the board. But I like to look at the monthly first, just to kind of gauge what the overall market is doing. So I will look at the Dow, the S&P, the NASDAQ, the Russell 2000, just to kind of get a gauge of where things are, and then pare it down and go to my favorite time frame, which is the daily. But it will work on any time frame, and I'll show you that. So here we are with the S&P 500. Now, what you see here, these green arrows are obviously buy signals. Now, I will tell you off the start, the intent here is not to take every single signal. The intent is to have a very strict set of rules for your entries and exits, and that's why I'm going to show you in a minute exactly what that is. But the arrows give you a heads up that, hey, there may be a trading opportunity here. Okay, then we go through that list and decide if it is or not. The dots that you see here, what happens there is the exact same criteria that came together here to populate the arrow has come together again. The reason why we put it as a dot and not an arrow is because we're already in a trade here. So if you missed the initial opportunity and you want to get in now, you can do that. And you'll also notice that once it suggests a trade entry, all the bars will be colored the same. So for a long trade, all the bars will remain green until an exit, For a short trade, all the bars will remain red until an exit. Now, an exit, when I say an exit, you should be exiting your trade on any color change. This may go from green to red, okay? It may just go to an exit flag here. The bar would be yellow at the time, if that's the case. And, we may go from red to green immediately. So whenever there's a color change, all right, if you were short, for example, you want to consider getting long and vice versa, okay? So you always pay attention to the color changes. But we decided to paint those bars all the same color to help you remain disciplined and not get scared out of a trade, okay? What you see here, this blue line, and I'll hover over it just so you can see it. It's just a 20 period simple moving average, not exponential, not weighted. If those are your favorites, you can change it to that, but I prefer the 20 period simple moving average. And what we use that for is to identify momentum. So the whole system is based on trend and momentum. Those are the two things you need in order to be consistently profitable with your trading. So from a personal perspective, as a trader, what you need is patience and discipline. Okay, you need patience to wait for the proper setup. You need discipline to actually follow the rules. If you can do that, and you're trading with something like this that identifies trend and momentum for you, it's gonna be hard for you not to be successful, to be honest. And I'll show you exactly why. I know that may sound weird at first when you hear, because everyone knows that 85, 90% of people that try to do this fail, okay? But that is because they don't have the patience or the discipline to follow a system that's been proven, or they don't have that system that's been proven. So let's have a look here. What we want to look for is obviously a signal to begin with, but one that happens to be along a sloping 20 period moving average. So for a long trade, we want this line, this blue line, to be sloping upward. And for a short trade, we want it to be sloping downward. That is the minimum criteria that we're looking for, okay? Now, I will explain when we want to take the signals here when we don't have slope. There are times if you're a little more aggressive and you want to try to pick the bottom that you can. I'll give you two rules for that. But otherwise, all you need to do is look for these setups and look to make sure that there is slope on that 20, okay? And that the setup is close to that 20. Those are the three main things that you need. So even if you're not that experienced with trading, you're just starting out, this is going to be very, very simple and easy for you to follow, all right? And just to show you that the time frame doesn't really matter, we can go down to a weekly, and you'll see that signals along slope. Okay, as I flip through charts today, pay attention to the ones where there's slope, like this one. Okay, re-entry, here. I mean, it doesn't really matter where there's slope. If you're looking for those entries, the majority of those will work in your favor. In a minute, I'm going to show you how to make that even tighter for you and give yourself an even bigger edge in the market. Okay, but whether you're talking about monthly, weekly, daily, okay, or let's go to an extreme. How about a 1 minute chart? How many of you day trade, right? 1 minute chart. Again, we're looking for entries near the 20 that have slope in the direction of the trade, okay? That's it. And of course, with MetaStock, we have a scanner that I'll show you near the end of the presentation and so on, that can really help you find these setups very, very quickly, all right? So let's talk about if you decide to trade with this add-on, what you're gonna get with it. At Trading Winds, we have what we call our pro service. And what you're gonna get with that, and here's why I'm showing you this, is you're going to get nightly emails from us after market close every Sunday to Thursday, okay? Now, they'll start off with a market summary of what happened in the markets that day, okay? My description of what happened in the market that day. And then some market-related articles that I think would be important for you to be aware of. And then we have what we call our victory traffic lights. here. And what we do here is we highlight the ETFs of the 4 main index charts, the Dow, the S&P, the NASDAQ, and the Russell, and then the 12 main sectors, so energies, financials, technology, consumer staples, etc., right? And what we're looking for are 3 time frames, the daily, the weekly, and the monthly. Now, I do this as much for myself as for you. I trade on the daily most often, so I always suggest you look at 2 higher time frames. So if you're trading on, say, a 5-minute chart, you want to look at a 15-minute, maybe a 30-minute, or an hourly, etc. Always to confirm what you're seeing on the time frame that you're trading. So what I thought we'd do here is I look at victory, and so going back to the victory chart, for example, if we're here and the bars are green, okay, meaning we're above the 20, we're in a long trade, right? That circle would be marked green here. So when you see green across the board, right, daily, weekly, monthly, you know that you're in a strong trend upward on that symbol, right? Now this is the Dow 30, okay? Now, even more important, when you see the Dow, the S&P, the NASDAQ, the Russell, all green on all 3 timeframes, you know the market is trending strongly in one direction. Now, with that alone, you know that you really should be focusing on long setups, not short setups. But taking it a little deeper and looking at the different sectors, you can quickly tell which sectors are going along with the market and which ones are completely out of favor. For example, XLE, energy, red across the board, okay? So obviously, we're going against the market here. How does this help us? Well, we'll teach you a money management plan that will go along with your trading plan. But to give you an example, if we were going to trade a stock in the energy sector now, okay, yes, the energy sector is trending strongly lower, but it is going against the overall market, the Dow, the S&P, the NASDAQ, the Russell. So if we were going to trade a symbol within the energy sector, we'd probably go in with smaller size than usual, right? Maybe half the size that we would normally put on. Those are things that come out of the money management plan. So this at a glance tells you, A, is the market trending strongly upward? Is it trending strongly downward? Or if it's all a mix of colors, you know we're in a consolidating market, kind of sideways, and you probably should be a little less active than normal, okay? So you'll receive this email every Sunday to Thursday, and then down here, we have our daily trade ideas. So these are setups that I believe are the ideal types of victory signals that you should be looking for. These 8 points here, these check marks, this is a checklist of criteria that I look for on my trades, okay? This is my trading plan right here. So I look for cleanliness on a chart. I look for my reason for entry, which is obviously the victory method. I look for the slope on the 20, which should be significant and in the direction of the trade. I look for the distance from the 20, which should be minimal. I look for where the bar closes. So if I'm looking for a long entry, that daily bar should close, near the top of that bar, the top half. Okay, is there any support or resistance nearby that I should be aware of? What do the higher time frames look like? So if I'm going to trade SOXL on the daily, is the weekly and the monthly in line with the trade? Are they green as well? And I don't want to get surprised by earnings, so I want to make sure that the earnings date is at least 10 days away, all right? So I will pick out what I believe is a trade I would take. So to be clear, for legal reasons, these are not trade recommendations. These are trade ideas that we share to reinforce what we look for with victory. But it is also what I'm doing. So if you want to see what I'm doing, this is what I'm doing, okay? And here's how I'm trading it. So for SOXL on that day, and this was, I believe, the 8th. Let me go back to the top. Yes, December 8th, right? So here, I said if it trades above today's high of 23.40, I would consider going long, and this is how I would do it. Using the May 17, 2024 call debit spread, 25-30 call debit spread. Then I break it down further. I say we buy the 25 strike call, we sell the 30 strike call for an approximate debit of 155. Reason why it's an approximate, this is after market close that I'm analyzing it, so the option prices are static. I tell you where I'm putting my stop loss. I tell you where I'm taking my first profit, where I'm taking my second profit. So it's all there. Some days we'll have multiple trade ideas. Sometimes we'll have a long and a short. And at times we'll share weekly trade ideas as well. And every Sunday when I send you this email, at the top here, there'll also be a link to a video where it'll be my weekly analysis on what happened in the markets the prior week, what happened, what I think is going to happen the next week, and the things we should look for. And I break down with the charts, symbol by symbol, each one of these sectors and where they're trending and where I think things are going, okay? Now, we track these trade ideas here on this spreadsheet. And I can show you that we go back all the way to like April or May of 2022, all the way down here, every single day. So let's go back a few days and just have a look at these. I'm going to start with last week on Monday. We had KBH. Now here on Monday's email, I put KBH as the main idea, showed you exactly how I would trade it. Also gave 3 that you should consider on the weekly time frame. So if we go back here and look at KBH, right? Here was the setup. Now this is the 1 minute. Let me go to the daily where it was. There it was right here, okay? So here's an example of a textbook setup with the victory add-on. Number 1, we had the green arrow that we're looking for, and it was close to the 20. The reason why we want it close is when price pulls away from the 20, it tends to snap back. So you see this setup here? I would not take that. For me, that's too far away, and this is the reason, exactly the reason why. I don't want to get caught in a snapback like that, okay? So this marks off, first of all, the cleanliness of the chart, right? You know, and by cleanliness, I mean orderly price action. When you see big bars back and forth, you know, and I'll show you an example. Can everyone still hear me? I just got a pop-up about my audio not working. Is it okay? I'm not sure. Are we still connected here?
Yeah, you are connected, but we lost your video.
Lost my video. So you're not seeing my screen?
No, we're not seeing your face. But we're seeing. So okay. I don't know what's happening with that, but I can see your mouse move. I can see your screen. I just don't see you anymore.
Okay. All right. Not
which is fine.
Yeah, the screen is more important.
But
yeah. Okay. Okay. Let's carry on. We won't worry about that. Again, when you let me show you quickly a chart that I would consider messy, not clean. Right? Zoom. This is what I consider a messy chart. And the reason why I want to stay away from these is no matter what trading system you're using or where you enter here, because of the back and forth nature, right? The wide swings from high to low every day, your chances of getting stopped out are extremely high. All right. So you want to find a chart that is clean, that has orderly price action. And usually when you're in a strong trend up or down, the bars are very similar in size from high to low. So you can use that as a rule of thumb and say, okay, this is clean. So we obviously are in an uptrend. We get the signal. We're close to the 20. 20 is sloping higher. What I want to see from the 20 is about a 45-degree angle slope, about like that. It could be less, could be more. As long as it's sloping, it's okay. But the higher the degree of slope, the better, right? So this is fantastic here. The other thing we look for is support and resistance. We want to know, is there a lot of overhead resistance in our way? And, if you're near an all-time high, even better, right? Because it means there's very little overhead resistance. The higher time frames, right? If we want to confirm that they are in line with what we're seeing on the daily. So at the time, is the weekly green here. Is it above the 20? Yes, it is. Is the monthly green and above the 20, right? Yes, it is. So this is how I whittle through the trades every day, because you get multiple setups. I compare one to the other and I select the best of the best. So as you can tell, then what we look for here is we look for a trade, 1 tick or 1 penny above the high of this setup bar. And when we get that, we enter long. Okay. And then as you saw in the email, we set targets. Okay. So you can see here that this one's worked out very nicely. And it's not uncommon. It is actually very common because we have that criteria that we're looking for. If you stick to that list of criteria, the 8 items that we look for here, this dramatically improves your odds of success. Okay, dramatically. Let's go to the next day, the 5th. We had 2 trade ideas, CNXN and CTVA. Let's have a look at those and see how those would have worked out. CNXN, I believe it was, .O. Again, look, if you look at this chart, right? Here's the signal. Look at the slope, dramatic slope. You look to your left, there's nothing there, right? I'm not going to spend time on it, but if we go to the weekly, the monthly, they're both above green. They confirm what we're seeing here, right? We wait for a trade above that high, and off it goes, right? Now, to the short side, we had CTVA. Was CTVA.O, I believe, no, .K. Yeah. Okay. Here's a short trade right here. Now, remember, the overall market is trending strongly upward. So if we're going to trade anything to the short side, we go with half size. Okay. Yes, it triggered. It moved down. Now it's starting to retrace. May end up stopping us out. Right now, we're still in an active trade. It's live. It's fine. But because we're going against the overall market, again, we trade with half the size only. And the other nice thing that you're going to notice about victory is that the second it starts to go against you, it'll get you out very, very quickly. So the whole goal here is to have more winning trades than losing trades, but we also want our winners to be bigger than our losers. So keeping our losers small, super important. We're still in this trade and it's okay. Now let's go and look at the other days here, a couple more. December 6th. Right? We had Apple to the long side and VAC to the short side. So let's have a look at Apple. Okay. Yes, here it was. All right. So it's pulled back today, right? But it did trigger and was moving fine. Still a good trade here. Nothing to worry about. We're patient. Remember, the only time we exit is we start to scale off if we hit a target, a prior target, like I show you there, or if we get a change in color, right? But if you look back on these charts and you look at where we had slope, right? And any of the ones that happened near the 20 with slope. And on something like Apple, Apple was a little choppy here, but you could see that the algorithm called an entry here. So you could add to these if you're a little more aggressive and then exit the full position here, okay? Or just pick one entry, and stick with it to the color change. But you can see how when you hit one of those areas of trend, the odds are highly in your favor. You can pretty much enter anywhere you want in that area and you'll do fine. All right, let's look at the short trade for that day. VAC, Marriott Worldwide Vacations. All right, here it was, the dot. And you can see that we never did take out the low of that. So this was never an official trade entry. We never did get into this short. And again, here's a good reason why we have that criteria to enter our trades. It opened a little higher and kept going and would have stopped us out. But we avoided a loss here by that one rule. So there you go. And we have December 7th, GNE here. Okay, Genie Energy. That was a long as well. There it was. Again, the same criteria, very close to the 20, very strong slope. You look to the left, really no overhead resistance. The higher time frames are in line. Very clean chart. We trigger and off we go. Nice and easy. Just one more here, the 8th. I'll show you SOXL, right? SOXL. Where's my chart? There we go. SOXL. This is the semiconductor ETF. It's actually the leverage 3X ETF. So again, whether you're trading equities, ETFs, futures, Forex, it doesn't really matter. Here's another example. Dramatic slope near the 20. We take out the high and off we go. Okay, this is very, very simple to follow. Like I said, you as the trader need two things. You need the patience to wait for these and be very, very selective like I am. That checklist of 8 items that we look for. If you can't check off every single box, you do not want to take the trade, okay? But again, you go back and you look at anywhere where there was slope, okay? These trades work out the majority of the time. Do we have any symbols out there that anyone wants to see? I'll bring up a few stocks that have been trending recently. We've been looking at, especially in our group. Look at CCL here, right? Again, nice clean chart, right? Nice trending, clean chart. Anything with slope that's near the 20, and you get some great entries and some great follow through. Great. Java wants to look at ABV, ABBV. Absolutely. Let's look at ABV. And remember, any time frame, it doesn't matter. Now, this is one thing that I want to talk about as well. When you get slope like this, you see how on this entry, we did not have slope in our favor, okay? And was not sloping upward at the time. So this is not a trade I would take. Now, I will give you 2 rules to show you exactly how to trade that if you're a little more aggressive and want to take added risk, you can. So here, what you want to do, what you want to look for in these areas where there is no slope on your side or where you cannot check off all 8 boxes. You know, this is another example here. Is one, you want to look for one of 2 things. You either want to look for a move above a prior high, and it's a major high, really, not a minor. So this one here for me still wouldn't, breaking this minor high still wouldn't be acceptable, but breaking this one would. Okay, so you can get in on the break of that high and would have done well, or you can look for a retest of the 20. So I'll give you a cleaner example of that on another chart. But here's one here. So we move here. Slope is not in our favor. Okay. We look to our left for a prior high to overcome. There really isn't any until way up there. But then the stock pulls back, right? Bounces off the 20, a retest, a successful retest. So from there on, you could look for an entry. Again, the easy ones, the more consistent entries are the ones where you just wait for slope and let it go in your favor, okay? But here's another example. One that comes to mind is Meta. Here. So you see why we didn't have slope? And then we pull back, we bounce off it. So we confirm now, that we found support at that 20 and are likely to move higher. And we break a prior high at the same time and off we go, okay? But again, you don't have to take those. You can just wait patiently for setups near the 20. So for here, if I wouldn't have taken that, I may have taken this one, it's close enough. This one I would not, it's too far away for me, but I would take this one, worked out beautifully. I would take this one, added here, exit here. Beautiful winner. It's that simple. And again, whether you're trading on a daily, a weekly, a monthly, the rules remain the same. You look for the exact same items, okay? The same checklist. Make life easy for yourself. Wait for those trades. Now, if you have a period of consolidation like this, okay, you're likely going to get a lot of signals in here. This is why we don't want to take those signals without slope. You see in here, you go red, green, right? This is where traders get chopped up. This is where you lose most of your money. You get in, you get stopped. You know, you go long, you get stopped. You go short, you get stopped. This is where people get chewed up. Just look for a trend, a strong trend, and Victory will highlight that for you with slope on that 20, with momentum. These trades are so much easier to sit through than something like this, okay? So now, if you can identify an area like that, you can mark the highs of it, right? And mark the lows. So let me just mark this. There's a very, very small channel, but you know, you want to mark the high of the channel, want to mark the low of the channel, and then look for a break above it, okay? So happens to be one here. Of course, we want to wait for follow through, make sure that we trade above that high, and we want to look for the other things, right? We want to look at the higher time frames to make sure that they're in line. We want to look to our left to see if there's any overhead resistance. We want to still check off those boxes, and if we can, then we can take the trade. Otherwise, we do not, okay? It's that simple. What else do we want to look for? Microsoft, for example, another great stock to trade. Again, why is it a great stock to trade? It's very clean, very ordered, has a lot of volume behind it, okay? It is a common symbol. So again, when you're in a strong trend, look at the bars. They're very uniform. They're very similar in size, okay? When you get more volatility, look at the size of the bars here, back and forth, compared to here, okay? Look at this period in here, right? Very, very messy. Now, was there slope? Would we have taken the symbol? Yes, we would have, okay? If we just got here alone, okay, after this move, and we looked at it and said, are we near the 20? Yes. Is it sloping? Yes. We look to our left. There isn't much overhead resistance. If the weekly and the monthly were in line, all of that, we would get in. Now, this is what I mean by if it starts to go against you, it's going to get you out very quick, okay? So very small loss, all right? Then we go here. If all those eight things that we look for line up, yes, I would go in again. Small loss again, okay? It happens, not very often, okay? Because normally when you start to get this chop, the 20 goes flat, okay? And then you'll be out of it. But because we keep our losses small, right? Once you do catch a move like this one, especially if you're adding to your positions, the amount you make in here more than makes up for this many times over, right? But again, you want to look for the cleanest chart out there. You want to look for the best slope, you know, and I do that for you every night and give you ideas in those emails. But with this add-on and with the MetaStock platform and the scanner you have and everything and the expert commentary, which I'll show you in a minute, it all makes it very, very easy for you. Another symbol request, Netflix. Let's look at Netflix. All right, so do we call this a clean chart? Not the cleanest, in my opinion, but you know, we could try to look for trade ideas. So here's an example, right? If we look down here, do we have slope? Yes, we do, right? But are we close to the 20? Well, we're really not. We're pretty far away, in my opinion, right? Because if we're going to put our stop down here, it's going to be a lot of risk. So I would skip that, right? This one's a lot closer, right? It's fine. And, you know, would we have hit an overhead target here? We would have. I wish we had more time for me to explain where we set our levels, but you can look for prior pivots. There's many different ways of doing it. We explained that to you in the training that comes along with this, right? This one would have been a nice entry right here, very close to the 20, right? Nice slope, etc. When I look to my left, I don't see a lot of overhead resistance until we get up here. So that would have worked out nicely. But again, we look back here, and again, you can tell when a stock is trending strongly. Look at the price action here, right? Compared to here, right? Just a complete mess. So this is what I'm talking about in here. And so by following those rules in that checklist of 8 items, it's going to keep you in trades like this. And it's going to discourage you from taking trades when it's like this. And that's what it's all about. You want to trade with an edge, right? When it's likely for you to be successful in a trade, not when you're up against the market. Okay, you want to be on the right side of the market, not the wrong side, and that's what those sets of rules do for you. Okay, let's look at. Let me show you. For example, Bitcoin. I don't know how many of you are into crypto, but the only reason I'm showing you this, I'm not a big crypto guy, is to show you that it works the same way. This is the weekly chart. Okay, it's the weekly chart. We can go to a daily. We can go to, a monthly, whatever you want. Again, you want to only look for those signals that are along that slope, okay? So when we look at a chart, we don't ask why. I always say this to my students. If you're asking yourself, why is something happening? And you're trying to figure out why this is happening, you're really setting yourself up for losses. There are so many different things that come into the markets and affect the markets that it's impossible for us as individuals to figure out, look at what the Fed is doing, look at interest rates, look at what's happening around the world and so on. And then let alone individual companies or things like crypto here and understand the ins and outs to try to pinpoint when it's going to move and when it isn't. It's impossible. So don't ask yourself why. Ask yourself what is happening. And when we ask ourselves that, what we're really trying to determine when we ask ourselves what's happening on a chart is we want to know, are buyers in control or are sellers in control? That's all we really want to know. If people are buying, price is going up. If people are selling, it's going down. Okay? And I know you may be thinking, hey, for every buyer, there's a seller. Yeah, but there's a bid and an offer, right? So when there's more buying pressure, people are hitting that offer. And they're taking out the size on that offer, and then the price moves to the next offer and the next offer. That's how the price moves, right? So when there's a lot more when there's a lot more demand, price goes higher. When there's supply without buyers, right, price drops. That's all we need to know. We don't care why. We don't care why. How many people spend their time talking about whether Bitcoin's going to hit $1 million a coin or 500,000. Who cares? Look at the chart and ask yourself, are buyers in control? And is it the right time to buy here? If it is, that's all you need to know. And you pull the trigger. It's that simple. You can use this on currencies, right? Euro USD, for example. Same thing. Okay. Not the cleanest chart in the world, but if you're really looking for those times where it's best for you to get in and out, again, you look for slope and go from there. You can go to the higher time frames to try to figure out what's going to happen with this longer term, right? So obviously, US dollar was going up strongly during this period, putting pressure on the euro. Euro was dropping, right? A symbol like this, look at that. Look how small that bar is, very close to the 20. Look at the slope, right? If you looked at the higher time frame, it was most likely in line and off it went. It really is that simple. Look, we're about to get a new short entry on the euro here, all right? Do we have any other symbols? Let's see. I'll pick some up out of the air. The home builders have been extremely strong recently, right? Here's an example, the Pulte Group. Okay? Again, when you think of what's happening out there with the economy, you talk about the real estate market. There are a lot of concerns about the real estate market, okay? Prices are extremely high. Interest rates are extremely high. So not only would a mortgage be super expensive, but actually difficult to get these days from a bank to qualify for one, right? Credit card delinquencies are at highs and so on. So, the prospects for the real estate market in 2024 are actually not looking very good. So you might wonder or think, why are the home builders doing so well? Again, we don't care why. We don't need to know why. A lot of times, common sense is not compared to what you see on the chart. It isn't linked. It just doesn't make sense. But what we do know is there is a strong trend here, a very strong trend. So this is the weekly. This is the monthly. Okay. I go back to the daily, and now I look for those entries near that upsloping 20, where there's very little overhead resistance, and I jump in, and this happens. It's that simple. It really is. Look at this. Am I going to go and analyze the home builder market, or go through financial reports for Pulte when I see this? I'm not. I couldn't care less. Many of the symbols that I trade, I don't even know what they do. I don't even look to see what kind of businesses it is or what they do. I do care what sector they're in, just to know what kind of size I'm going in with, but that's really it. It really is this simple. It does not have to be complicated at all. Another symbol request, AZO from Java. Let's look at AZO. Okay, here's a perfect example, AutoZone. Is this a chart I would trade? No. In a split second, I would move on to a different chart when I see this. It is a complete mess. Now, this is the daily. If you're trading it off a different time frame, it might look different. Let's go to the monthly. See, here it's smooth. So, and if you're more of an investor, managing a retirement account, or even if you're managing money for others, we have several financial planners, money managers that are part of our membership. They focus on these monthly charts. Okay, this is where they're putting their money, their clients' money to work. Here. I mean, it's very smooth, very clean, very obvious where this is going. Okay. Now, if this ends up being a double top here, the second we get below that 20, you will have an exit and you'll be out of there. Why do you want to adhere to it? Okay. Why do you want to adhere to it? It's an absolute must. To me, an exit or a change in color is an absolute hard stop. Here's one reason why. Okay. If you look, let's go down. If you ever see gray bars, it's because there aren't enough bars to for the algorithm to work its formula. Okay. Here's InMode. Was a very popular stock, very bullish. Everything you read about this stock was great. There were great setups, great signals. Okay. Problem is that when you get a parabolic move like that, you usually get a retracement of that move just as quickly, if not quicker. Usually, that's one reason why when it turns on you and closes below the 20, you want to be out. But if we go to the daily time frame here, for example, okay, at this point, when you see this red arrow here and it closed down here, at this point, the talk on this stock is all very bullish. Still, people are feeling great about it. They just made a ton of money on this move. What they're thinking of, it's going to close down here a couple of days, then it's going to go back above and take off again. So they try to justify why they should hold this stock because it's going to rebound. Or look, there's support down here. It's going to come down here. It's going to bounce and go back up, right? And then this happens. Okay? When you get a change in color, you don't want to scale out of part of your position. You want to close out the full position. You want to scale out a part of your position when it's going in your favor. So when you get in here and it moves up and you hit a prior high, you say, okay, I'm going to take a third off. It hits another one. I'm going to take another third. Okay. And then you let that final third run. But if you ever get a close below here and a change in color, whether it's at a break even, at a slight loss, after a huge gain, you want to close out that position completely in its entirety. Okay. Because what we want to do is minimize the losses. And we want to keep what we make. Let's see. DPZ was another request, and then I'll show you the other tools that come with this. Again, not a very clean looking chart, right? pretty messy on the daily time frame. There's lots of gaps in here, lots of different size bars. Okay. And again, you look at our rules, this one would qualify, assuming the daily and the weekly time frame at that time were in line. Okay. And it would have worked out nicely. A trade like this, for example, okay, see how far away it is? Okay. Not one I would be interested in. Now, has it worked out? Yes, but I don't really care what I leave on the table. I care about the ones I catch. That's what matters. Look at this one, far from the 20. Okay. Did it work out? Yes. Would I have taken it? No. So when a chart is messy like this, it's going to be difficult to find a setup. Okay. When it's nice and clean and trending strongly, there'll be plenty of setups. Let me show you a couple of the other things that come with this. If you go to your MetaStock platform, top left, click on View and click on Expert Commentary, you're going to get this box that shows up. And here, it talks about myself, trading wins, etc. What we do. But you'll notice here to the far right that the most recent bar, there's a little triangle over it. Okay. So it always defaults there. Now you can move that to any other bar by clicking above the bar or by using these arrows. And you can see as I click to my left, you'll see this triangle moving. Okay. So what this does is when it's time, let's go down here. Where's that arrow? Okay. Let's go back here to just before the trade. Okay. So you'll see that, it says it's currently in a short, and now we're gonna move it to where there's a long opportunity. Now, here's where a different text comes in, and you'll notice that the text is the same color as the bars. So if there's no trade at that time, there'd be no text in here. If it was a short trade, it'd be red, and if it's long, it's green. So it's telling you that it's signaling a long opportunity. Okay. Then it goes on to talk a bit about options, what kind of delta you want to look for, what kind of expiry, if you're going to choose that, and so on. And then more importantly, as it moves forward here, it populates a suggested stop loss. Okay. And you'll notice this change as it goes higher and higher here. So in other words, this is helping you trail your stop along the way. Okay. So not only does this kind of guide you as to what kind of trade you want to look for or when there's an opportunity, but through the life of the order kind of holds your hand and helps you trail that stop. So if you can't be in front of your machine all day, you have to go to work, you can set a stop at that level, go to work next night, come back, have a look at where it is on the next bar, and then update your stop, etc. So very, very, very handy. And then, of course, one of my favorites is the scanner. If you go to the top left, click on the P for Power Console, come down here, the third tab on the left, Explore. Okay, you get all the different strategies that are programmed in here. Mine, they're in alphabetical order, so mine will be at the bottom here. And there's Vora Victory, for example, and then Vora Victory Filtered. What's the difference is the filtered one is filtered for slope on that 20. So Vora Victory will give you any arrow, regardless of slope on that 20. If you click on the one that's filtered, which I prefer, it's going to double check to make sure there's slope on the 20. And so it wouldn't give you this one, for example, but it would give you this one. Okay. And then the reentry, which are the dots. So again, if you just choose Vora Victory Reenter, it'll give you any dot, regardless of slope. If you click on the one for filtered, it'll filter that out for you. What I like to do is right-click here, set as favorites. So now all I have to do is go to this tab, make sure these boxes are set, and then go down here and pick the group of stocks I want to scan for. So I always look at the U.S. Optionable stocks. There's 5,800 of them. It goes through it in no time. Then come to the right here and select my time frame. Okay, I would go for weekly. In this box, it confirms what you're searching for. You click Start Exploration, and up here, it's going to show you how many stocks, 5,832. You can see it's already gone through over 100 of them. It goes through it very, very quickly, okay? And I'm not going to let it run. Obviously, I'm going to cancel this, but here. So for example, the trade ideas that it finds, it will populate down here. Here's an example, ALKT. There's a new long and new short. Whichever one has the number 1, that's the type of signal it is. Okay, so if the 1 was on this column, it'd be a short idea. This is a long idea. It gives you a number for the degree of slope. It starts at 5. So the higher the positive number for longs, the better. The higher the negative number for shorts, the better. It'll give you its closing price. Okay, I generally like to trade stocks that are over 30, so you can sort it that way, and the symbol. You can copy and paste this list into a watch list. You can print these out. You can do whatever you want. I like to just highlight it, click open chart, and over here, look at the type of setup. And there you go. You see how it's filtered for that slope? It's given us a real nice slope near the 20. Now we just have to wait for the close of this bar to see if it meets that checklist of eight items, okay? And we go from there. So it really is that simple. I think I went over time. I apologize. I'm going to hand it back to Jeff so he can let you know how to grab a copy for yourself, but I'll stick around if there's any questions. Jeff, sorry if we're going a little long here.
Oh, you're fine. We're happy if we can get in under the hour. Right. So no problem at all. A couple comments that I wanted to kind of just say from YouTube. Let's see, although now I'm having a hard time finding them. Hager says, very good webinar. Or Hanif Cigar says that in YouTube. And Greg says, this is good info. Will the session be recorded? Yes, we're recording. Actually, you're watching this on YouTube, so just come back to the same URL. But great job today. Appreciate it, Vince.
Thank you. Thanks for having me on.
Very cool. Let me go ahead and do this. I'll show my screen as well. And let me just get this off over here. Okay, all right, very good. So as you might have imagined, Vince's add-on has been a very, very well selling add-on for MetaStock. It does a great job. Vince did kind of talk a lot about kind of what's included with it, and I'll just kind of highlight it real quick. With it, you're going to get a detailed commentary alert. You have the full market scanning, so you can scan for the setups. You're going to exit the entries. It does include system testing. It doesn't include a commentary, so you can actually go in and see exactly what the recommendations are with the trade. Vince does a really, really good job of actually highlighting that and putting it out. One of the things, I'm actually kind of a little bit of a new member and that we've been including with this is 1 year access to the TradingWinds Pro membership. So if you go to tradingwinds.com and you sign up, it'll cost you about $97 per month. And with that, you're going to get the multiple times a week emails. You're going to get the sessions with Vince Live, where he can sit down and look at charts with you. You're going to get his reports that actually come in that you can read, that have like the trade ideas, all of that kind of stuff. And that the access to that is like $97 a month normally. So if you get his add-on though, it's normally $19.97. It's a one-time cost here, $9.97. You'll own it forever. That's going to include a few things. It's going to include obviously everything Vince showed you in the software. It's going to include 2 bootcamp classes that we sat down and we actually recorded. That basically where Vince goes in and he talks about kind of how to scan, how to find the stocks that he likes. They're 2 individual sessions, and each of them, if memory serves me right, last between an hour and an hour and a half. Okay, we're going to give you a money back guarantee so you can try it out. If you don't like it, we'll give you a refund. We're going to give you 1 year access to that TradingWinds Pro membership service I was talking about, and that Vince talked about in good detail. And if you need access to MetaStock, we'll give you a free 30-day trial to MetaStock as well. And as I stated at the first of the thing, it's been rated #1 in its price category 30 years in a row. So there's a couple ways you can actually take advantage of this particular offer. You can give us a call, 800-882-3040. You can chat online with us at metastock.com/sales chat. And it's also part of like an offer that includes like all of the things that we're actually marketing today. So Vince Vora's Victory, you'll get 3 months of GoNoGo Complete, training package that we put together with Oscar a couple years ago. He's coming up in a few sessions called Trendlines of Trainings. Jake Bernstein's Setup and Timing Triggers. 3 months of Price Headley's Big Trend Toolkit. A service called Learn MetaStock that you're going to get for 3 months. And Unleash the Power of MetaStock, a workbook and a video. So normally, that entire package would be over almost $4,000, $3,985. The event that we're doing today, it'll be $1,692. So you can actually do this online at metastock.com/summit deal. You can call us at 800-882-3040. And you can also visit us online at metastock.com/sales-chat. Abdul says, I'm waiting for my weekly trading idea. Oh, great. Thanks for signing up, Abdul. That should be automatic. Let us know if there's any issues with that, but thanks for using it. Awesome. All right, very cool. Real quick, we're going to say thank you to Stocks and Commodities Magazine, great sponsors of the event. If you're watching us on YouTube, just because you stumbled across us, you should go sign up for the free issue. And then there's also a lot of other bonuses you can get as part of registering. But if you go to metastock.com/traders-summit, just fill out a little registration form. You can get a free month of Stocks and Commodities. You can get some free courses. Almost actually all of the presenters today offered a freebie. And so if you're interested in any freebies, it's a great place to get it. So there you go. I'm also going to say thank you to CMT Association. CMT Association, our next presenter is actually a CMT. CMT is a well-respected, well-reputed organization. You can find out more about them at cmtassociation.org. Tyler's actually going to come in at the very end of today. He's going to talk about how it can be very, very important if you're looking to manage money, if you have assets under management. It was really eye-opening to me how much a CMT designation can be helpful. And he does a great job of talking about that. He's going to come in a little bit. So there you go. Okay. All right, our next presenter. Oh, actually, and we're MetaStock. We're going to talk a little bit more about MetaStock as we go today. If you want to do just an extended trial of MetaStock, because you've heard maybe it's been rated number 130, not 29 years in a row, but 30 years straight, you can go to metastock.com/traders-summit 3 for 1. Or you can give us a call, or you can chat with us. So our next presenter today is Martha Stokes. Martha is a good friend of mine. I love having Martha in. She likes to talk about dark pools. She likes to talk about volume. She does a great job. So we're going to go ahead and bring her in here, let her talk, and I'll get out of the way as soon as we get her going. Martha, how are you doing today?
Hi. Yeah. Okay. We're just getting things set up. Are you ready for me?
I'm ready. Yeah.
Okay.
Let's see. I'll let you know soon. And I can see your screen. Oh, I could for a second. Yeah. Okay. Now I can. All right. So everything looks good on this end. I'm going to go ahead and let you go unless you need anything from me.
All right. No, I don't. Can you see me?
I can now.
In my office. All right. Okay. Hi, everyone.
All right. It's all yours. I'm out of your way.
Thanks. One of the things I thoroughly enjoy doing is introducing people to ideas and concepts that are from the professional side. Today, we're going to talk about momentum power trading and how you can use that. As always, I am an educator. Technitrader is the educational division of my corporation, and it's been in business for 25 years. So this is an education. I do not recommend stocks and things like that because my Series 86 covers research and teaching, not recommendation of stocks. So we're going to have momentum power trading. That's me. I'm a long-standing CMT, full service member of the Chartered Market Technicians and approved by the SEC Series 86. I'm going to pause here for a minute because this is very important. The SEC is cracking down on anyone who recommends stocks and requiring a Series 87, anyone who gives technical or research analysis or whatever a Series 86 is required. The CMT Association and the CFA provide those credentials or testing through the SEC. I'm the co-founder of Technitrader and the CEO. Howard Johnson and I developed this 25 years ago to educate retail and professionals. We're a very special niche boutique educational company. We're not right for everybody. We're right for people who are very serious about becoming semi-professionals to professionals, are very serious about what they want to do as far as training and trading and making money in the market. A lot of people just want to have fun. They just want to make a few dollars here and there, and that's just okay. But this is for more of those of you who want more education. Cycle evolution theory was my landmark doctoral thesis that earned me my CMT in the shortest time ever. How to identify evolutionary cycle deviations are now a big part of the CMT. And they also asked me back to provide the relational technical analysis program that I taught. It's a revolutionary way of looking at technical analysis and using it, and it expanded the body of work of technical analysis also. So I am a professional of the market in my retirement, trying to help professionals and some retail traders who are very serious about becoming more proficient and actually making a living from the market, okay? So momentum power trading is about finding the stocks before they move. You're going to need a certain kind of indicator called a large lot versus small lot. We have developed 5 hybrid leading indicators for MetaStock exclusively. They are only found on MetaStock, and they are designed to improve your analysis of the market by understanding who is in control of price. Sometimes, and I will explain this a little bit further, there's different market participant groups. There's about a dozen now, and that's a lot of different market participant groups. The stock market of the United States is the largest in the world. If you take all of the other stock markets and combine them into one stock market, we're still so much larger. There's over $100 trillion in asset management by our buy-side institutions globally. So trading stocks is a skill. You can learn all the strategies that are constantly promoted by hundreds of gurus and day traders. You can study all the Japanese candlestick webinars and books. You can watch the hundreds of videos on YouTube about stock trading. You can learn about MACD, RSI, Elliott Wave, Fibonacci, and on and on and on. However, you will never attain a high level of income from trading stocks until you learn the skills of trading, and that's what I teach. Trading like a professional is a skill, not a strategy. A strategy is applied to a trading style. Once you accept this fact, then you will become highly trained semi-professional, earning the respect and income all professionals enjoy. There's nothing more delightful than to have one of my students find themselves being very respected by the professional side of the market. I had one student who took from me for years, and suddenly he was the head of a $100 million hedge fund from my training. So you can go all the way, or you can just be a stay-at-home mom or parent and you want to do something, but you want to make that extra income that you can't make elsewhere. You can make it in the market. And remember, we're a digital economy now. It's no longer a consumer-based economy. The financial industry is the largest and most important industry in the US. So it's important to learn this stuff. Advanced skills. This is an advanced spatial pattern recognition skills webinar. If you're a beginner or novice trader, you will probably feel overwhelmed at times. Instead of trying to take it all in, focus and learn one aspect of the analysis process today. Later, you can go back and study it more. So advanced and professional traders take notes. People remember only about 20% of what they hear and see. Learning highly skilled relational technical analysis takes time, but it is worth the effort in higher profit from each trade. My goal in teaching is to give you tools and skills you can use on your trading to enhance what you already know. All of you have taken some courses, all of you have taken some webinars, or maybe you're just brand new and you're just starting out and you're just trying to look around and find, see, what can I do? It's okay. Many of you have been trading stocks for a while and have taken training or watched webinars, and you're trying to trade. You're here today because you're not as successful as a professional, because if you were as successful as a professional, you would be trading the market this morning. you would not be watching these webinars. What I teach is a new approach. What you don't know is the cause of your losses, frustration, and low profits. Momentum price action is commonly used for swing trading and intraday trading. However, and oftentimes a platform position trader or an intermediate term trader, which are all trading styles, will find themselves holding a stock that has gone momentum. The US stock market is in a new, young, bull market. Anybody who says otherwise doesn't know what they're talking about. We have been in a bull market, and we started moving up into a bull market several months ago. So we're ready to go and have one of the longest bull markets in the history of the United States, because there are over 20 new technologies driving the economy. So it's big. Therefore, it is important to recognize and understand momentum price action, even if you choose to trade the easier style of position trading, which is very easy, is really good for beginners and that sort of thing. So you want to follow and say, who's in control of price? When you know who is in control of price, you know how price will move next. We have pro traders totally changing their strategies, and they nudge the market, and then they cause HFTs to trigger, and I'll show some of that to you later. The topic of momentum power trading is extensive, and we're only going to be able to cover a limited scope of what you need to learn to trade fast-moving stocks successfully. There is insufficient time to cover every aspect of momentum power trading, but what you take away today will be very beneficial. This training is intended to introduce you to all the aspects of momentum power trading you have never heard before. It may surprise you, but most people lose money trading stocks during a strong momentum action because they don't understand, or they're trading with scared money. Let me talk about scared money. You see all these long wicks and tails? That's scared money. They're taking money off the table, but the stock keeps moving up. It goes up a little bit, and then they panic and they sell. It goes up a little bit, panic and then sells. Meanwhile, the pro traders are instigating an opportunity. At some point, this thing will gap huge. To be successful, you must have a complete process for trading, a trading style, or STUs, a set of rules and parameters you use every time you trade. Professionals don't use trading systems. They have their own unique proprietary indicators. A lot of them are mine, and they have a lot of their own rules and parameters that they trade. They are not getting rid of floor traders. They are adding to floor traders. So AI and all that is not replacing pro traders. I've talked to a lot of buy-side institutions, and they say, no, we can't get rid of them. They're extremely important because the way they analyze stocks is a skill that we just can't get into a computer yet. The goal today is to show you how MetaStock charting software and Technitrader's proprietary indicators can help you see when a stock is poised to move with momentum for short-term profits. When you're trading a stock, it's like the weather. You can ask about the weather during the day. You can ask the weather for the next few days and that sort of thing. So it's similar to that. We have MetaStock charting software with momentum trading. We have a top that forms, and then the stock runs down, some buying on the dip, which is a mistake because people didn't understand that the stock was in the downtrend, because prior to this, the dark pools were rotating and lowering their inventories until such a point that happens that there's so many sales going on that it starts the pro traders triggers and the HFT triggers down. At some point, and the indicators start to show you that this is a shift, we have massively long TTQA, which it indicates that smaller funds are dumping. We also have an HFT spike in volume. This is never, ever dark pools. Dark pools do not move huge volumes. They increment it over time. So what you have here is you have a lot of smaller funds selling, and then slowly over time, the dark pools are accumulating. We have a dark pool buy zone right here. Dark pool buy zones are where they halt the downtrend with their heavy, large lot. I see 1 million, 5 million, 20 million share lots going through before the market opens. And they slowly slow the price down because the fundamentals are above the stock price at this point. So it's a bargain for them. Then we have a retail trader nudge, and that stock moves up with Momentum. I will explain the difference between velocity run and a momentum run in a moment. And this helps guide you into understanding. If you understand who is in control of price, what their intent is of that trade, how they move price or not move price, because a lot of what's going on with pro traders and dark pools, buy-side institutions, is they don't move price much. And they keep their volume at a level that hides their activity. There's 50 dark pool venues now. There's only 13 public exchanges in the US. So that tells you that there's a huge amount of stuff going on that you never see. Trading is a process. What is the first thing you need to know before you start selecting stocks to trade? What is the current market condition? There are 6 market conditions: bottoming market condition, platform market condition, moderately trending up or moderately trending down, velocity market, which is a speculative gambling mode, up or down. It's the shortest market condition of all. Moderately trending is the longest market condition of all. Trading range, which is a huge, wide sideways pattern that can get traders who are novices or less experienced and don't understand it, they can get into whipsaws and all kinds of problems. And topping. Topping is often rounding or flat tops these days rather than head and shoulders, so you need to understand that. 4 of these conditions are sideways patterns. Each sideways price action is different and unique to that particular market condition. The automated marketplace trends sideways about 70% of the time. So you need to understand the difference between resting days pattern, a consolidation, a sideways pattern, a trading range pattern. There's a lot of different things, and where that sideways action is happening in relation to what it's going to do next. So the moderate trending and velocity are trending markets for both up and down, and they occur. So what market condition are we currently in right now, folks? Which one are we in? Anybody know? We're in a moderately uptrending market because we have succeeded past strong resistance in the indexes and in the broad base of stocks. There's about 7,000 stocks and about 3,000 or 4,000 ETFs. And all of those are short-term traded. So there's a lot of activity going on. Downside price action is very different from the upside action due to the lower number of market participant groups actively selling short and trading the downside market. So you got to be aware of that. A lot of people say, oh, the upside market is just an inversion. The downside is just an inversion of the upside market. Run from those people because they have no idea what they're talking about. So we're going to talk about the U.S. stock market participant cycle. A lot of you are internationals and you trade this U.S. stock market, so it's important for you to learn this, and it's a very important part of your MetaStock Technitrader experience. The buy-side institutions are also called dark pools. They form the bottoms. They also precede the tops. They start selling out as things go speculative. They do it in such a way that you don't even know they're there. They also are on their ATS venues, which are off exchanges that are exclusive to buy-side giant institutions, and nobody else is allowed in. HFTs can't get in there, nobody can get in there, but professional traders and buy-side institutions. Now, the professional traders on the buy side, they have lots of floors of traders and they use them. The sell-side institutions tried to get rid of their floor traders and discovered that a computer is incapable of doing what the brilliant brain of a highly skilled, highly trained professional trader can do. So they're adding to their list of them. And they're also increasing their number of technical analysts and CMTs and CFAs on staff. Professional traders that are independent. There are a lot of professional traders who got tired of working for either the buy side or the sell side, and they trade independently. There are a lot of them out there, and they make amazing amounts of money. You will never hear about them. They are very exclusive. They don't use chat rooms. They don't talk together. They don't share. They are very, very centric, and they pay attention to what they're doing, and everything else doesn't matter. Wealthy private investors have the best money managers in the world. They're also mostly men and women who ran a big corporation or who started a corporation and made it huge, like Bill Gates. And so they know business, and the stock market is the business of businesses. So since they know business, they can tell their money manager, hey, go buy this stock or get into this this private company because I know this thing is going to take off, because they know business. That's one thing that most of you don't know. A lot of you are employees or maybe you are a sole proprietor or something, but you don't understand business as well as a wealthy private investor because they owned a big corporation and they understand how the business cycles and all of that. The stock market relates to the business cycles. The sell-side institutions are your 6 major banks of the US and a couple in Europe. They're also the giant financial services companies like Goldman Sachs. They provide a specific service. This group are long-term investors. These can be short-term to augment or control the inventories for the buy-side institutions. Professionals also trade short, trade a short-term thing, and they will buy and sell short. The sell-side institutions have professional traders, the best in the world for short-term trading. None of these groups, they trade anymore. There's not enough. The decimal is too tight. The penny price spread is just too tight for the money they expect to make on every trade. So the sell-side institutions are involved in doing the buybacks for corporations and for trading and making money for their company. And they're the best in the world. You have corporations. They will assign their bank to do the buyback action that they want. We don't have a lot of buyback actions right now. Why? Because the corporations are expecting corporate taxes to rise at some point. And they're stuffing all their extra money into infrastructure, and they're working on hyper automation of their IT department, which can eliminate a huge amount of their IT people in IT and save them a huge amount of money. They're going to have higher revenues and higher earnings because everything is going better for them. They also buy smaller companies. They might buy a private company, invest in a private company. They may take it over or they may just nurture it. So they're in the market too. High frequency trading and hedge funds are the companies that make the gaps, okay? So when you see a gap at open, that's always going to be a high frequency trader. If you see huge volume spike, that is not the dark pools, that's high frequency trading and hedge funds doing that activity. The sovereign funds, foreign funds, and nonprofit funds are out there, big entities, but they hover between being a professional side and a retail side. Small asset management, small funds, small hedge funds, AAII, and investment groups are on the retail side. Small assets by the SEC are considered anything with less than $3 billion. Vanguard at one point was worth $9 trillion. So $3 billion is nothing in this market. We have $300 billion trading hands every single day, and it keeps going up. Small lot investors, means, and retail trading chat groups and retail traders get in very late in this trend because they don't understand how to trade with the professional groups. And then we have the odd lot investor who has a little tiny bit of money and they rush in and they buy a stock at the top, and of course, then the thing goes down. We're not going to talk about that. So 20% of all market activity as this group with some of this in there, and 80% of all the market activity is these groups, and you don't have access to most of their activity. So you have to use it in your MetaStock charting software, and you have to use the indicators so you can see what's going on with this group because they're controlling 80%. Got this? Okay. So market condition analysis, momentum action, who is in control of price? What technical patterns are prevalent and reliable? Just because you see an engulfing white doesn't mean that you can just buy it, or just because there's a up arrow, down arrow, you have to understand whether that's going to continue or not. The only way to know if a trend is going to continue is to understand who is in control of price at that time. It changes constantly. How will price behave at resistance and support? Depending on who is in control of price, resistance levels and support levels vary in terms of weak, moderate, strong, very strong, support, or resistance. What trading style works best? There are certain markets that require a different kind of trading style. What indicators to use? We have the 5 leading hybrid indicators for MetaStock. The inherent risk in trading specific styles. What trend line patterns are common? You've learned trends. You've learned uptrend, you've learned downtrend, you've learned what they call neutral trend, which is not true. There's nothing neutral about the market, or a sideways pattern, but you have never learned trend line patterns. What entry and exit signals are most reliable? You've learned reversal candlesticks and you've learned continuation candlesticks, but this is not Japan and this is not the 1600s. 21st century. And the entry and exit signals that actually work for the US stocks are different. They're very specific. I call them nudges. I call them stair steps, springboards, pole vaults, hurdles, so that you understand what it is, resting days, so that you understand it's a term that you can say, oh, I get what this means, rather than the beautiful terms of Japanese candlesticks that don't make sense to what is actually happening with the price. The strength of the price and volume patterns, they have to be strong. Market condition analysis tells you how and when to trade. Who is controlling price? What to expect in the near-term price action because you're trading short-term, where to find excellent stock picks fast and easily, how to enter, and when to exit. You don't want to go in and say, oh, I just want to get $25 or $100. As soon as I hit that, I'm just going to exit this stock because I'm really trading with scared money. I've lost so many trades. Oh, I just want to make some money and I don't want to lose anything. I just want to make some money. I don't want to lose anything. It's like, you're going to lose because your attitude is totally wrong and your confidence is down. When you trade, you should be totally confident that you are trading something that is within your risk tolerance and that is probably going to move in the direction you expect it to 70 to 90% of the time. All professionals have a 90 to 95% success rate. The price moves in the direction they intend it to move. Most retail traders are at the 30, 40%, and a lot of programs will tell you all you need is 50% success rate. Not going to cut it. At the end of the year, are you taking a loss? Or are you taking a profit? Market condition analysis is a roadmap of which market participants are actively trading, which are sidelined or waiting for the price to hit their buy zone, and where we are in the overall long-term, intermediate term, and short-term trends. This gives you the information you need to start planning for momentum price action. We've started to have that momentum price action that always comes with a young bull market. A lot of people get excited. There's high demand for ETFs right now. So there's rapid accumulation going on by the derivatives developers. Momentum is a sudden event, especially nowadays. The professionals' triggers are subtle, and I call them nudges. They're trying to nudge that price by just giving them a large enough large lot and a large enough, just small, very small white candle to trigger those HFTs and have the HFTs run it up. Okay? So market condition analysis is my proprietary and professional relational technical analysis conditions present at any given time. I wrote this many years ago, and I customized these for MetaStock because I had a trading floor and Howard was managing it. And he said, we need something more than futures at open because it's not working. And so I did this. I want to know all the stocks that are moving up with momentum. I want to know all the stocks that are moving down with momentum, and I compare it as a bias. I want to know how many dark pools are accumulating. I want to know where the HFTs are. I want to know how many stocks have improvement in price action over the last so many days. I want to know if there is a lot of trading ranges that are turning down. I want to know if there's a lot of consolidations because price is very tight when the professionals are in it. So it gives me this roadmap of what's going on. It includes quantitative formulas which reveal whether dark pools are active or not and whether the market is entering a momentum mode, a platforming mode, which is sideways but about 10% wide, and incipient mode where the dark pools are pulling back, or void where there's not enough buyers for all the sellers. Voids are very dangerous and you don't see them instantly on your charts. They happen later. Voids are becoming more common nowadays as so many of the giant institutions control when their orders trigger. Market voids are extremely high-risk conditions which are not visible in the index action, news, or other market indicators due to the type of order and venues giant funds now use. You cannot see the dark pools even on a level 2 screen. I know there's things out there that say, oh, this whale is coming. That's not a giant dark pool. That is a small fund gambling. And it's very dangerous to chase smaller funds because they don't generally use technical analysis. So this is an example of my MCA scans for quick analysis and MetaStock. These are my indicators. It really helps you speed up the process of developing your skills. If you become a skilled semi-professional trader, you will reap a much higher return of income. If that's not something you want to do, that's okay. I'm a boutique educational company specifically for those who want to become semi-professionals to professionals. So here's some common ground. Momentum power trading uses the rules and principles of the trading style called swing trading, which is a one-run trade. This is a entry pattern, and it's a one-run trade exiting here. Professional traders create a price nudge, which is a new entry signal that we see in the U.S. market. A nudge is a professional trader's buying of a stock with sufficient quantity lot size to trigger the automated orders of HFTs. They've got to figure it out. An HFE is a computer. It's dumb. It's a program. It just does what it's supposed to do. And it's like, we can beat this HFT. And they have for the past couple of years. I've been watching this for a couple of years before I introduced it to people. The entry must be made prior to the sudden speculative runs created by HFTs and retail groups that cause huge gaps and runs. The run can be either a momentum run or a velocity run. Now remember, HFTs are triggering on the millisecond. So you have 60,000 trades in a second. So the exit is usually prior to the stock retracing due to professional profit taking. So you want to see in your indicators that, okay, it's time. I have one indicator in particular that's excellent, that's showing that they're going to start taking profit. Today, we're studying only momentum power runs to the upside. So a momentum run, this is very important. These are basic information about momentum runs. A momentum run is a sudden move up out of a bottom formation, an extreme low ending a downtrend, or a run up out of a consolidation or compression pattern. So a momentum run can occur in a bottom, it can occur in a resting day pattern, it can occur in a tight consolidation, it can occur in a compression pattern, which is what you see in Bollinger Bands is compression and expansion patterns. It can occur suddenly as the HFTs are dropping a stock and they fall below their fundamental level, boom, that thing is going to move right back up into that, above that fundamental level. Momentum runs often have candlesticks that overlap as retail day traders trading with scared money take profits too soon, leaving the bulk of the profits after they exit. So they often overlap or they have long wicks and tails. Momentum runs may also have inconsistent energy, also known as up and down volume and resting days. So there's a lot of activity with the momentum because when we start seeing the momentum, retail traders and smaller funds get in there, but they're trading with scared money or not a lot of money, and so they can cause whipsaws and other things. So you need to get in early and ride the run up. Shift of sentiment in the TTQA and lower volume that pops up just above the moving average periodically tells you that this is occurring. The longer volume bars are HFTs. There may be consolidations within the run. That's okay. Just hang in there. Therefore, momentum runs can last longer than a velocity run. Both momentum runs and velocity runs require an understanding of day-by-day price and volume relationships. So volume can go up and down. It can change. We can have wicks and tails. We have long candles and resting days and long candles. That's a momentum run. A velocity run is also a sudden move out of a consolidation, compression pattern, resting day pattern, or a bottom low. The volume starts out at or slightly above average as pro traders nudge price to trigger smaller funds buying in HFTs and retail day traders. Candlesticks tend to get longer at first, then shrink as the velocity run starts to lose energy because pro traders are going to be taking profits while the retail day traders are buying. Candlesticks tend to have smaller wicks and tails. Volume steadily rises with price as more and more speculative trading and buying and gamblers come into the price. Volume continues to increase during the run and ends with either a high-frequency trader volume exhaustion pattern or a fading volume pattern. So these are the tricks of a velocity run, and it helps you understand whether you're in velocity or momentum because you have to change how you use your stop losses and where you exit. Price often accelerates each day with a longer candle forming than the previous day. Volatility. is an often misused term. It means that the price action is unreliable, choppy, and inconsistent with unstable runs up or down. Volatility occurs during indecisive market conditions when there is a lack of market participants, especially the dark pools. Most speculative runs are created by retail traders, retail investors rushing to buy emotionally, and odd lot investors buying to get rich quick. Professional traders create the nudges which trigger smaller funds buying and HFT runs and gaps. You want to be in with the pros. Understanding how a run develops helps you learn how to take advantage of these big gain moves. This is a volatile price action. When you see something like this, give it up. You can't trade this. If you were using a system, it would be red light, green light, and you'd lose money. Volatile runs should be avoided as they are higher risk with lower profits. Only a human eye can disseminate whether this is a good momentum run or a choppy sideways. And look at all the wicks and tails. Yikes. Throw this away, go on to the next chart. Angle of ascent is important. There's angle of ascent or descent. Angles of ascent or descent are your best friends. This is an analysis that is only taught by Technitrader. It is the understanding of the physics of price action. The steepness of the short-term trend matters during a swing trade or velocity trade. This is an invaluable analysis for all short-term traders. The angle of price is moving tells you a great deal about what will occur next. This allows you to plan your exits based on technical patterns rather than emotion, fear of loss, or trailing profit stops. Using the Technitrader hybrid leading indicators, you are able to exit close to the highest high of the run. You never want to try to hold on to get the highest. No, just get out at the top and be happy with what you've made. Angle of ascent tells you when to exit at a fast running stock before profit taking creates a black down candle or a big whipsaw like this candle. So you would be exiting on this candle and get out near the top the next day. In order to be able to identify chart patterns that are poised to move with strong momentum or velocity, you must use a combination of candlesticks and confirming the candlesticks with leading hybrid indicators. Indicators on their own aren't enough, and you don't need price and time indicators. Candlesticks are your price and time indicators. This is the only way you can identify momentum versus non-momentum stocks. Stocks without ProTrader hidden momentum will move more slowly. Momentum is generated by professional traders nudging price to initiate HFT triggers that gap and run stocks, often with velocity action or momentum action. Each market condition has different signals prior to a sudden momentum or velocity run. As an example, during a platform market, you need to use indicators that lead price rather than merely tracking price, okay? Indicators for momentum trading. Most of you have heard or have been taught that price and time indicators are the most important indicators. Yes, they are. And they're the candlesticks. That's all you need, candlesticks. They are price and time. Many of you only use price indicators such as MACD, stochastics, Fibonacci, Elliott, Bollinger Bands, etc. How do I know this? Because traders come and ask me, I need help. I'm using these indicators, and I'm going, well, you're using MACD, you're using stochastics, you're using RSA, you're using basically a set of indicators that doesn't tell you anything different than what you would see on the candlesticks. Oh, others of you use VWAP or volume bars. These are very dangerous. Why? Because everybody thinks on the retail side, and I have to keep informing you of this, that VWAP has something to do with dark pools. It doesn't have anything to do with dark pools. Smaller funds use VWAP entry orders. So when the HFT gaps up or runs up, the VWAPs automatically trigger. Boom, 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 boom. You have this huge surge, this huge run, and the pro traders are already in it, and they're going, yay, let's take some profit. That's why so many smaller funds have gone out of business in the last 2 years. This is better when you understand things, but it's still 1970s to 1990s indicators usage. This is 1923. This is 2023 going into 2024. This is ancient history. Most of these were written years ago. Bollinger Bands is still really good, and I do include that, but you've got to be careful because there are, rather than use stochastics, which is a price and time indicator, why not use a volume oscillator instead of a price oscillator? Because then you get some information you don't have on the charts. Nowadays, with dark pool venues off exchanges, the most critical indicators are uptick versus downtick for day trading. For swing trading, large lot versus small lot indicators are crucial, and we have these. We have these in MetaStock. Technitrader has TTQA and TTVA for students to use in their MetaStock charting software tools provided to each student so that our students have exactly what they need for their trading style. Technitrader has 5 unique high-grade leading indicators that were created specifically just for MetaStock charting software users. During a moderately trending market condition, momentum is sudden with subtler signals in candlesticks and hybrid leading indicators. So you have to study. So this chart that I have here is the same chart here. And you can see that it starts to move up. Using MACD or RSI or stochastics or Fibonacci or Elliott waves signal after price is moving strongly upward. Thus your risk rises exponentially because you're late in the trade. You get it very late, and profit taking by professionals can and will whipsaw you out of the trade to cause losing trades, and then you'll wonder why the stock keeps moving up. The earlier you can identify a momentum power surge forming prior to the actual movement of price before price moves, the more profits you can make. Stocks often gap during moderately trending market conditions, and stocks build underlying energy are not always easily seen in candlestick patterns from many traders because they haven't been taught spatial pattern recognition skills. They're trying to rely on other things. And a lot of this is brand new, and it hasn't been into the systems that are out there. Using the proper indicators will definitely help you see the subtler nuances and patterns. If it could be done by a computer, the banks and the sell-side institutions and the buy-side institutions would have a computer doing it. No, they got these massively huge floors of traders. Nowadays, 80% of all the transactions in the U.S. stock market occur in off-exchange alternative trading venues called dark pools. There's 50 of them. Currently, there are 50 dark pools and 13 U.S. public trading exchanges, such as ICE, which owns NYSE now. NASDAQ Exchange and BATS exchanges are 2 you may know. The dark pools are permitted to delay their orders until a few hours after the U.S. market closes. Thus, you must wait for all the data to be in before studying stock charts for the next trading day. Did you know that? If you trade intraday as a day trader, then be aware that you can only see 20% of all the market activity. 80% is not available to you, no matter what charting software, no matter what level screen, no matter what system you use, it isn't there. It's not allowed there. That increases your risk of whipsaw and sudden changes in price because the dark pools are maybe buying against you. It also creates illiquidity in even big blue chip stocks for intraday at times. Now, so hidden rates are, this is the dark pools, and these are some of the other professional traders. Then we get into the high frequency traders. So all of this is on the SEC. You can study it, the metrics. That's how they study and see what's going on. They check to see who's doing what, and so they can penalize people that are doing bad things. Key elements for momentum power trading is the current market condition, the active market participants, creating that market condition, the most reliable candlestick patterns, which are buy or exit signals, proper indicators to use, angle of ascent or descent, which warns you that the stock is getting out of control, impact on various support and resistance levels, controlled entries with correct orders. We have a very special order that we have that Howard created for us years and years ago. I came into his trading room and he was talking on the phone, and I said, "What the heck are you doing?" And because he was laughing and joking, and he says, "Oh, I'm talking to the market maker." And I said, "What?" He says, and he goes, "Okay, sure, yeah, you can use my order system. I'd be delighted if you would." The market maker was a very important one in those years, Herzog, and he said he was so impressed with Howard's specific order type that protected from whipsaws and all kinds of things that he asked if he could use his, and today it's still being used by the professionals. So when you become a Technitrader student, you learn how to trade like a professional. Your stop loss and placement, most of you use percentages. Everybody can see your orders. So when you all cluster order and you get together, they take you out. They don't care. daily analysis of price action and energy, selecting strategies that work for the market condition that you're in. When you use hybrid leading indicators designed and written for the current market conditions, you are able to identify the hidden momentum energy that's going on before the big price moves. Hidden market energy, boom, blasts off. Dark pool, hidden accumulation. See this little marker down here? This is our indicator, TTVA. It told you that they started to buy right in here. As it continues down, they were buying. And then when it gets here, they stopped and pro traders take over. Dark pool, hidden accumulation over time slowly draws more and more liquidity from the stock. At some point, the buy zone will be obvious on the chart and to professional traders who will nudge the volume with larger lots to trigger HFTs to move price suddenly with a big gap or run at market open. You need to learn how to enter the stock with the professional traders to be in the stock before the big gains. As I said before, I can't teach you everything in 30 minutes, 60 minutes. So I want you to know that chat rooms and gurus create cluster orders. Many technical trading systems include some AI use either MACD or stochastics for formula trading using rather primitive and oversimplistic algorithms. It doesn't work in our modern market. Chat rooms are also very popular with retail day traders. Why? I have no idea. The chat rooms cause risk as you end trading. You tend to trade as a group. The most popular retail indicators create inherent risk in today's electronic order processing system because they can see what you're doing. You can't see them. High-frequency trading firms use these indicator formulas in order to find anomalies in the order flow. So high-frequency traders have programs that are written that track cluster orders. When you have a cluster order identified by the QA formula or AI, it triggers HFT millisecond trades that can move price before the trading system's orders can be filled. This is a primary cause of whipsaw action when using technical systems. A normal order flow is all over the place. Different people are buying at different price levels. Cluster orders are where you get together and you all decide, okay, we're all going to go and buy Boeing because it's been running like a bandit. Or look at IBM. Wow, that's really going. So let's all buy this together. And so they can see your orders and they just trade against you. That's why most of your losses occur, because you don't see them, they see you. Dark pools have a controlled bracketed order that's a price range, typically around 10%. It can be 8% or it can be 15%, but typically 10. So the semi-professional, professional traders do not trade in groups. They trade independently. So if you need a group, you're not going to be making as much money as when you can be skilled and confident and trade by yourself. Because I don't know a single professional trader that trades in a group. They don't do it. Summary of trading like the professionals. Choosing 1 to 3 optimal stock picks to trade instead of 10 weak picks is going to net you far greater profit and lower risk things. I have a manage your trading planner that Howard created, and it's just awesome because people go, first thing when they're students and they use a trade management planner, is they go, Martha, I only have to trade a couple times a month to make that kind of money. It's like, yeah, the more you trade, the higher risk. So being very careful about what you trade and not trying to trade every day, every minute, every hour. You don't need to. It's surprising how little you trade and make really good money in the market. Learn how to select the strongest patterns with Technitrader candlestick buy entry signals confirmed by Technitrader hybrid leading indicators in MetaStock charting software. It's a winning combination. Trading only the very best picks, you will lower your trading costs, make higher profits, and keep profits made. Work toward a 70 to 90% success rate on a consistent basis. If you are not at 70% yet, then you should be on a simulator until you have achieved that percentage level. Junior traders, they get on the floor. The senior traders don't help them. Professional traders average 90 to 95% consistent success rate. I've been on floor trades, and a junior trader comes in, a brand new guy, and everybody ignores him. Nobody will talk to him. They don't stand around the coffee machine and chit chat. They don't do that. They're at their desk making money because they're on commission. The more money they make, the more commissions they make. Most importantly, you will continually increase your confidence in your ability to trade. A lot of trading is like anything you do in life. If you're skilled, you're confident, and you can do it. And you don't need other people to tell you what to do. You don't need other things to happen. You are in control of your destiny. Chronic whipsaw trades and losses, no matter how small, erode not only your capital base, but you're confident in your ability to trade successfully. So you're doing two things. You're losing money and you're losing your confidence. And then you get scared money and you start trading and trading. Oh, what should I do? What should I do? I don't know what to do. Okay, I'll make it shorter. I'll trade for only 10 minutes. Okay, now I'll only trade for 5 minutes. Okay, now I'm only going to trade for 2 minutes. The shorter the time that you trade, the higher your risk. And you're trading way outside your tolerance zone. If you're scared, if you're nervous about being in that stock, then you're trading above your risk tolerance. That's something we also work on with students. The net result is a trader who's doubtful, second-guessing their decisions, and panicking at every hiccup the market makes. Trading with scared money is a recipe for disaster. Learn to be highly selective in what, when, how, and why you are trading a particular stock or ETF. This discipline will reap huge returns for many years to come. I have many students who become professionals and make huge money. I have many who just stay-at-home parents, make more money than their spouse who's working at Boeing. I have a lot of success stories. Momentum power trading is not for everyone. It is a high-skill trading style that requires training, education, and the development of skill. Just like driving an Indy 500 race car, momentum power trading takes skill development as well as a full-service charting software, MetaStock, and a comprehensive education that is taught by credentialed and SEC-certified professionals. I do not let anyone who doesn't have a Series 86 teach my students. So there are two of us who have the Series 86. This allows us to train with the SEC approval. If you are going to go to buy a course, you need to find out whether that person is certified and has the Series 86 or 87 or other SEC approval, because the SEC is cracking down on individuals who have no SEC certification or license to do what they're doing. We do. So our students work with professionals. However, you can make back your investment in MetaStock trading software and Technitrader education quickly. Many students tell us that they pay for their education in just one or a few trades. Just the other day, somebody says, Martha, I just made money to cover all the costs of my education and my MetaStock. Consistency matters. When you learn to trade like a professional, you become a semi-professional and earn the respect of professional traders. And that is a big deal. Trading stocks is not about sitting around during the market open, talking to other retail traders. It is about making consistent income. When you sit around and talk to other retail traders, one leader in the group maybe come forward, or you're all talking, you're all trying to agree, or you're all griping about the market makers ripping you off. That's not how professionals do. Professionals are loners. If you just want to have fun and you want to join a group and you want to be together and you just want to chit chat and you don't really care whether you make money or lose money, that's fine. But if you're really serious, then you may have the potential to become a student. We have a webinars attendee special only. It's available through December 18th. And it's how to find the dark pool activity. Here's a little thing that you can use to scan code on your QR. You can apply for the coupon at 2023 Econ 12. So you can either use our link here, Jeff, or they can just take their little phone and snag it off the screen. And I have something else to show, but I'll leave the screen up for a little while. Jeff, do we have any questions?
We do, and I will do my best to type and talk at the same time.
Right,
Martha, let's see, G wants to know, Martha, does your conditional analysis work only for indices or just individual stocks?
It works for both. I have an analysis, the market condition analysis. I do an index analysis. I write 2 market reports every morning. I'll write a market condition report for my students, and I write the market open report. It gives them all the information that they need. They're 2 big, long reports that come. So I have a lot of professionals, and I write that between 3 and 4 in the morning because I have pros all over the world that are using that. The market condition analysis is actually everything. It takes all the stocks and ETFs that are being traded and analyzes to see which ones are doing what. So it's a full, complete process. Yeah. It was really necessary because futures just don't work as well. You know, it can change a few seconds before the market opens.
All
Okay.
right. Another question we had is, what time frame do you use to see the nudge? Bob wanted to know.
The nudge, you won't see it intraday because they don't trade on the public exchanges. So what you need to do is after the market closes, I do a real quick end of day analysis because there's a pro traders auction that's only for professional traders, and a lot of activity happens, and that happens within the last 3 to 5 minutes of the market thing. That information isn't in the daily charts yet. And so we have to wait. Then it's not in the intraday because they're not on the public exchanges. Intraday is only the public exchanges. The ATS venues are off the exchanges, so you can't see that during the day. And that's a really big deal that people just don't understand. And it makes a huge difference about how you impact what you do. So what I do is an immediate right at market close, about 1:15, 1:30. And then I come back around 5 or 6 and I check my market condition. And I will often see that there's a huge change in the numbers between close at 1 o'clock my time and 5 or 6 my time, my Pacific Standard Time. So that tells me what's going on. Then I analyze the difference, and the students can learn to do this. My professionals learn to do this, and they can analyze it and they can see it. A lot of students will do it on their own and then compare to my analysis of what's going on. And it's a full depth analysis. So it tells you when to trade, what to trade, where to look for stocks. It gives you all this information. It's way ahead of what the indexes do. A lot of times the market condition analysis will be saying one thing, the indexes are doing something else. Well, you have to remember that the indexes constitute less than 8% of all the stocks and ETFs traded on the exchanges. So it's a big deal. Okay, I'm going to move this forward. I think everybody can have that if they want that. And then we do have a year-end sale going on, and this only happens once a year. And so if you want to get it now, I want to remind you, we're a boutique shop. We have 2 Series 86s who teach the students and guide them and show them things. We also help you learn to set up your own trading process and trading style for you. But you do that work. I expect you to be fully committed because this is very professional trading. Students love it. We have students that are just amazed, and whether you're just a retail or a beginner, we have a beginner's course, we have an intermediate course, and we have the elite, which is for people who wish to become professionals. So we have the 3 different courses. They're all on sale right now until the year end. But because we are a boutique shop, because we're not this huge corporation that's trying to sell millions of things because we're just this niche, we only have so many students in that we can put in and train at any given time. So if you want to get in, you want to get in early, and you want to get registered early so you can start learning right away, because we do have openings now still a little bit in December, and then we'll have some other later on. So you want to consider getting in now because the market is moving. It's moving with momentum. It's not just the indexes. There's tons of stocks moving and bottoming. The stocks that were damaged by I say damaged, there are about 150 companies who benefited from the pandemic. So in a single year between 2020 and 2021, they just blasted off the charts because they had all these stimulus checks driving their revenues. Well, they had 3 years worth of revenues in a single year. So the year after the pandemic, right, the next year, their revenues can't possibly be that high because there's no more stimulus checks. So now all of a sudden, year over year, just looks like awful. And everybody goes, oh, I got to get out of that stock. Well, nobody considers that the pandemic has changed everything. And you have to think, is this a pandemic anomaly, or is this a change of cycle? What's going on? There's a lot of different things going on. I'm a cycle theorist, and I'm going, well, that's a broken cycle, and that's never coming back. So you have to understand that. It's really exciting. I just love teaching in my retirement. It's just a super blast. I'm so proud of my students. And I know there are some of you out there today because you always sneak into these things just to hear me talk. And I'm very, very proud of them because they do so very well. But it is a boutique shop. And we are trying to make you semi-professional so you can make a huge amount of money. If you just want to play and have a good time, I'm not for you. Okay?
All right. One last question. I did, after 3 attempts, I was able to get that into the chat properly, both of the URLs. So, but we did have one last question from Reg. Reg wanted to know, at first look, the last chart looks like a long, the platform prices and a green above the red. Can you just take a look at that last chart and confirm if it was a new in a long position for Reg?
For this one?
I guess.
That's the last chart.
Okay.
This is a short-term trade, though. Did you mean the one where I had the full chart across in the beginning?
No idea. No idea, actually.
Okay, if you come and register on my site and say, hi, I was part of the MetaStock charting software, and you say, I want you to study this chart for me, I will make that. I will take the time out of my teaching my students, and I will personally answer your question.
Perfect.
Okay. Right.
And this comment comes actually not from our YouTube chat and not from our GoToWebinar chat, but this actually comes from our internal chat that we use here at the company. But I wanted to read it to you. This is from Greg Lewis. You might know Greg.
Yeah, I know Greg.
I like Martha's presentations a lot. She is very informative. So I thought I'd throw that.
Oh, thank you. Yeah, I try to show you things that you don't know, and that you need to learn. And if you've seen a few of mine, you probably see some repetitive, but it's still really good because people forget, and it takes education is a process. You go along and you kind of plateau, and then all of a sudden you go up, and then it plateaus again, and then all of a sudden it makes more sense. I'm always learning something, so I'm always reminding myself as a student that of various different things that I do on the side, that when I hit that plateau, it's like, okay, I'm not going downhill. My brain is just learning that process. And then of course you have this huge light bulb moment. You go, oh, wow. Oh, I get this. Yeah. And all of a sudden things are clarified. So I always take classes and various things because I know that reminds me of what it's like to be learning something that's very exciting, but also can be challenging.
Cool. Reg also added, thank you so much. I'm a fan, so to speak. Merry Christmas.
Okay, great. Thank you. All right. See you later.
Thank you. Thanks, Martha. Happy holidays.
You too.
All right, very cool. Let me go ahead and do this. We'll do a couple changes here, just kind of get things moving. And, all right. And there's a few things I have to do. Okay. Thanks again, Martha, for coming in. That's great. Just a couple of reminders. Today we'll be talking about we have a lot of really good speakers today. Martha did a great job. We are offering a summit action pack or a summit pack or whatever you want to call it. It's going to include a lot of the stuff that we're talking about today. Vince Vora's victory, GoNoGo charts, complete 3 months of that. Oscar Carboni's trend lines and training, and drawing tools training that he did. Jake Bernstein's setup and timing triggers. 3 months of Price Headley's Big Trend Toolkit. 3 months of Unleash and MetaStock, or learn MetaStock.com, and then Unleash the Power of MetaStock. So normally all of that would be $3,985. Here at the event today, we're actually doing a really, really big discount, $1,692. You can take advantage of that by going to metastock.com/summit deal. You can give us a call, 800-882-3040, or you can visit us at metastock.com/sales chat. So there you go. Very, very much appreciate everybody that's been in here so far today. We're doing great. The session is doing awesome. Thanks for coming. I hope you're enjoying it. And before we go to our next speaker, I want to say thank you to Stocks and Commodities for sponsoring today's event. You can find out more about stocks and commodities if you go to metastock.com/traders summit. Actually, you can get a free month of stocks and commodities. If you're watching us on YouTube, go to metastock.com/traders-summit. Register for today's event, and you can get a whole bunch of free training as well as like a free issue of stocks and commodities. So metastock.com/traders-summit. So our next speaker is another good friend of mine, Price Headley. Price actually was somebody that we've been working with for a number of years. What he likes to do, and I love it when he says this, but one of the things that he likes to do is he likes to focus on big opportunities, and wrote a book called Big Trends in Stocks and Options, has been rated several times the Market Timer's top timer of the year, Market Digest top timer of the year. He always does a really good job. I love his approach to trading, his philosophies, all that kind of good stuff. He's also going to give us a very, very good presentation. Are you ready, Price?
Yes. Hey, Jeff. How you doing?
Hey, I'm doing good. How are you?
Oh, fantastic. Thank you. Great
Are
to
y'all
be
ready
with you
for the
as
holidays
always.
yet?
No, absolutely not. How about you?
I have it on my list. Get ready for the holidays.
I got the official 2 weeks until Christmas countdown today. So yes, this will be a busy week in our household, I'm sure, as we scramble around.
Cool. Well, I can hear you. Oh, here. Let's see. And I can see your screen. Okay, we're all set. You're good to go. I'll get out of the way. Your turn.
Well, thank you, Jeff. Great to be with you all today. Thanks for everybody joining in. I know just tons of great information across these trader summits. Thanks, MetaStock, for organizing all that and giving folks a chance to see what really resonates with you about what you're looking to accomplish. It's interesting, in my 24 years since having started bigtrends.com, how my philosophy has adapted and evolved. I remember when I got started in options trading, I started with the super way out of the money approach, going for the super cheapies, and that was not working. And then went for the more in the money, more expensive options as I launched bigtrends.com. That was working, but not giving me maybe the optimum leverage. And so what I'm sharing with you today, here in my now 34 years of options trading experience, is sort of a middle ground where relatively cheap options, not the super cheapies, but relatively cheap stock options have been dramatically outperforming the more expensive ones in our recent data as we look back over recent years through all kinds of market conditions. But it's about still knowing how to pick those out, right? How to find the best of the best opportunities. And also being pretty disciplined about saying, if it doesn't fit what I call my success profile, which is like what a good trade's supposed to look like, if it doesn't fit that profile, we tend to blow them out pretty quickly and move them on and basically not get stuck holding too long on things that aren't fitting your typical kind of top 20% of your trades, kind of that Pareto's principle, 80-20 rule. 80% of your results come from the top 20% of your actions. And trading, especially in options buying, we're talking about today, that is certainly true. Those top 20% of your trades are going to drive most of your profits. You want to stick with that. So as we get things rolling on my end here, let me just remind you, everything I'm sharing with you today is based on our proprietary research, and it's intended for illustrative purposes only. Nothing we talk about here should be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but also large potential risks. The past performance of any trading system or method is not necessarily indicative of future results. So do see our terms of use on our bigtrends.com homepage for more information here. So what I'm going to focus you on today is this has become my favorite small account strategy. Now, it doesn't mean if you have a large account that you can't trade this. You can trade it with large accounts too, or medium accounts. But our goal here is, so we're looking for doubles, triples, even quadruples, which would be on our final target, a 300% profit target. So we're going to walk you through that and share with you why, kind of like how two heads are better than one. In this case, two indicators are better than one. We call it double confirmation. Both of them signaling together is what we want to see for kind of extra quality of trades. It doesn't guarantee a winner. There's never any guarantees of any trade winning or losing. It's going to say, okay, it's following a system and where the edge is stacked in your favor. So we'll show you both when it worked and when it didn't, how to manage that with case studies and detailed chart examples. And then it's also about knowing that, okay, there's never been a better time to trade options in my 34 years of options trading. Commissions have come down so dramatically. You don't have those high costs that you had early on in my trading journey. So it's never a better time than now to start with options, and also knowing that you can manage risk. And let me ask you a quick question before I get things into my slides deeper is, what's the experience level of options trading with our crowd today? I'm going to ask you to type in a number. 0 if you've never traded an option. If you're in your first year of your options life, 1. If you're in your 20-year options trader, type in the number 20. I never name names, but I like to name the numbers of what kind of experience level we have in options trading. I'm not talking about your stock trading or anything else, just how long you've been trading options, how many years. If you're brand new, type a 0. If you're in there for multiple years, type the number of years you've traded options. It's always good to know where people are at and get some feel for like what the experience level of the crowd is. The beauty of this strategy, you don't have to have traded an option ever in your life. Basically, you can just implement this easily. We call out real-time trade alerts via real-time email and also real time to your smartphones. We got a 6-year veteran, a 5-year trader as well. So that's the first couple. We tend to get some that are brand new with a 0, so that's normal. So don't panic. For those of you out there who haven't traded an option yet, no, you should stick with this and learn the beauty of options trading. What caught my passion, I got the trading bug when I was at Duke University as a student, and it's right after the crash of '87, and basically realized that there's a lot of potential in these things. There's a lot of potential to make a lot, or if you don't know what you're doing, to have that leverage work against you, right? So leverage is a double-edged sword. It's important to know how to manage that well. So that's what I'm going to help to guide you on here. And what I do for my Grand Slam options students is what we're talking about here, called a Grand Slam options trade when we call these out. So what we'll do is we'll send a real-time email and trade alert. This is one that is no longer active, so don't try to go buy this one here. It's the IBM December monthly 150 calls. We called these out a little bit ago. You can see these are called out in early November. Now, what we have on, and I'm going to give you some meaningful specifics here so you could actually plot these on your MetaStock platform as well, that basically we say, okay, we're going to look at a couple different indicators here. The indicator in the red line here that we care about is Larry Williams' indicator here. It's called the percent R indicator. Okay, percent R. What does percent R mean? It means percent range. And you'll often see it called out as Williams percent R. Larry uses a 0 to minus 100 scale. I know Larry, he's a true trading innovator and a true trading legend. But I use this indicator in a different way. I use it in a way that says when it goes, quote unquote, overbought in the top 20% of readings, you can see I've got a 0 to plus 100 scale over here on the right. And what we're looking for is we're looking for A's, A pluses, no worse than B's, right? Basically, we're looking for things in the top 20% or less of their upper boundary. Why? Because it's no longer a range if it just keeps making higher and higher highs, right? You know what the definition of higher highs and higher lows is, right? It's an uptrend, right? It's a trend. Now, I jokingly say I should rename it percent T the way I use it, because I'm looking for things that are going to stay overbought and stay in this top 20% of readings, because that just tells me that it's continuing to make higher highs. So that's how I use percent R in a different way, the big trends way of using the Williams percent R to find trend phases. And then the blue line on the bottom panel here is the CCI. CCI stands for Commodity Channel Index. CCI is basically telling us that, you know what, when we go overbought on the Commodity Channel Index, I use it on a lot of big name stocks because it works in growth modes and says, you know what, same principle. You want to see things that are staying overbought, top 20% of their readings, or top 10% of the readings probably for a CCI reading. CCI is not bounded like percent R is. So CCI can go up to plus 1,000 or down to minus 1,000. But we just care about it staying above plus 100 or below minus 100 for these purposes to tell us that it's outside of the normal range of action, right? We don't want to trade what's normal, what's expected. We want to trade the unusual, the surprises, the moves that are bigger or worse than people thought they would be to the upside or the downside. So what we did, we got our signal here on this oval circle here, right? So I can probably take off some of my markups here. So I've been marking up the charts a lot. So basically say, okay, look, we're trading when both percent R and CCI cross into their, what's called their overbought territory. But when they both do it together, it often signals a strength signal, a power signal, that there's a thrust, like a rocket or a space shuttle taking off. You want to see that kind of power when you're riding that rocket, right? If you were riding a rocket that didn't have a whole lot of power, guess what? You're probably not going to get very far off the ground before it comes back down to earth and crashes. We don't want that crash. We want that takeoff and that coast effect of those power boosters behind us. And really where this power is coming from the institutional buying interests, right? If they see strength in the institutional community and they want to keep buying something because it's got a good story behind it, it's got good earnings, it's got good whatever, good product, good management, good outlook, that they're going to keep buying into that thing, and they can't buy all at once as a big institution moving billions and billions around. They have to buy it slowly and steadily. That's why I think these trends tend to persist. So you see the first overbought phase happens, as I was circling there on percent R and CCI. And on that first phase, once we're into that trade, which what do we call out at that point in time? It started the day November 2nd. It's actually first hour's close end of the day, about 10:30 a.m. Wall Street times, where we get our first hourly chart signal. First hour is in the books, and we've got that breakout. So we're saying, okay, at 146, by the December 150 calls. Now remember, December monthlies, these expire officially this coming Friday now, December the 15th. But we're calling it out November 2nd. So here we've got almost 6 weeks to go before these options are going to expire. We don't expect to hold them 6 weeks. So you see the first place that we got our first target is the double. And this is a golden rule, if you will, that I follow on pretty much any asset that I trade, whether it's an option, whether it's a stock. If I can double something, I want to sell half of it at a double and get my risk capital back in my pocket and in my subscribers' pockets. So if you, in this case, paid $1, it's quoted at $1, but you've got to multiply times 100. Every options contract controls 100 shares of stock typically. So in this example, if you buy a one contract of a December 150 call, quoted at $1, you'd have to pay $100 to control 100 shares of stock that would have cost you $14,600 or so. So $14,500 worth of stock controlled for just $100. That's where your leverage kicks in, right? So as it makes the move up to just under 150 here, you can see our first square here. That's our plus 100% on the first half of our trade, right? So we're getting a plus 100% reading there. Okay, plus 100%. So plus 100% is hit just under 150, about 149.5 here. I've sold half of my trade out when the option hits $2 or $200 a contract. So think about it this way. If you put in $1,000, you get every contract costs you $100 to start. It means you could get 10 contracts here, right? And so what do you do when it hits then $2,000 total value? You sell half of your contracts. You sell 5 of your 10 contracts at $2 a piece or $200 a contract. 5 times 200 is your $1,000 back, right? We do these calculations before commissions. As you know, commissions have come down so dramatically. So the beauty of this is you say, okay, look, we're looking at a situation here in which really simple, really effective. You now have the proverbial free trade right here at the start of the day on November the 8th. We put the trade on November 2nd. So about 4 trading days later, we're cashing out half our position at a double. Now you can see it's a good thing that we did in the sense that once we get a quote unquote free trade, we tend to give it some extra wiggle room here. And it drops back down on the stock to where we got in, back near 146, even goes down almost to 145 there intraday, the morning of the 9th, a week later, right? You say, if you're just riding and holding and hoping and not having a strategy to take some part of your position off the table, then you're going to oftentimes kick yourself and maybe blow it back out when it's back around to break even and get kind of frustrated, like, I left too much money on the table. My philosophy is we've got now a free trade. We should have a little more wiggle room. Sure, we still have some trailing rules, or we'll try to not give up all of that profit, of course. But remember, if you had half your trade out at a double, even if you did sell the second half out at break even, you would still average a 50% gain on the whole position. That wouldn't be too bad. But we give it a little bit of room to breathe here, and you see then it starts coming back up, and then really goes into that next big overbought phase when both of these indicators cross up together here on the next gap up, back to about where we got out near 150, and then just the next day later it goes to 153. So next stage 2 of that uptrend on the hourly chart is happening in the second week that we held this position. Remember, we've got 6 weeks to go in time starting out or so. Now we still have about almost 4 weeks to go before expiration as we close out the second half of our trades. What are my targets after I get a double? I shoot for a 200% gain on the next half of my remaining position and then a 300% gain on the final piece. So remember, if you had 5 contracts left, we'd sell 3 of the 5 at 200%, and then we'd have 2 left. We'd sell this final 2 at 300%. That's how we do it, fairly conservatively in how we manage our trade and still gradually taking profits off the table. If it keeps going past the 300% gain, that's fine. We don't care about that. You know, the idea here is that we've already made a healthy profit off of $1,000 investment. We ended up making $1,700 gross profit off that initial $1,000 investment. So you see here that works out to on average about 170% gain on the total position. So the idea is that you give yourself a chance to keep letting that trade work, but you still have stopping points, way stations, if you will, on the way where you sure it takes a stop at a double, take half of it off the table, but keep riding part of it for the bigger potential. to the 200 and possibly 300% gains. And then at that point, it said, okay, bulls and bears get rich, but hogs get slaughtered. We don't need to be piggish about trying to shoot for 1,000%. We'll take that in less than 2 weeks and be happy. Remember, past performance never guarantees future results. There's risk in every trade. Obviously, you buy an option. If you ride it to expiration, nothing happens. You could lose what you put into that trade. We're going to guide subscribers through to help you find this. But if you kind of recap, what are these indicators? So I don't have to just handwrite them on the chart. You can see the two indicators have to signal together on that same hourly close that they're both breaking out together, the upside or the downside. It's the CCI, Commodity Channel Index, used for big name individual stocks, and the Larry Williams percent R, percent range indicator, the big trends way, what we call the big trends percent R philosophy, which is really looking for more of that trend phase when it starts to make a lot of new highs or a lot of new lows on the downside. So when you combine them together, it reduces our fake outs, and we're trying to get to the true breakouts and minimize how many fake outs you have to endure. There's still going to be some occasional fake outs. So, when we get faked out, we're going to talk about how we get rid of those trades that aren't moving like we thought they were. But the idea is that, look, when you become a subscriber, we give you full access to the system settings and rules. So you can actually plot this with all the parameters, what time frames to put in, et cetera. But let's dive into another recent trade. This is another very liquid stock on Apple, right? Apple amazes me to this day that it's basically the biggest U.S. stock market capitalization, around a $3 trillion valuation. And yet it still moves a lot of times like a healthy growth stock, where we can get fairly quick moves and get fairly dramatic leverage, even on such a big name in the stock market today. So here's Apple going back to the morning of November 14th. There we have both our percent R upside cross and our CCI cross happening on the same bar. A lot of times if we get it happening on a different bar, different candle, if you will, on the hourly basis, we'll say, okay, we're not going to get in if they don't signal together on the same hourly close. So we're buying that into the next beginning of that next hourly bar here. So we're actually slightly wrong on this over that next hour. So we buy in, it dips that next hour to hour and a half. Then it starts to stabilize. By the end of the day, it's back up to about where we got in. But we're not making a lot of money yet, right? We're basically just we were down a little bit, then we're basically staying fairly stable. And you'll see there'll be tests underneath this overbought threshold, like on the percent R there, on the CCI there, or test that upper or underneath that upper green line in either one of those threshold values. Those are often what I call retracement retests, the big R retest. It's a retracement. But the idea is that the retracement should hold those retests, right? So you'll see these retracements a lot of times hold off these little stair-step moves up. So we get that kind of first leg up here and moves on up on Apple. Notice what we were buying, by the way. We were buying when the stock was about 187.5. We were buying a 195 strike call. Usually we'll go out to the monthly options, but the December monthlies were priced kind of off where we couldn't get the ideal entry for us. We want to pay $100 or less per contract. That's our first kind of starter rule. So if it told us we had to pay $125 or $150 a contract, we wouldn't take that trade. So I said to my subscribers, let's actually shift it down from the monthly options that expire the third week of December and go down to the second week of December options, because we expect Apple to move fairly quickly if it's going to move. We can get out quickly if it doesn't. So you can see in this case that our first move up, stock did not, remember, it doesn't have to go to the strike price that you buy to get a double or more in a lot of cases, especially in these higher dollar stocks. See, Apple spikes up here to maybe 191, and we're getting out of our first half of our trade at a double. So we paid 77 cents, that's $77 to control 100 shares of Apple priced at over $18,500. Right, we're controlling $18,500 for $77. Your leverage here is huge, right? So you just get about a 3.5 point or about a 2% move in Apple stock is good for 100% gain, and we sell the first half out at that double. In this case, we did tighten our stop up and said, okay, we don't want to give back too much of that, and as it comes back down later that day, this is the end of the second full day in the trade, we sold the second half out at 28.5% gain. We were a little bit tighter on our risk management here, because we had a little bit less time than I normally would start out with. So we only made 28.5% of the second half of the trade. So what did you make on the whole trade? If you make 100% on half your position, 28% on the second half, divide those two halves by 2, you're talking about a 64% gain for about 2.5 days of work. Okay, so that's pretty healthy. And you see what ends up happening is it bounces back a little, comes back up, back down, but essentially is fairly flat over the next week after we're out of that trade. Flat is not going to cut it for an out-of-the-money option strategy, right? You need speed of movement. If that was going to carry on, it should have kept rolling fairly dramatically and fairly quickly, and it didn't. So we just said, okay, the speed of this thing has throttled down, and it's time to be done with the trade. So on 12 contracts, if we assume you put in up to $1,000 invested, 12 contracts at $77 a piece would get you into about the low $900 value that you invest in that trade, and you make about $600 on the total position on 12 contracts gross before commissions. So the idea is that, okay, we're going to keep it simple. We're going to look to leverage it intelligently, but if it doesn't fit our parameters, we won't ride for the 200 and 300% objectives, even if we just got a double on half. We're going to still try to be sensible about how we manage the rest of our position. But here's one that got all of its targets on Marathon Petroleum, MPC's the symbol. Back in September, we bought the October monthly 160 calls. Here's a very classic kind of a breakout, right? And this is one of the things you have to get used to when you're a breakout trader. You get the percent R breaking out into this overbought threshold. So does CCI in a big way. The CCI reading in that first hour as we kicked off September was over 250, which is a pretty high reading on CCI. The first hour's close, we're finishing here near 146. You say, okay, 146, what do we have to buy to go out to the third Friday in October, about 6 weeks away? We're buying the 160 strike calls out into the third Friday in October, monthly October expiration. So you say, hold on, now you're going about 10% out of the money? I'm saying yes. To get an option at $100 or less a contract, we had to pay 95 cents or $95 to control 100 shares of stock. That would have cost us $14,500, right? So you can see, again, your leverage is huge here. And this is very typical of that you want to see that big thrust, that big launch on a gap, right? Whether it's earnings related or some other kind of broker upgrade or some other kind of news happening, outlook related, whatever it is. The one thing we don't try to do is buy right in front of earnings. That's not our game in this strategy. Our game is trend evolution, looking at the trend structure and saying the trend structure has now just gone into a strong launch to the upside. Uptrend should be coming here over the coming days to next couple of weeks. And you can see, okay, initially we do get our first little move up here. You can see we get a little retest point here right off of this little short-term low on the CCI. Percent R comes to give us a retest a little bit later, a couple of days after that. So these retests are holding. And you see those first couple of days, we're not making a lot. We're up and then we're back to about flat. So maybe slightly higher than we bought in, but we're not making that much or losing that much. It's basically just kind of a waiting game at first. But then about the fourth day into the trade, it starts to really kick up here. Now it pushes up towards just under 150. Remember, we're still 10 points out of the money here. And yet because we've lost so little time and we've made, in this case, about a 4-point move in our favor, about a 2% move in the stock, we're making 100% in these options. So we're selling half our position at a double. So in at $950 on 10 contracts, we sell 5 of our 10 contracts out at $1.90, and we get our $950 back. So the idea is that, okay, now we're shooting for that 3 times our money, that triple on the next piece, then the quadruple on the final piece. When did those get achieved? As the stock gaps up here into the 153 range, we're getting our tripler 200% gain, and then up to 156. I remember it well. It was a Friday morning, September 8th. We're cashing out of the final piece at a quadruple, 300% profit. So that 95 cents, $95 a contract has now turned into $380 a contract. So on your $950 invested, you made a total of $1,615 gross. And remember, with commissions, you shouldn't be paying more than $1 a contract with no ticket charge. So you could do this strategy even with less than 10 contracts. I would tend to recommend starting with no less than 4 contracts. So 4 contracts at $95 a piece invested would cost you $380. So you can do it on less than $1,000 per trade, just however, and you can scale it up as you gain confidence in it, see how it's working over time. You can certainly, of course, scale it up as well. It took a grand total of 4 trading days to achieve 100, 200, and ultimately 300% target profits over 4 trading days. So that's very typical. It takes about a week, sometimes 2 weeks to get those size of gains. Here's one that didn't get all of its targets. Here's one on eBay where we made about 100% on the whole position, 102% in the first half, 97.6% in the second half. And this one took a little time because we got off to an okay start, and then we kind of, it went slightly against us here, right? We're starting catching a breakout. Both of these are signaling, getting a little follow through, but then you see it shakes us back down to about break even over the next couple of sessions. This is right around the July 4th holiday. And then we get a market sell-off where we're like, okay, the market takes us down and starts to rebound. We're like, this thing's got to get going or we're going to time stop our way out of the trade here. And then you can see, thankfully, it did start to kick up and got that nice next second phase launch here. As you see the CCI breaking out and the percent hour breaking out together here when the stock's back to around 45 and a quarter. We bought the options when the stock was trading here around 45. What did we buy? We bought a 47.5 strike call. So we're about 2.5 points out of the money, or about 5% out of the money. And you can say, okay, well, what are we paying? We're paying 84 cents, $84 to control 100 shares of stock that would have cost us $4,500. So our leverage here is not as great as those prior examples I was showing you, right? More in the 50 to 1 range versus before it was well over 100 to 1. But yet, when it makes the move up here towards about 46.5, 46 3/4, we're getting our target at 102% on the first half of our position. So we've doubled our money. We've created the free trade. Remember, if you saw half your position out at a double, even if the other half went to 0, you would still not lose on your total position. You would break even at your worst case if you let the other half go to nothing. We want to manage that. In fact, we were so concerned about event risk here. We had a CPI inflation report, consumer price index report, coming out the next morning that said, you know what, we think it's the right thing to do later that same day to just take the rest of the trade out at a near double, 97.6%. So the two halves together average exactly 100%. We made, you can see, invested $926. We made $926 when that $926 turned into a total of $1,852 on 11 contracts. So the idea here is that, okay, you double your money for about 5 trading days of work. And then you say, okay, you see what happens the next morning. We gap up and then immediately give it back as that initial inflation report reaction was positive and then getting a little dicier. So it was just saying, okay, look, take the bird in the hand. Don't need to take big event risks tied to earnings or other big concerning inflation reports, right? But not every trade's going to work, right? We're going to have trades that don't work. So here's one that didn't work, and it's not a household name, but you can see we don't just trade tech. We traded Floor here. FLR is a huge construction company. I've been thinking for a long time that our government, instead of just handing out the trillions, would actually put some money into roads and bridges. And, you know, basically our infrastructure tends to get very poor grades, and saying, okay, we should be boosting our infrastructure up, right? Have almost that kind of New Deal era projects, right? And so Floor should benefit from that. But regardless, I'm saying, okay, well, then both of these were signaling together. Here's a breakout around 34.5. We bought the 37.5 calls. You can see we paid not a lot because these aren't priced for big volatility. So we only paid $66 a contract. You see, it's kind of working higher. The percent R is still hanging in there, but I didn't really like how the CCI was starting to lose a little bit of support here. That was raising a question for me, and so we stayed underneath it into the afternoon. We're saying, I think it's probably just the right thing to do to just take that quick loss, just under 17% loss the next afternoon. So we said, okay, as it turned out, that trade would have popped on back up. And so that happens sometimes. You know, you could say we got faked out a little bit, but it's like, you know, it should have been doing more one of these, right? One of these marches higher, and it was just kind of going the wrong direction here where we said, don't like that divergence, right? If you know what your profile looks like, sure, you can get a little volatility around it, but it should still be staying within some kind of a band of trend in your favor, right? When it doesn't do that, it's just saying time to exit out and move on. Take usually the small loss is the right thing to do when it's not getting you off to a good positive start. So kicked it out, could have made a little bit, but it just wasn't the right kind of success profile trade. But on all of our Grand Slam targets being achieved, here's one on AMD. Again, it kind of highlights that you can buy well out of the money with a strategy and still get well paid. But the secret to this is that you got to buy enough time, right? So here's one with the third week of April. We're going to have an expiration, and here we are in the middle of March. So we still have at least 4 weeks to go before the expiration when we get our launch on AMD on both the CCI in blue and the % in red. We wait for that first hour close. You say, why wait? Why not buy it off the open? Because it could definitely reverse by the close. We don't want to close that hour. We don't want to get faked out. So wait for the close. It's about $88. And here we are buying $17 out of the money. About 20% out of the money, we're buying the April 105 strike calls. And you would say, well, it doesn't have to go above 105 to make money. If you're going to hold it to expiration, yes. But if it happens well before expiration, you don't have to sweat it so much. You can see we do go through a little pause as it pulls back a little bit. We see our first % R kind of a little shakedown here right into this support level here. Then you see we get our next big surge here, and now the stock gets us our chance to double the first half of the trade at about $93. So think about that. The stock's gone up $5 from 88 to 93. What? Something in the neighborhood of about a 6% move in our favor in the option is good for a 102% first target, right? We paid $84 to get into the trade. So we're cashing that out at like $1.70. So that's why it's slightly better than the double on the first half of the trade. Now we're targeting that next target up to about, $2.55. We're getting 203% when that hits a couple bucks higher, up around 95. And then you can see it ends up going up above 98 here. And that gives us a chance to make 304%. Remember, it's still about 7 points out of the money. And all this has taken just 3 trading days to transpire, right? That's the secret, is that if you don't have to be in that trade long and you're getting good directional movement, even with that initial pause that was even had the trade slightly against us in the first day in the trade, we weren't sweating it because the structure of the trade was still very bullish. So bottom line is that, okay, we take that money off the table gradually. I see too many traders taking their profits way too quickly at way too small of a level because they've got that scar tissue of having given back a profit and being like, I'm not going to let that happen again. You can't go broke taking a profit, right? Well, if you take 20 and 30% gains and then you end up taking 50% or bigger losses, yes, you can have problems. So we like to take bigger gains and smaller losses as a general rule of thumb. We've shown you some of the individual trade-by-trade case studies, but if you look at what happens if you stack all of the Grand Slam options trades together, this actually goes back to the inception of this portfolio, which is all the way back to 2017 start. So you think about that and you say, well, if you were just putting in $1,000 a trade, and this is important here, we assume no compounding in this look back. You know, past performance, of course, can't guarantee what the future results hold. Future results are going to vary, right? What's not going to vary is that we're going to keep following our system rules. So we will not change and adapt our system. We'll just say, look, we want to keep following the system. We know it's worked for us. Over the past, there's going to be ups and downs, but if you follow the system, it tends to have bigger wins and more manageable losses. And that's our objective as trend traders, right? Let your winners run, cut your losers quickly. So a $5,000 portfolio in this look back grew to over $32,000 gross with no compounding, just keeping it at $1,000 maximum investment per options trade that we called out, including all winners and losers before commissions, mind you, and before subscription investment. So the idea is that, look, we've had bull markets. We've had, like, last year's bear market was a nasty one, right? I mean, the NASDAQ was down over 30%, S&P down like 19%. And yet, even through up and down markets, we've still been able to generate, you can see, more than a 6-fold return on a gross basis, 541% gross before commissions and subscription investment. So again, the idea is that, okay, look, updated through today on closed trades. Okay, so we're keeping it super current. Who knows what 2024 holds? And again, my philosophy is that whether you're a bull or bear on the broader market, there's always going to be a bull move and a bear move happening somewhere at any point in time on the individual stocks, right? So the question is just, is the liquidity good enough? Is it something we feel good about getting subscribers into and out of relatively easily? and then guiding you. And if you say, well, what have you done for me more recently? If you just look at November, just look at our trades trading the $1 or less options. If you put $1,000 in per trade just last month, you'd have made $1,534 gross before commissions or subscription. So the idea is that, look, okay, it's about saying commissions are very cheap now, $1 or less a contract. If you're reasonably active, you should be calling your broker and asking for even better savings than $1 a contract. I know some people that are paying $0.50 a contract. So that's what I try to get from more active traders, try to get mine down too as well. So the idea is that, look, $1,000 a trade maximum leads to a nice, if you're trading a $5,000 portfolio, that's like a 30% gain for the month on a gross basis, right? So you can, a lot of people, that would be their year. If you made 30% on your portfolio, you'd say I'd be a real happy camper for the year. You know, we were pleased to do that just in the month of November. Again, past performance never guarantees future results. But the beauty of this is that, hey, you know what? This strategy has been sold out on our bigtrends.com website, but I did just approve just a handful of spots to open up for the MetaStock community as part of this summit event. I wanted to give you a way you can get access to these trades at also not only a highly discounted rate, but also just more of a trial period. And I don't consider a trial like a week or a month, but actually looking out at what I call my MetaStock appreciation package. I am so thankful to Jeff and all the team at MetaStock for all they've done for me in helping code my big trends work so I can use it on the MetaStock platform, but also so you can also take advantage of it. And I want to leave a little bit of time for Jeff to tell you about that code. That's what's called the Big Trends Toolkit that has a whole lot of my best work in it that you can take advantage of within the MetaStock platform. But for this special MetaStock appreciation package, I want to say, look, try it out for the next 3 months. It's called Grand Slam Options. I call out specific entry and exit alerts. I never leave subscribers hanging. I'm always saying, this is the time to get in. Here's where you want to get out. It's not working. Here's where we're going to cut and run. It is working. Here's how we're going to gradually take money off the table while still giving ourselves a chance for even more potential after our first target is reached. If you were able to buy it on my website, which it's sold out on bigtrends.com, it'd be $297 a month times 3 months. That's $891. That would give you access to some extra goodies, including my specific settings and rules for Grand Slam Options as a system. So you can actually go follow this, trade it yourself, not just on what I'm calling out, but actually you can use those signals in MetaStock to go find that, or at least use the parameters of it to go follow along on whatever stocks and markets you want to trade as well. I also do weekly video training. So every Monday, so this afternoon, I'm going to record another weekly video update for my Grand Slam Options subscribers to say, this is what we traded this past week. Actually, I just called out a trade here this morning at 10:30 right before I came in to see you all. So that's something you could also potentially get access to as well as a brand new trade that's waiting for you when you get signed up. You get access also to me and my research team, my analysts that help me to follow the markets even when I'm in doing a webinar. They're watching the markets for me as well, watching my Grand Slam system and helping me to get trades out to subscribers, whether it's time to enter or exit as appropriate. Total value on this of more than $891 when you consider all the support you get with me and my analyst team and all the other training and educational updates. I'm slashing it down today for the next 3 months access to just a one-time investment of $177, right? $177 gives you tremendous value. You know, you think about how many trades am I going to make over the next 3 months? I typically average 6 to 8 trades a month. So we'll call it 7 trades times a month times 3, about 20 trades a month. So less than $10 a trade if you break it down that way, paying just $177 for about the next 20 trades over the next 90 days. Okay, think of it in those terms. It's at that special link that I've set up for you there. It's members.bigtrends.com/slam3. So I'll type that in real quick. But basically the idea, it's not a www link, by the way. We want you thinking like a Big Trends member. So it's a members.bigtrends.com/slam3. And we're big on Jeff beat me to it. Thank you, Jeff. So bottom line is that we're big on making sure that you're getting a whole lot of value and a whole lot of support, right? So it's all about saying, okay, when you think about that, it's like, okay, well, what's the value? Well, remember, performance since inception, up over 27 grand in gross profit before commissions and subscription investment. assuming no compounding, you just keep putting $1,000 into each new trade over the last, you can see since the beginning of 2017, you're talking about over the last 7 years through up and down markets still being so effective. Remember, just in the last 2 years, a lot of people think, oh, it's been a great year in 2023. Well, did you know that if you looked at the S&P 500 since the beginning of 2022, it still hasn't made back where we started the year in 2022? SPY right now is trading at just under 461. And I go back on the chart and say, where were we at the start of 2022 before Putin invaded Ukraine, before all the other Fed actions? The market closed 2021. Hasn't gone anywhere. Job as a trader is to say, don't get stuck in the hold philosophy of just kind of hoping something's going to work out over the longer haul, but being more proactive to take advantage of the market's moves. And Abdul says he wants to take advantage of this. What's the phone number? I'm glad you asked that, Abdul, because the phone number is actually available on our special order page there. When you go to that members site page, let me show you where that is. Thank you for that. Here we go. When you go to that page, there's our phone number, Abdul. It's an 800 number. So if you're overseas, let me know and I can give you a direct dial number, but it's 800 big trends is the best way to remember it. So, like we said, that link is the members.bigtrends.com/slam3 page. But if you need to remember a toll-free number, 800 big trends here in the US. And also you can reach us via email, clientcare@bigtrends.com. So if you have any questions when you go to that order page and you have any trouble getting signed up, you can either email us clientcare@bigtrends.com or you can call us toll free at that 800-244-8736. Just remember 1-800-BIG-TRENDS on your phone. Notice, we've already taken the promo code savings down, so there's no other promo code discount to be applied because it would usually be $891 off of our website. But it's just $177 gets you not 1 or 2, but actually 3 months of access to the trade alerts. You also can get an extra special bonus if you want to add a boot camp training session. It's 3 to 4 hours worth of training here on my Gamma Options boot camp. That would usually be a $295 add-on. I'm throwing that on as an extra. You can add that to your order for just another $77. So definitely take advantage of that if you want a lot deeper training for just another $77. Hit the add to order button, and that would take it up to $254. But of course, you don't have to do that. If you want to just get the trade alerts, you can remove that and just get the trade alerts alone. With the weekly kind of quick update training from me as well for just $177. So philosophically, the idea here is that, okay, remember, it's about setting yourself up to not just get a trade, but also learn how to trade. So I regularly walk my subscribers through this. As I said, the November results alone up over $1,500 gross, right? And so this package is all shown right here, the members.bigtrends.com/slam3 special link on the very bottom there. So just make a note of that. And remember that the idea here is that just to summarize in a nutshell what we're after here. We're after growth, no doubt, right? We're willing to take manageable risks to get it, but we're saying, look, the secret to that kind of bigger growth of hitting not just doubles, but even triples and quadruples is that you can't buy the more expensive options that are quoted in the $1,000 a contract range. We trade them on some other more conservative strategies in that $500 to $1,000 contract range, but that's when we're targeting, smaller gains, typically 25 to 50% type of potential. Here we're targeting doubles, triples, even quadruples when we can buy an option for $100 or less per contract. I did just call out a brand new trade as well. And so I love hearing from Abdul as well. Said, used to watch me 20 years ago, now coming back, how many trades do you get every month? We're not day trading here, Abdul, definitely. And welcome back after 20 years. I mean, that's why being in the game for 34 years overall, but 24 years here since I launched Big Trends in November of 1999. I'm blessed by so many folks who've known me a long time and now and know that, we stand behind our products, obviously, to make sure you're not just satisfied with your investment, but actually thrilled with the investment and the value we give you as a Big Trend subscriber. So thank you, Abdul, for that, and welcome back. But bottom line is that We're not day trading here. We're definitely big believers in kind of giving that trend a chance to run, right? So we showed you examples where it might take a few days to a week to even a couple of weeks. And yeah, so we're definitely all about, we want to help you to not only make it a profitable experience over time, but also invaluable in terms of the education and the philosophy of knowledge. And I'd say one of the biggest things I showed you in my time here with you, I want to hand it over to Jeff in just a couple of minutes, but I want to just kind of summarize real quick that you have to have the right philosophy for trading success, right? A lot of trading, we're all looking at charts here. Every presenter is going to show you charts, show you different plays that they made, different things they're looking at. But it all comes back to a philosophy, a mindset for how to be a winner in the trading game. And for me, the mindset is you cannot do what everybody else is doing and expect to get outsized results, right? If everybody tells you they're making money off of XYZ indicator, I'm probably looking somewhere else because I don't want to do what all the masses are doing. I want to do something different, something that's more what I would call unconventional wisdom. Conventional wisdom is not going to get you there. You can learn every indicator under the sun, but if you find things that are unconventional, you're going to be able to take advantage of it. And yes, so when you get signed up, Abdul, we'll send you the new trade we just called out. You'll get that forwarded to you, to your email address that you use to sign up. So definitely, I'll be looking for your order, and my team will be forwarding you the brand new trade we just sent out just over an hour ago. But here's the point, is that unconventionally, the word overbought, most people think of as a word that means you shouldn't buy it, right? Overbought implies that it's gone too far to the upside. But what I'm showing you here today, folks, if you didn't notice, is that overbought can turn into a powerfully good thing, a very bullish thing when the institutions want to keep buying it, right? So I look for just a confirmation that it's continuing to get bought up, and the institutions are continuing to build their position. You want to be on that train. You want to be on for that ride. I didn't get a chance to show you a whole lot of oversold here, but when oversold keeps getting more oversold, we'll play the put side as well, too. So we'll play both directions. So the idea is that we're here for you to guide you through the ups and the downs. Now, I mentioned that Jeff also has kind of been so vital, he and his team at MetaStock, in taking a lot of my big trends philosophies that have helped me to be in the trading game for 34 years and counting with what's called the Big Trends Toolkit for MetaStock. So I'm hoping that Jeff can take a few minutes out to actually talk you through a little bit of some of the value you get on the Big Trends Toolkit as well. So we're going to give you the trade alerts from the Big Trends side, but through Jeff, they can help you get set up with how to actually input the indicators and the methodologies via our Big Trends Toolkit into the MetaStock platform as well. So Jeff, I want to thank you for having me, and I hope you can walk folks through a little bit of some of the amazing things that are available in the toolkit that I've been so blessed by you and your team to be able to have coded in for me and help me get into it. So, and let me say before I hand it over, Kelvin just asked a question too.
Throw that over to you.
Yeah, thank you. Kelvin said, what's the minimum amount to get in on options? I might want to give it a try. So we're talking about, Kelvin, $100 or less per options contract. So you could theoretically buy one options contract here and have to invest no more than $100. Now, I would recommend, if you're getting started with the Grand Slam approach, that you get started with at least 4 contracts. I would recommend to try to have about $400 to commit per trade. But you could do less. You could do even $100 per trade just to get started. But I want to target not just the first target of a double, but also the chance to get a triple and a quadruple. So that would mean I'd need 2 contracts out at the double, another contract out at the triple, another contract out at the quadruple. That would be 4 contracts, or $400 per trade would be my recommended minimum commitment. But you could do it with less. And we're allowing you to start here for just $177. A lot of my subscribers will be required to pay $1,000 or more to get a year's worth of access. You're getting into 3 months for just $177 because MetaStock's been so good to me. So Jeff, I will hand it back over to you to see if we've got any other questions I need to answer before you share some stuff about the toolkit with folks.
All right. Thank you very much, Price. I appreciate that. Good job.
It was a pleasure.
All right. Very cool. Let me go ahead and do this. I'm going to go ahead and just kind of change everything over. Give me a second while I do that. Let me go ahead and make me the presenter and show my screen. And one of the ways you can always tell if we're on our 3rd iteration of something, It's been a very, very successful toolkit and add-on and stuff like that. As I had mentioned, kind of as I was introducing Price is actually, his big focus is on big trends, finding big trends in stocks and options, and he does a really, really good job with it. I just want to show you, before I kind of show you in the software, I'm going to kind of show you a list of the methodologies that we include with Big Trends Toolkit 3.0. So if you kind of take a look here, the methodologies that he kind of look, or that we kind of look for in it is the, based on Bollinger Bands. A concept that Price likes to use is called acceleration bands, and you can use that with Bollinger Bands. I'm going to come back to Big Trend Score because that's actually what I want to show you. The DMI difference, efficiency ratio, how fast, not only is how efficiently is something moving, is it moving consistently and efficiently in the direction that we want. Force index from Dr. Alexander Elder, momentum divergence, options, and his options shark system, the percentage above the 200 and 400-day moving average. This is just a list of, and of course the percentar and the stochastics. This is just really a list of the different methodologies that are included with MetaStock and with the Big Trend Toolkit. There's about 17 of them. Now, one of the things that Price wanted to do with the last one, and I just ran a scan. In fact, I'm going to show you how the scan runs. But what he wanted to do was he wanted to combine his favorite indicators into a methodology to help kind of score them. And so what we did here, actually, let me show the commentary first. If I come in here and I go to the expert commentary, basically what it's going to do, you'll see that there's a bit of a buy signal right here. Actually, did it go away? Okay, it came. Okay, right, cool. You see a buy signal right here. This right here, this diamond that appears underneath the chart indicates that yesterday, or in this case Friday, because it's a Monday, was actually a setup day, okay? The reason that we had a setup day yesterday is because we had a score of the indicators that Price likes to use the most of above 80, and that we're above what Price's big trend bands, the bands that Price used. So we had a setup. What kind of trigger is that we traded above that high. So I'm just going to go back one day. So if we'd run a scan Friday to kind of find this, there's a setup scan that you can run. And what it's going to tell us is our big trend score. It's actually loading. Oh, okay, did it go away? Okay, I think it's still up. Hold on. Okay. All right. So right here, you've got this arrow. It indicates that this is the day that you're looking at. And so on Friday, we had that big trend score of 80, okay? And he's looking, here's the indicators that he's looking at: percentar, 2-day Williams percentar, the commodity channel index, the efficiency ratio, acceleration bands, Bollinger bands, ADX, DMI difference. You can see how all of those kind of are stacked together and how they're scored, okay? What this means when you see this setup is that there's a setup for the following day. So if I kind of zoom in here, it's going to say the big TS is a combination of 10 of Price's favorite indicators. Each of these can be found in the Big Trends Guidebook. Traders should look for a score of at least 80 to confirm an underlying signal. For long positions, traders can look to trade at above the high of the previous bar to confirm the position. So here we have the setup. As soon as we triggered into this trade, it would have been triggered by going above the high. That happened today. And that's why I'm looking at AMD, because I ran a scan to find that particular setup. And here, now that I've kind of got that scan up and on the final day, it's going to basically kind of give us some advice in terms of how to do this. And I want to read this out to you. So this is actually crossed above 80, and the price is broken above the high. This indicates you can take a potential long signal. If you're interested in taking advantage of this opportunity, you could look to buy the stock. If you're buying an option call, you could look at 2 months before expiration. If you're aggressive, you could look at this, and he kind of goes into a lot of detail. Very, very well put together. Actually, I love Price's actual commentary. And a lot of times when I look to design commentary, I look at kind of the way Price has put together commentary to find it. So here, this is what we're looking at here is the expert advisor. You've got the setup bar here as well as the trigger bar. And of course, with MetaStock, one of the things that I like most about it is your ability to scan. So if I come in here to the scanner, this is actually how I found AMD today. If we just look at the BTT3 scans, you've got 80-day Bollinger bands, acceleration bands, setups, triggers, momentum divergence, all of those 18 different systems are going to have scans with it. What I ran was the big trend score trigger. And so everything that we found on this list, and I'll show you the list real quick here, report, everything on this list had actually either a buy setup and signal today, or a sell setup. And all of them are buys because you see that it's all just ones in that comp. Was able to quickly go through that, kind of find a list of the stocks that are there. And I personally love scanning. Every day when I come in and do the markets, I just ran one. Every time I trade the markets, I'm actually running a scan. Because as a trader, what I want to be able to do is ignore opportunities that, like, I don't even care to look at stocks that don't have a good opportunity in the market. What I want to do is focus in on the ones that have an opportunity and then decide the ones that I like best. So that's what scanning does for you with MetaStock. So let's kind of just recap. We're a little bit out of time, actually. In total, this is going to have 17 different methodologies that are included, 17 explorations, system tests. You can test them to see how well they work. There's a total of 18 custom indicators that are indicators that either price is designed or kind of modified a little bit, and all of it's included. One of our most popular add-ons. For this particular add-on, it's available on a monthly subscription. It's $49 a month is all. So for $49 a month, you get literally a software that's been kind of created in conjunction using one of the top market timer digest, top market timer of the years, all the methodologies that are included, the systems, all of that kind of stuff. What we're going to do here at the conference is if you buy a month, we'll give you a second and third month for free. It's only $50. So you can do that by giving us a call at 800-882-3040. You can go to metastock.com/saleschat to sign up for that as well. And it is part of the big package, the holiday special, if you would, the Summit Action Pack, if you care, which includes Vince Vora's victory, his year of service, the GoNoGo charts complete, Oscar Carboni's trend lines and technical triggers, Jake Bernstein's setup and timing triggers, 3 months of Price Headley's Big Trend Toolkit, 3 months of Learn MetaStock, so you can learn how to run everything, get some really good lessons on everything. And all of that is normally $3,985. We've got good specials on all of it today, but here it's $1,692. So you can sign up for that at metastock.com/summit deal. You can give us a call, 800-882-3040, or you can go to metastock.com/saleschat. So give it a go. An awesome package, more than 50% discount. So real quickly, I want to say thanks to CMT for sponsoring today's event. CMT is a very well-respected, well-reputed organization. You can find out more about them at cmtassociation.org, 646-652-3300. Tyler Wood's going to come on at the end of the day and talk about how having a CMT designation might be helpful for you. He's also going to come in and talk about GoNoGo now. So anyway, CMT, great sponsors. We love working with them, cmtassociation.org. Let me put my headphone back in. Okay. All right. And of course, we're MetaStock. I need to go in and fix this. 30 years in a row, MetaStock's been rated #1 by the readers of Stocks and Commodities magazine. It can help you scan markets, test trading ideas, forecast probable price activity and movements with our patented forecaster, get real-time alerts, commentary, and signals. All starts at $60 a month. It's part of our Summit special. You can buy a month, and we'll give you the second and third month for free. It's been rated #1 for 30 years straight. Give it a go. metastock.com/traders-summit 3-for-1. So in any case, let's kind of move on. Our next presenter, we have two, Tyler Wood and Alex Cole. I don't know if it's an Alexander, actually. We should ask. Anyway, Tyler and Alex do a really, really good job. If you have MetaStock 18, as part of MetaStock 18, they actually gave you a free trend analysis that they're going to cover. They have quite a bit more that's also included, but they also do a really good job. They're going to come in and talk next. So Tyler, how you doing?
Hey Jeff, long time no see.
Hey Tyler, it's good to see you. Yeah, it's been at least like a month. Ooh, you dressed up. You're looking great.
Every once in a while, it's important to put on a tie and remember that in the morning you come around. Get my mind focused. Yeah, but it's good to see you.
Alex, I know you like to go by Alex, and we always call you Alex. Is it Alexander? Is that your official name?
Only when I was in trouble with my mother growing up.
Yeah, that's the only time I hear Jeffrey.
Yeah.
All right.
In fact, funny story real quick. When I was young in school, they made us write our full name, and I would write Alex and my middle name Ander and my last name Cole, because I thought that was just my middle name. I'd never been called Alexander in one go.
Ander, that's a great middle name. I'm going to start nicknaming you that, bud.
Yeah.
I think that's great. I think that's also cool because my daughter's name is Annabelle, but her middle name is Bell. And then my other daughter's name is Ash Lee, but her middle name is Lee. So
she's not Annabelle Bell then?
No, just Annabelle. Her first name's Anna. Her middle name's Bell.
I like that. That's
From the
good.
Department of Redundancy Department.
You're right.
Annabelle Bell. Oh, Jeff, thank you so much for having us here today. What an awesome day so far. You have had a killer lineup of presenters and educators, and hopefully the audience is ready for a little more, maybe refreshed their cup of coffee, ready to dive into a little more education.
All right. Well, I turned off my camera, so that means I'm getting out of your way. You guys go.
Fantastic. You can see my charts okay? Everything's coming through? Awesome. So everyone, thanks so much for sticking with us. I know we are in the middle of the trading day, but hopefully you can take a second, step back from your screens just to think a little bit about the process and tools that you use every day in the markets. Alex and I are so appreciative to Jeff and Kelly and the entire MetaStock team for giving us an opportunity to come here and teach. Alex and I have known each other for well over a decade, and mostly in the context of teaching institutional investors about technical analysis. A lot of them, like myself, going through an MBA program, you get a strict diet of bottom-up financial statement analysis and sort of the fundamental view of the companies that we're talking about investing in from an equity perspective. But today we're going to talk a little bit about GoNoGo charts, whether or not these tools become a part of your workflow. Hopefully today's session has a lot of value for investors of all stripes. And hopefully we're talking about some big picture concepts that you can take and put to work in your own trading. So our company is very, very new, but these concepts and tools are really timeless. So let's dive right in. For anybody who's been attending webinars that we've been hosting with MetaStock, hopefully these first few slides will just be a little bit of review, and we'll get into some current markets. But as we dive into the concept, I think we have to ask ourselves just a little bit about how trading has felt, maybe this year versus last year, or maybe last year versus 2021. And if you can recognize, or maybe you've been keeping a trading journal, recognize that your emotions might look very different from year to year. And even the trade length or trade size might look different in a bull market versus a bear market. What we're focused on as investors is developing a repeatable process, a system. A lot of people they spill a lot of ink in financial news media and give a lot of airtime to talking about algos. Well, algos is just a system of rules, a setup where you can automate your trading. And certainly understanding how to code in Python is very, very helpful. But it starts with having an idea about what your checklist might be, a rules-based approach, something that you can do repeatedly to help remove some of that emotional bias, some of those, I guess, underpinnings from our behavioral heuristics. And so for Alex and I, the concept behind GoNoGo charts was exactly the same as what most fund managers and institutional research analysts are producing, which is a systematic approach to the markets. But instead of leaving our algo in a black box and telling everybody to just trust us that it works, we thought we would put it back on the chart, use data visualization to our advantage, and so that everybody can see how the tool is working in real time and use it in your own way. I think one of the difficulties with trading is there's a lot of sort of paint by number or mimic somebody else's trading style, which may work for a time, but trading is deeply personal. And so you need to be able to customize things to your own objectives, your time frame, and all the rest. So just to help illustrate this point, I'm going to speak for you, Alex. You're trying to teach a 16-year-old how to drive. So I'm sure right now you're going through a little bit of a traumatic moment trying to keep this kid safe and other drivers on the road. But as you learn to drive or learn to fly an aircraft or sail a boat, you name it, you're going to start before you ever get behind the wheel of any vehicle. You're going to have this rules-based checklist, this approach that you go through every single time. It's the exact same sort of operator's manual, if you will, to keep yourself safe, to make sure that you don't make ridiculous mistakes and injure somebody. So if we apply that to technical analysis, we might have a similar checklist, multi-step approach, where we're looking across the markets and across a varied mix of indicators to give us a weight of the evidence. Is it safe to merge into the traffic light? Is there a trend that we can join? Can we on-ramp to this security? And we might use a mix of things, trend lines and some of the classical stuff. We might use a mix of indicators. We might look for confirmation between those indicators and what's happening with the price action. But Professor Cole, why don't you walk us through very specifically what this might look like in a rudimentary or a very straightforward technical approach to identifying trends?
Yeah, and I think we can all agree that we've spent some time in technical analysis that trend identification is that all-important skill, because if we can identify a trend, then we can trade in the direction of that move, right? And we can profit from the bulk of that movement in price. It sounds really easy, sounds really straightforward, but it certainly isn't. So what we need to do is be objective in trying to do just that. So what might we do first? Well, we might eyeball the chart. And of course, here we can see that it's going from bottom left to top right. Nothing tricky there, right? It's a series of higher highs, a series of higher lows. We know that price has moved in a trend, but it's easy to do this after the fact. But how do we identify when the trend is beginning? Because that's, of course, what we need to do to be able to profit on that movement in price. So we're going to probably turn to something that allows us to automate the process and remove that subjectivity. So we might go to something like the Donchian channels. That's going to automatically find higher highs and higher lows for us, because what the Donchian channels do are look back at a period in price action and just ask whether or not price is the highest price has been. And if it is, then you'll see that green line move up. The green line above price, of course, and the red line below price moving up as the lows move up. So it just allows you to visually, somewhere sort of in, I guess it's end of March, April there, we're getting a new high there in the Donchian channel. And if you have any interest in the history of trading, of course, I'm sure everybody does, but don't be shy about looking up the Turtle Trader experiment and those amazing story, and those traders use Donchian channels as one of their primary entries in that whole experiment. But then what might you do after that? Well, you might then turn to something like a simple moving average. If anybody's looked at a technical chart or even a financial chart, they've probably seen a moving average on it. Moving averages aren't really even considered, I mean, maybe that's a stretch too far. They're, of course, technical analysis, one of the earliest tools that we've had. But in some platforms or some charting packages, not really looked at as core technical analysis because they're so prevalent. So everybody has a moving average on their chart. It's inherently bullish, of course, if price is above its moving average, because what that tells us is that price right now is trading above the average of its prices over whichever period you're looking at for the move ad infinitum on charts. But certainly adding another one can provide value, because that allows us to look for crossovers. And now we get the idea that a short-term average moving over a longer term average, that gives us a sense of direction, because we're able to smooth prices, but still get the information that shorter term price activity is moving in this direction we're looking for faster than the average of its longer period. So looking at a moving average cross is very important. But we might go on from here and look at something else. Of course, if you've had any background in technical analysis, you'll have probably studied Bollinger Bands. John Bollinger, an absolute innovator in our space, done so much great work, and we're privileged to have been able to hear from him and meet him at events and learn from his work in the industry. And the Bollinger Bands are just a brilliant concept, because they plot bands around price that encompass the vast majority of the data. So if we think back to our math classes when we were younger, we know that around a mean, 2 standard deviations should encompass about 95% of the data. Now that's of course for a normally distributed data set. Financial data is not normally distributed, but the vast majority of price action should fall within those bands. So when it doesn't, that's significant, that's important, that's something unusual happening on the price chart. So we know from reading about Bollinger Bands is that when price trades up and out of a band, we can trade in the direction of that break, especially if those bands are narrow, right? There's certain interpretations of the Bollinger Bands, but right there in that same sort of area, we've now got Bollinger Bands being broken to the upside, as well as price being above its moving average. We had a moving average cross a little bit later there. We've got Donchian channel new highs, right? We're starting to stack the weight of the evidence in our favor. But we can go on, right? A lot of people will add something like volume to the chart. This is the first of the non-price indicators that probably you'll have on a chart, and it's been used as a confirmatory indicator to provide understanding of how much market participation is affecting what we're seeing in price, how much enthusiasm is there in the price moves that we're seeing on the chart. And that goes all the way back to Charles Dow, when he was talking about how volume could be used to confirm price action. So you want to look for volume. Is it healthy when we're seeing a breakout in price? Is there thin volume when price is doing something? Does that change the way you think about what's happening on the price chart? And then we can keep going. Let's add one more on here, Tyler. We might look at an indicator on the lower panel. So we might look at something like the MACD, which blends a little bit of trend following with a little bit of momentum concepts, in that it looks at the difference now between 2 moving averages, the exponential moving averages in this case, but it looks at the difference between them. So we get something that oscillates around 0. So we're looking at the difference between 2 moving averages. And again, bullish inherently bullish in understanding that the MACD, if it's above 0, means that prices in the short term, again, are moving higher than prices in the long term. So we might be looking now at MACD and saying, okay, where's MACD crossing its signal? Where does MACD become greater than 0 for the first time? Where do I get a new Donchian channel high? What's my moving average situation? Am I seeing any crosses, Bollinger Bands tightening, and then a breakout to the upside? What's volume looking at? And so somewhere in that circle there, we're getting all of those criteria being met. And so we're going to be fairly confident now at some point in here that we can recommend a long position. We're starting to identify a trend in the up direction. But we've reintroduced some subjectivity, obviously, because we have to make the decision where in that circle, how many of those criteria need to be hit for me to feel confident to make any kind of movement based on this price chart.
It's the entire first quarter of last year. And, spoiler alert, Alex and I were cherry picking for a security that has a very clearly defined trend, right? Apple is sort of the poster child in terms of a trend follower's delight. So even on perhaps the simplest security to trade, right? And even with a very responsible but simplified process, we're looking at 6 or 7 things. We still have 3 months of trading activity whereby all of our process is stacked up. Now imagine the kinds of charts that Tyler Jr. used to create before at GoNoGo, or perhaps all of you. You may have a more sophisticated approach. And this is not to denigrate any of the incredible studies that are out there, the men and women of Wall Street, many of them of the CMT Association who helped to create, innovate, and discover all of these tools. I mean, we're lucky to be alive at a time when we've got so much data and so many really powerful ways to look at it. But when you get a chart like this, there are 2 problems. One, you have indicator overload, as Alex was just saying. How do you make a decision in that first quarter of last year to get involved in the new trend that's emerging in Apple? Whether you're looking first for that Donchian channel break or waiting for that moving average crossover, it's somewhere in there. Now, imagine a choppier security or needing to make a decision even more quickly to take advantage of trends. Now you've got this indicator overload, and this analysis paralysis that takes over starts to reintroduce a lot of that emotional subjectivity. If you're like me, with enough squiggly lines on the chart, you can sort of convince yourself of holding on to a losing position or waiting to enter a trend. If you're particularly negative on the markets, even if all the weight is stacking up right in front of your eyes. We as human beings tend to drift towards confirmation bias. And so if we have an emotional opinion, We're going to collect the data that supports how we already feel about the marketplace. So we want to remove all that subjectivity, but we want to still retain all of the information from those powerful indicators. So when I was talking about the algos before, Alex and I have a trend model, and many fund managers out there do. What we're doing is taking that weight of the evidence, a lot more indicators than what we just went through in that simple process, but taking all of that and blending it in the background so that we have a weight of the evidence approach. And then taking the result of that trend analysis and painting it back onto the chart. So for those of you who are new to GoNoGo charts, just a quick review. We've got Go Trends, right? The name of the company is Go or No Go, like a pass-fail system. If you were NASA thinking about launching billions of dollars of hardware into space, you want the conditions to be optimal before you take that decision. So Go Trends, strong form of the trend model in blue bars, weaker form of a Go trend condition in these aqua bars. And then to the downside, we have no-go trends. So pink is the weak form, purple is the strong form. And here at these areas of transition, sometimes what the model is telling us is that the market has reached an area of neutral readings. All of those blended indicators in the background are giving us a go fish signal, meaning that the market is uncertain. There isn't enough evidence to one side or the other to indicate trend and the strength of that trend. We're big fans of the life and work of Jesse Livermore, who said that in all markets, there's a time to go long, a time to go short, and a time to just go fishing. Sometimes the signal of the market is that it's just moving sideways, it's range bound, choppy, or uncertain. So that is the very simple way that we think about using technical analysis to our advantage, but maintaining our focus on the most important indicator of all, which is price action. Alex, talk us through this next quote.
Yeah, one of our absolute favorites, and it's from Mark Abraham. What he says is, ultimately, it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down, and that consensus is revealed by analyzing price. So that's us as technical analysts, right? We look at price charts. We believe that everything that is fundamental about this company is reflected in the price, as well as the collective opinion of all market participants. That's the piece that fundamental analysis doesn't get, right? We can understand the fundamentals, but it's also the collective opinion that at the end of the day settles on a closing price, and then of course settles on whether or not that price may go up. So the consensus of collective opinion of all of the market participants is revealed by analyzing price. So that's why we want to be able to keep our attention focused on the price panel.
And I'll be back at 5 o'clock this evening to talk to everybody more in depth about, thinking about the quality of the company, what's on its balance sheet, how's the management team doing, thinking about the valuation of the company. And there's lots of different ratios and estimates that we could use to come up with an idea of intrinsic value for a corporation. And then, of course, there's the growth factor. Our returns on equity expanding? How about gross margins? And we can look at a lot of fundamental data sets. But as Mark Abraham tells us, perhaps we don't have access to all of that knowledge. If we're trading global equities, I don't know the first thing about semiconductor manufacturers. It's, for sure, I don't know about Taiwanese semiconductor manufacturers, but can I be a responsible investor and still participate in those trends? Absolutely, because all of that information is distilled into price. And we'll talk a little bit more about that this evening. But what's exciting about all of this work for Alex and I is just to get it out to the world. So we give the GoNoGo trend indicator away for free to all MetaStock users. It's right there in your platform. You can apply that template right after this talk, or maybe even have a couple of screens. You can try it out right now. And so that's available in MetaStock for everyone to use for free. All we would ask in return is let us know how it's working for you. What sort of timeframes are you trading? What securities are you trading? Has it changed the way you handle your trading discipline? And we're going to talk about that a little more in the second section of today's talk. But Alex, let's go through a couple more charts of Apple specifically using the GoNoGo trend based off of last week's closing prices.
Yeah, and this is the weekly chart. We work with people that are using all different periodicities. You might be trading 10-minute charts. We might be talking to a fund manager rebalancing quarterly. So it's important to understand And we'll talk more about multi-time frame analysis. But just to give you an example of how we would look at a chart like this is the weekly chart of Apple. And we can see as the price has rolled through its trends, what the GoNoGo trend indicator shows us. And that is that there are periods of weakness. If you look at the most recent period here, we can see that it came off the high and that we saw some weakness with the paler aqua bars. And then the trend resumed, stayed in the Go colors, and now we're back painting strong blue Go bars. You can also see that really sloppy, choppy 2022, most of 2022, was then highlighted by no-go and amber bars. So we were told by a GoNoGo chart here that the Go trend was over. We're now painting uncertain bars of uncertainty. We're painting no-go bars, we're painting pink and purple. So we're staying away from that if we're long investors until we see the trend clearly resume. And that, of course, happens just about the end of Q1 2023. And now we've been in a Go trend since. And we're looking to, possibly run up against all-time highs.
Absolutely. We work with a lot of institutional investors and registered investment advisors, and for them, these seductive relief rallies, right? They're fairly short-lived, but I use the word seductive because who wasn't hoping to resume 2021's bull market activity in the middle period of 2022, right? And this was, for a lot of investors, a time when they felt confident enough to get back into the trend. On this weekly time frame, we never re-entered the Go trend criteria. The model did not suggest there was enough evidence for Apple to take off to the upside. Of course, we're going to move past just weekly charts, but the idea of long-term investors, in whatever time frame you're in, to stay out of no-go areas and to simply take positions when the trend is in your favor. Now, Alex, we've been talking about weekly charts here. I'm sure for a lot of folks on the line, they're thinking, wow, this might not be for me. I'm a shorter term trader. Well, thanks to the original, the OG technical analyst here in the West, Charles H. Dow, over 130 years ago, this gentleman, without any computers, without any algos, understood market movements. And he used this analogy to the oceans. He was an accomplished nautical sailor. And he said that the primary trend, this longer period of any stock or the market index at large, is like the tides of the ocean. It is not changing based on the whims of investors or the news of the day. This is about expanding GDP. This is about the underlying fundamentals of the company continuing to expand. They have new products. They're a good company. That's what's going to drive our primary trend. And we can look at that over years and decades. But he also identified that just like the oceans, there's a secondary period. He compared this to the waves of the ocean, and that in our secondary trend, secondary time period, we could see prices move well below or well above that primary trend, the underlying drift of markets or a security. And then, of course, he identified the minor period or that tertiary trend being the ripples on the surface of the water. So if you're a short-term trader, if you're looking at intraday charts that could be very, very short-term, you can absolutely make money on those short periods. However, it's helpful to understand what the primary and secondary trends are telling you about that security. And we're not locking those periods into any one kind of periodicity on the chart. But for you, if your trading period is on a minute, 60-second chart, maybe looking out to an hourly and maybe a daily chart as your longer term period would let you know if you are trading against or with a longer term trend. So let's go through Apple on a couple other time frames just so we can understand how this might look. And Alex, I think what jumps off the screen on that weekly chart again of Apple is that anecdotally, when we see major breaks of trend lines, areas of support and resistance, that's often concurrent with changes in trend. And that classical technical analysis, being able to highlight areas of key support and resistance or trend line breaks, just adds to our conviction. It's very simple to do on a chart that isn't cluttered with a ton of indicators. So let's move down from that weekly basis. Talk to us about what's happening on the daily chart of Apple.
Yeah, so this is the daily chart from this morning, and you can see that we have really nicely emerged from that no-go trend just over a month ago now, and we've put in a new higher low. That's really nice to see, right? We saw that go trend take shape back in the beginning of November. We moved higher, and then we sort of saw a correction. We highlighted that weakness with some of those aqua bars there, but then we've returned to paint strong blue go bars again, and we're moved higher. So we now have a higher low and a higher high on the daily chart. So we're second higher high, actually, a second higher high and a higher low. So we're looking at now a new trend well and truly in place on the daily chart, and we'll look to see if we can get back and test those highs from a year or so ago. And then this is the 60-minute chart dropping down in time frame. I mean, think about how you might use technical analysis depending on what you're doing in the industry, whether you're in the professional space or not. But you might be a trader working for a PM. The PM may say, listen, weekly chart is a go, daily chart is a go. I want you to take a position in Apple for me, please. You might drop down into smaller time frames to look for sensible entry points, right? So if you're looking for a go trend on the 60-minute chart, because you know that your larger time frames are also both go trends, then you'd only be taking go trend opportunities on the smaller time frame chart. Now, of course, you might not be that long-term of an investor. You might be using, the daily chart as your large time frame, or even the 60-minute as your large time frame, and then dropping down to 15-minute charts and 5-minute charts. So the point remains is that technical analysis, being fractal, should work the same on any time frame. A good suite of tools or a good checklist should be able to be applied to any time frame and any asset class.
Absolutely. Speaking of other asset classes, I'm sure many of you don't strictly trade equities. You might be Forex traders. You might work in the futures markets and look at a lot of commodities. Regardless of whether or not you trade across asset classes, I encourage everyone to at least pull up the charts, because there is a ton of information when we're looking at interest rates or fluctuations in dollar strength or even the commodities markets. And it's the great John Murphy, a fellow CMT charter holder, who first sort of showed the world this idea of intermarket analysis. In the CMT program, you're going to learn a lot more from folks like Marcos Katsanos, who've helped to quantify what some of those correlations tell us about the influence between asset classes. But just for sake of argument, right? As technical analysts, we want a top-down perspective. Technical analysis gives us a lot of information, contextual information about the environment in which we're going to be trading. And so if we do a little bit of research ahead of our week's trading plan, that can set us up for understanding a little bit more about the macro environment and what potentially could be an influence, headwinds or tailwinds to the securities that we're trading. So this is just a simple 6-chart, multi-chart layout of securities, all just using the Go trend. Alex, why don't you take us around the round robin, and let's talk through what's happening in markets.
For sure. So we're looking at the top left here. This is the S&P using the ETF, of course, the SPY. We use ETFs a lot because we can get volume information. We'll talk about that later on. But the trend is a strong go, as we mentioned, on the S&P. We're seeing a return to those bright blue bars. So that's a good thing for the bulls out there. Strong go trend on the S&P. If we move across, Treasury bond prices, that is also in a go trend, but we're seeing the first weaker bar there. So a little bit of weakness after that new high in Treasury bond prices. Of course, bond prices move inverse to yields, of course, so just be aware of that. Crude oil on the top right, strong no-go trend. Oil was a bit choppy a couple of months ago, and it's really found its direction. Now we've seen a no-go trend, set a series of lower highs and lower lows, so strong no-go bars for US oil. If we move to the bottom left, that's Bitcoin, of course, and what a week it had last week. A strong bar today, though, which shows that we're now in a weak go on Bitcoin. But look at that move in Bitcoin, really being quite impressive over the last few months. We can see that trend clearly on the chart there on the bottom left. In the middle on the bottom, we've got gold. Gold, of course, people will talk about it all day long and talk about how it should be a flight to safety. Sometimes it is, sometimes it isn't. At the moment, we are in a go trend. The weight of the evidence tells us we are in a go trend, but we are painting weaker aqua go bars. So we're seeing, you can see there, the higher high, higher low, and then we'll see if we find support somewhere around here and put in another higher low. But a go trend still in place for gold. If anybody's interested, have a look at those super long-term charts of gold, right? Some really interesting things happening on 20-year charts of gold. We could talk about that at another time. On the bottom right, we've got the dollar, or the ETF that represents the dollar, the UUP. The dollar, of course, had a really nice strong move for 3 months or so and then rolled over into a no-go trend. It's rallied over the last couple of weeks. We see that weakness in the downtrend portrayed by the pink bars. It's come out of those purple bars, painting pink bars now as it comes up against resistance from what used to be support at the end of that go trend. So you can see there, important moment for the dollar as it we'll see whether or not it maintains that no-go trend or not.
Absolutely. This all-important concept of polarity in technical analysis, what has been support can become resistance or vice versa. And so being able to do a little bit of classical technical analysis on your chart, at least for Alex and I, has been really important. And this chart of gold right there at what could be a support level. And if not, if broken through, that's a serious signal to us to the downside. Now, we talked about data visualization just briefly, right? Blending lots of tools to give ourselves more information with less clutter. And just to illustrate that point, one of the things we do for our institutional clients is an array of different heat maps. These are the absolute trends of those same 6 markets that we just looked at, but we're removing the price action. Just so you can start to see sort of that rollover when we were in 2022's bear market in US equities, transitioning from pink and purple trend conditions through neutral back into the go trend in 2023. Bond prices have continued to move lower in no-go trend territory. And then, of course, we can move down that list. But it's just another way to visualize even more information at a glance, and certainly helpful if you are doing some top-down analysis. If that all sounds interesting to you, but trading, it takes up enough of your time. If you're interested, we do offer subscription research from GoNoGo Charts. That's actually where this company started, was sharing with some fundamental managers how they might look at trends and to help their positioning and technical asset allocation. So twice a week, every Monday morning, narrative format, top-down approach across the asset classes into the sector groups and down to the individual security level. And then every Saturday morning, we like to practice what we preach. Launch Conditions goes out, and it's a chart pack, which is probably a historical reference that some of the youngsters won't recognize. Back in the day, you used to actually get packs of charts all printed out for you and do a little weekend review. Longer time frames, global indices, cross asset, just to get a sense of the context in which we're going to be trading. So you can check out more of that at GoNoGoCharts.com if you're interested. But Alex, let's shift gears here. We're past the 50-yard line. Let's talk a little bit about the second half of today and what we're trying to do as traders.
Yeah. So we know this. If we're going to be honest with ourselves, we know we shouldn't be anticipating any kind of movement in price. We know we shouldn't be trying to say we know what's going to happen. We certainly shouldn't be doing that. What we want to do is participate in trends that we have identified. That's the whole first part of this presentation, was how to do that sort of trend identification. But again, we want to do it in a way that removes any kind of confusion. We don't want the uncertainty that comes with trying to read panel after panel after panel and indicator after indicator. And if we can do that by using a disciplined checklist, but in a way that's easy to understand, we can stay objective, we can stick to that rules, and then we can hopefully act responsibly and without any of the emotional problems that we know are pitfalls for so many investors.
So get excited. This is the audience participation section of today's presentation. Feel free to shout these answers out at home. You can type them into the chat. We'd love to hear from all of you. But to help illustrate this point, right? So we've got our analysis. We're studying our charts. We're identifying trends. How about the trade management, the life cycle of the trade? And let's talk a little bit about how challenging this really is. It's very simple to say, it's very difficult to execute in real time. And to help us with this point, we're leaning on some research written by Professor Terence Odian. He's a Berkeley Haas School of Business professor. He and his fellow researchers looked at 360,000 trading accounts over a 15-year period. It's a lot of data to crunch through. I think in the research world, they call that statistically significant data sets. And the question in front of us is simply, what percentage of those traders do you think lost money over a 15-year period? right? This research was published in 2011. We saw multiple market cycles changing from bullish to bearish and back to bullish. And the question is, what percentage lost money? Do you think it was about a third? A. B, 54%, C, 68%, D, over 75%, or E, 87% of those 360,000 day traders. I'll give you just a second. You can throw it in the chat or the question section, shout it out at home, scare your dog, whatever you need. Here's the answer. E, 87% of these traders were unable to be consistently profitable over 15 years. That means that only 1 in every 360 people, or less than a third of 1%, were consistently profitable. Now there's a follow-up question. And here we're leaning on the same research team led by Terence Odian. And instead of thinking about their overall accounts over 15 years, they went from the macro to the micro. Now they looked at 43 million individual trades from an FX broker. They grabbed some 15 different currency pairs, and they looked at the individual trades to try to discover whether there was some directional validity or errors. And now my question is, what percentage of these trades were profitable? A, 13%, B, 18%, C, 27%, or D, 39%, or finally E, over 50% of the trades were profitable. Now we just said 360,000 people failed to make money consistently year after year over those 15 years. So take a second, throw it in the chat. And the answer is E, surprisingly, over 50% of those trades were directionally correct, right? So this is what that data looks like. The average retail trader has a win-loss ratio greater than 50%. So why on earth would so many lose money, right? We spend most of our time trying to get our trades right. And in fact, most of us can even be successful in picking a directional bet with our trades. The answer for the money loss comes from the profit ratio. So they are holding on to losers far longer than they are holding on to winners. Their average loss per trade far outweighs the average profitable trade. So that edge is there on the analytics side, but the discipline for money management is missing. Okay, like we said, simple to articulate, very difficult to execute. Now to help us illustrate that point, right? Our expectancy formula, this is the efficient frontier. This is where any trading system is going to break even. It's just the combination of the percentage of winning trades multiplied by the profit ratio, okay? We could talk all afternoon about topics in behavioral economics, about the heuristics that all human beings are subjected to. We could talk about the works of Amos Tversky and Daniel Kahneman, the 2002 Nobel Prize winner in economics, really brilliant, not an economist, but a brilliant behavioral psychologist. And they helped us identify this prospect theory. The fact that we experience a whole lot more suffering from a loss than we experience joy from the gain. And when we translate that to our trading accounts, we're going to quickly lock in a 10%, 15% move. Great, celebrate that win, but we're not going to hold it through the full length of the trend. We want to make sure that we lock in our profits. And when something starts to trade against us, right? Well, now it's not a trade. Now it's an investment. I have such conviction this turnaround story is coming back. I'm definitely going to get back to break even. And you might sit there holding this as it moves 10% against you, 20% against you, 50% against you. We've had multiple once in a lifetime market disruptions in the last 20 years. So the risk is there. That part is certain. But let's just pick on one dot on this chart for a second. This is a 50-50 scenario. So imagine your whole analytical discipline. You don't even look at charts. You just flip a coin. Buy the security or don't buy the security. You can still have a profitable trading system with absolutely no knowledge of what you are purchasing, so long as you let those winners run and you cut those losers short, right? That's a 2-to-1 profit ratio from that trading system. And some of the greatest trend followers in the world, and I'm talking about David Harding from Winton Capital, or Jerry Parker, one of the original turtle traders who runs Chesapeake, they're really comfortable over here, meaning 30 to 35% of their trades are exceptional winners, and they're fine. They're comfortable being wrong a lot of the time. They're widely diversified. They take a lot of small bets, but they have really great trading discipline, really great money management. So the next part of today's talk is about how you can use GoNoGo charts, the complete set of tools to help you with that money management side, right? The analytics are super important. We want to participate in trends. But if you can also add volume, volatility, and momentum to your understanding, you can help manage those positions. So Alex, I'm going to turn it back to you. And why don't you talk a little bit about the complete chart and what that looks like in MetaStock?
Yeah, because when we are talking to anybody in the industry, we need to give a complete understanding of technical analysis for whatever it is they might be looking at. And that, as you rightly said, includes momentum, volume, volatility. So we know about GoNoGo trend. We've talked about that. We're going to talk a little bit about the GoNoGo oscillator, which gives a complete understanding of momentum, but does it all in one panel with the same approach of blending some of these robust momentum concepts together. We're going to also talk about some data visualization cues we have that help us understand what we're looking at. Those are the GoNoGo icons. And then, of course, we're going to also talk about volatility and how we look for reduced periods of volatility that can lead to significant moves with the GoNoGo squeeze.
All right, so let's talk a little bit about leading indicators versus lagging indicators.
Yeah, so this is when we would go into momentum, right? After we've established trend, anybody looking at charts or a technician will want to get a sense of how volatile or how strong the price movement is. And that's what these oscillators will give you. They'll give you a sense of price velocity, how fast something is moving in any one direction, right? And we can look at extreme areas of overbought and oversold. We can look at when a price has moved maybe too far in one direction and come back. We can also understand how we can take a look at using oscillators when in trend. That's been a big area of research over the last several decades.
Absolutely. So instead of diving deep into all of the different momentum oscillators that we could be using, let's take for granted the idea that we're blending multiple indicators into a single price panel. The GoNoGo oscillator is going to be a range bound. So unlike rate of change and some of the other oscillator tools that you might use that are unbounded, we're just moving from -6 to +6. And we can use that in the exact traditional way that we would use other momentum oscillators, looking for areas of overbought and oversold readings. So extremes in price move that might lead to exhaustion points in a trend. But what's really powerful about the GoNoGo oscillator is the idea of an objective zero line. So positive momentum, negative momentum, and we're going to talk in just a second about how we use that in the context of trend. What we've done with the implementation in MetaStock is to also incorporate volume, where you've got this ribbon at the bottom. We know that heavy relative volume is really important when we're starting to digest whether the market is participating in a move. And we can see that just where this dark shaded blue area shows up on the ribbon. That's where we have heavy relative volume against the look back period. Now, Alex mentioned areas of divergence or confirmation, right? We can see at the end of this trend, price continues to make higher highs, but our GoNoGo oscillator is making lower highs. And the way that I was taught about momentum is that you throw a baseball in the air, it's going to be moving fastest when it leaves your glove. It's going to reach the apex, as high as you can throw it, and it's going to continue to climb as it gets to that high point, but it's going to be moving higher more slowly, not as fast as when you first threw it. So when we're looking at any momentum oscillator, we're looking at those areas of exhaustion. That's the concept of divergence. So a bearish divergence here, as price makes these ultimate highs, the oscillator is making lower highs. Alex, anything else that we want to add here on the GoNoGo oscillator?
No, I think just the most important point is coming on the next slide. So
fantastic. Why don't you take this one?
Yeah, so what we know about the oscillators that we've looked at is that they range from, let's say, a bounded oscillator might go from 0 to 100. If you think about something like the RSI, right? We know that an overbought RSI level is over 70. That's what we've been told. We know that an oversold is under 30. But what happens when a security is trending strongly? It's not going to swing from overbought to oversold. What we tend to find happening is that it rallies up into overbought territory, and then it comes back into neutral, so that we wouldn't expect an RSI to be oversold if a trend in price is very, very strong. What we find is that those oscillators range between neutral and overbought, but they're very choppy. Sometimes we don't know where to set those ranges. Sometimes we have a hard time with being sort of honest enough with ourselves. Like if we get down to a level that should be support, but it breaks a little bit, is that okay? Because we don't have those clearly defined ability levels that we can use for trading ranges. What we did when we designed the GoNoGo oscillator was calculated in a way that when all of the blended inputs are in their respective neutral territories, the GoNoGo oscillator will fall to the zero line or rise to the zero line if it was negative. So what happens then is when a trend is strong, we get an objective level that we can use as support or resistance. So if you look at this chart here, we're in a strong trend, a strong go trend, and every time that we see the oscillator come back to the zero line, we can look for support. And if it finds it, we will say that the trend is likely to continue because momentum is resurgent in the direction of the underlying trend. So we want to really pay attention to that zero line. It allows you to stay with the trend.
So going back to now at each one of these pullbacks, nobody knows what's going to happen on the right side of this chart, right? If we only saw up to here, we're pulling back, price is correcting against the trend, and we see our oscillator coming down to the zero line. So that's our moment of decision, right? We're sticking with that trade so long as our momentum oscillator finds support at zero and heads back up into that positive direction. And we're going to talk a little bit about the data visualizations on the chart in just a second. But imagine you're a money manager, you want to trade around your positions, right? So you might start a position with a fairly small position size, and then as you see repeated support at the zero line for the momentum oscillator, you could scale up. They call that pyramiding. You could add to your position size. You could get really outsized positioning and maximize gains to those trends that are working for you in your account. But simultaneously, you have a clear area of risk management, and you have a clear signal when that GoNoGo oscillator breaks below zero. That's the enthusiastic selling that is certainly a threat to any trend. So Alex, let's talk about what this scenario looks like with the GoNoGo icons.
So what we want to do next is draw our eye back to the price chart, right? So we can keep our mind and our attention focused on price. So what we want to do is use data visualization. Oh, I said that a bit too fast. Data visualization to highlight important areas on the chart. The first kind that we're going to talk about are trend continuation icons, and those are the circles. So if a trend is in place and the oscillator finds support at zero, like we just talked about in that previous example, we're able to say that momentum is staying in the direction of the underlying trend. So we're going to put that on the chart in those circles, telling us that we're seeing trend continuation. The second type of icon are counter trend correction icons. And so that's more using the oscillator in a traditional sense of understanding momentum. If our oscillator goes to 5 or above, right, that for us is overbought, and then comes back below that level, we're going to highlight that on a chart with a counter trend correction arrow. When that tells us that price might have been overextended in the short term, and it might come back a little bit. Now, remember, that's not necessarily a trend reversal. They're counter trend corrections. That goes back to your discussion of those seductive relief rallies back in a couple of years ago, right? The trend may not have changed, but we may struggle to go higher in the short term. And then, of course, we then look to the oscillator again to see if it finds support at the zero line, and then we'll flag the trend continuation icon.
And a quick little note on the placement, right? These icons are showing up as momentum has left the zero line. That's what identifies to us, articulates that there was support at zero. So we don't immediately buy more as the oscillator reaches the zero line. We wait for that bounce. Same thing with the counter trend correction arrows. We don't see a level of overbought and immediately think of exhaustion. It's when momentum cools from an overbought or rises from an oversold that we see those counter trend corrections. So quick note to those of you at home, just because something gets overbought doesn't mean it can't stay overbought. And I think Price Headley was mentioning that before. Now, Alex, let's talk about the final piece of the puzzle, volatility squeezes.
Yep. So we know that after periods of reduced volatility can come periods of increased volatility. So don't be afraid of volatility. A lot of people I talk to say, oh, it's so crazy right now, there's too much volatility. But if you can find areas of reduced volatility, then you can enjoy the sort of oncoming increased volatility, because it probably will lead to some sort of significant move. So the way we do it, we can read up on Bollinger Band squeezes, Keltner Band squeezes, but the way we do it is we know how important the zero line is. We just talked about that. We know that when in a trend, the zero line should hold as support or resistance. Given that, we look for situations where the oscillator gets stuck at the zero line. That means there's been very little directional pull, very little overbought readings, no oversold readings. All of our inputs are in the neutral territory, and they've remained there for some time. It's like that tug of war between buyers and sellers, and we aren't winning. Nobody's winning. And so while we are seeing that situation, we then have an indicator called the GoNoGo squeeze that creates a grid that climbs for every bar that the oscillator stays at zero. So what we're looking at then is an extended period of reduced volatility. And when that squeeze grid is then broken significantly in one direction, then we can say we've got a break out of a squeeze. And so in this case, it's a continuation. We've been in a go trend, we've moved sideways. You can see how reduced price activity is, how small those bars have become as we consolidate sideways. And then we get the squeeze broken to the upside, which is in the direction of the trend. We get trend continuation, that icon right there. And then we get a nice significant move in that upward direction.
Now, the GoNoGo squeeze can happen at points of trend continuation, the example we're looking at right now, or we can see volatility squeezes build up at points of trend reversal. The most important part of volatility compression is understanding the direction of the break. And oftentimes momentum leads price. And so if we were to break down from here, that's the topping pattern, right? Had this been a no-go trend and we were in no-goes all the way along, building a squeeze, the momentum oscillator would have been in negative, risen to the zero line, and been stuck at zero from below. Then a break above zero would be a trend reversal. So we can use these in two different contexts to our advantage. But now, Alex, we've talked about a lot of concepts in technical analysis. We've talked about volume, volatility. We've talked about trend and momentum. Let's tie this all together here in the last few minutes of today's webinar and just isolate it to those three simple questions. I'm a simple guy. I often can't remember anything after the third bullet point on a list.
Yeah, I stick to three or less. You're better off that way. But in all seriousness, if you can answer these questions, if you can understand what's happening with the trend, what's happening with the oscillator, and if there's anything interesting happening around the zero line, then you can have a complete understanding of the technical analysis of any chart. So let's do one, and then we'll get into some of the really cool features of the implementation with MetaStock. But this is that Apple chart, and let's walk through it now using the complete set of tools. Again, nobody can hear anybody, so if you want to just jump in and sort of answer these questions as we go along, we're going to go through it in those three steps. What's the trend for Apple right now? Well, we know we're in a go trend, so there's no confusion. We're in a go trend. The bars are bright blue, so that tells us it's strong. Where's the oscillator? The oscillator is at a value of 2, so we know that there's positive momentum. Now, the third question is there anything interesting happening around the zero line? Well, not currently, but we can say that we recently found support at the zero line, and we know that that's a very, very healthy thing in a trend. So we're in a go trend, the bars are bright blue, oscillators in positive territory, we recently found support at the zero line. That's your technical analysis on Apple. How about volume? Volume is not particularly heavy right now. You can see that there is no blue on the ribbon there. So there's your technical analysis on Apple. And if we move...
Well, and just before we move on from there, we have the counter trend correction icon appearing above price. And so if you haven't owned Apple in November and December, and this is not a securities recommendation, for illustrative purposes, if we're looking at this chart, do you buy in to a go trend at a point where it's just reached an overbought level in momentum? Well, the counter trend correction arrow tells us the price may struggle to move higher in the short term, and that if we came down to test the zero line, there's an optimal point for trend re-entry or entry point into that trend. So I think I hear a lot of traders who, somewhere after this second week of rally, they think, missed the move, it's already over, right? Well, consider that, first 2 weeks of a trend back here, there was still plenty to participate in. So a logical entry point might be looking for the retest. And again, that's going to be, to your own risk tolerance, to your objectives, your time frame, and your trading style. So Alex, moving back to the presentation, let's talk about the implementation in MetaStock.
Yeah, so MetaStock has a couple of great tools that we can use to just help make everything easier. One is the expert commentary. I love this, and it's really like having you there with me or me there with you, and we can discuss these charts and say, what is it saying at the moment? And what we do is with the expert commentary is just give an interpretation from a GoNoGo perspective. So those 3 questions that we were just talking about, that's all going to be right there at the top. You hover over any bar, you open up the commentary, and you'll get us walking through those things. What's the trend? Where's the oscillator? Are there any icons on the current bar? And what's happening with the squeeze? And then underneath, we explain the concepts and the tools and all the rest of it. But it's just like having that quick understanding from what the GoNoGo charts are trying to tell us. And then the next thing, of course, is the explorations. I know Jeff loves screening. He talks about it a lot. And so do we. I mean, it just is the biggest time saver. So we can go through on MetaStock and we can just say, find me all the securities that are showing a new go bar today, right? Or show me securities that are in a squeeze. They're in a max GoNoGo squeeze. Show me any securities that have an icon on the current bar. So when you do this, you can really, really whittle down your time and get it to where you need to go very, very quickly. So those are a couple of fantastic features of the implementation with MetaStock.
Now, I know we have a few other examples in here, but we have also run out of time. Jeff, if you'd like us to keep going for a couple of minutes, we can. Otherwise, happy to turn it over to you to talk a little bit about how folks can take advantage.
We did start you a little bit late, so if you can wrap up within a couple of minutes, that's great.
Perfect. We'll just go through 2 more examples. Remember those 3 questions. Where is the trend? Where is the oscillator? Is there anything important happening at the zero line? MTZ, Mastic Incorporated, coming out of a very long drawdown and re-entering a go trend. So as we saw, momentum leads price. We saw the negativity, the selling enthusiasm, repeatedly retesting the zero line, being rejected below, trend continuation icons. And here we come up, we build the squeeze. As I was saying, it can also be at points of trend reversal. Now we break to the upside. That positive momentum precedes the color change in our trend model. Now we're in a go trend. We've got strong blue bars. The oscillator is at 4, and we are now on light volume. So that's MTZ for you. Alex, why don't you talk to us about IESC?
Yeah, and these are coming out of some relative strength that we're seeing in industrials and the heavy construction index. So when you tie it all together and now you're looking for opportunities in places that make sense. Here's another one. What I like about this is that it's very, very easy to see the break of prior high resistance, right? So if we're keeping this price panel large, look at how we screen through that resistance. So this came across my desk a couple of days ago. We've got strong blue bars. We've recently found support close to the zero line on the oscillator. Volume is heavy. We're seeing market participation. We're seeing enthusiasm. But I love to see this from the 20th. When we entered that go trend, volume picked up right away. That's that confirmation that we're talking about. And of course, we broke above the zero line several bars ahead of that, as you said, momentum being a leading indicator. But now we are at new highs. We closed at the top of the bar yesterday, so that's a great sign. And we're in a go trend with momentum on our side for IESC.
Absolutely. Last one here. CHGG is the ticker symbol. Shout it out at home. We're in a strong go trend. We've got an oscillator at 3, positive territory. We had broken to positive territory on the momentum oscillator. Trend changed to go colors. First weak form, now strong. We came back to test the zero line, and we had that tug of war that Alex was talking about. The no clear momentum direction. Buyers and sellers really in a tug of war as the price range began to narrow. We broke back positive. See that trend continuation icon, and we're back off in strong Go trend colors.
And one of the things that's fantastic about this chart was, number one, it shows what you were talking about a couple of slides ago, where maybe you missed that initial pop of that when it went to that Go trend and it did all of that work in one bar. Well, this is almost a way of automating that buy the dip kind of idea, right? You're looking at a bull flag, you're looking at a triangle. You can put a couple of lines on this and you can certainly see some sort of pattern. And as you're watching that pattern develop, you look to the oscillator to see it ride the zero line, and you think, do I get in? Should I have I missed it? You know, what situation am I looking at here? And then as soon as we break that squeeze, we know, okay, momentum is resurging in the direction of this move. So this is a relatively low risk opportunity, sort of buying that first dip after a new trend has been identified.
Absolutely. Very well said. Alex, it's so great to talk markets with you. Jeff, Kelly, MetaStock team, thank you so much for having us back on today's summit. And for all of you in the audience, congratulations on taking an investment of an hour to think about your trading discipline and your process. If our tools can be of help to you, by all means, we're hoping that you'll reach out to us, info@GoNoGoCharts.com. But the MetaStock implementation is just incredible. So make sure to take advantage of that. And Jeff, thank you. We'll be seeing you in the new year.
All right. One quick question, if you don't mind, Tyler.
Yeah, please.
B has asked a couple times. He wants to know if he can use this with intraday charts.
100%. When we were talking about the multiple time frames of technical analysis a little earlier on in the session, we talked about how the tool, and really any technical analysis tool, work the exact same way on any periodicity. So the trend model that we're using on a weekly or monthly candle is the exact same trend model we're using on an hourly or 1 minute or 5 minute candle. So you can use these on any time frame that you're trading. In fact, we do have a lot of clients who are trading extremely short term. They might just be scalping, but understanding trend is a core concept no matter what your trading objective is. If you're a position trader or a swing trader, or you're a long-term investment manager just thinking about asset allocation, these tools have something for just about everybody.
Petrus says, thank you guys. That was valuable. So thank you, Petrus. Glad you enjoyed it. All right, very cool. Thanks, guys. I appreciate it.
Thank you, Jeff. We'll talk to you soon.
Have a good holiday. We'll talk
you
soon.
as well. Bye-bye.
All right, cool. Go ahead and do this. Go ahead and show my screen. And go ahead and do that. Cool. And one of the things, as Alex was saying, I love scanning. I absolutely love scanning. We just released a couple of new scans with it as well. And so let me talk a little bit about kind of how to get this and what the offer is. Thank you very much for the interest there. They did a really good job of talking about the trend, the oscillator, the icons, the squeeze, how that all fits together. The scanning, the expert advisor, the commentary. There's not a lot for me to actually cover to kind of reiterate, which is good because we're actually out of time too. So we did add just a whole bunch of scans that are available as part of this. And basically what we're doing as part of the offer today, B, thanks for your interest too, by the way. If it's $149 as a monthly subscription. If you buy a month, we'll give you a second and a third month for free. So as part of that, you'll get some bootcamp training that we put together for it. If you need a trial to MetaStock, you can get a trial to MetaStock as part of it. And there isn't actually, I'm going to go ahead and kind of take that off. There isn't actually a 30-day money-back guarantee on this, but there's no commitment. So if you pay for it, you'll get it for basically $50 a month for your first 3 months. If it's something that you don't like and you don't want to keep, there's no ongoing commitment for that. So you can do that. Give us a call, 800-882-3040. You can go to metastock.com/sales-chat as well. And it is part of our Trader Summit Action Package. So as part of the package that we'll give you today, you can get Events Vora's Victory Add-on, GoNoGo Complete, Oscar Carboni's Trend Lines and Technical Training Package, Jake Bernstein's Setup and Timing Triggers, as well as 3 months of Price Headley's Big Trend Toolkit. So I was just looking at the schedule today and kind of the layout and how many people we have, and everybody, we have such a great array of speakers and add-ons today. So normally if you purchase that, it would be $3,985. Here at the event today, it's going to be $1,692. You can do that by going to metastock.com/summit deal. you can give us a call, 800-882-3040, or you can go to metastock.com/saleschat. So there you go. A couple of different ways to get a hold of us. Let us know what kind of questions you have. And let's, before we move on, I want to say thanks to Stocks and Commodities Magazine. They've been an ongoing, all-time sponsor of the summit. They've been sponsoring the events that we've been doing for over a decade now. I think we're going to start year 12, if I'm not mistaken, just in in a month here. So they've been sponsors. They've been a supportive of the event. If you're watching us on YouTube, go to metastock.com/traders-summit. Register for the event, and as part of that, you can also opt to get a free issue of Stocks and Commodities. So 17,000 trade articles, 1.3 million subscribers, publishing since 1982. Great magazine. Get signed up for it. And there you go. Of course, we're MetaStock. We'll talk a little bit more about this. Let's get to our next speaker. We're running a little bit behind. Not unusual, not uncommon, but our next speaker is great. His name's Oscar Carboni. You can actually join him almost any day the markets open. You can live with him at livewithoscar.com. I actually think it's livewithoscar.com, but they're both correct. He's a great technician. He does a lot of work with trend lines and technical analysis. So Oscar, let's go ahead and get you live. How are you doing today? I can see you. How you doing? I can't hear you yet, though.
Yeah, very good, Jeff. Thank you so much for having me.
Cool. I'm going to make you the presenter. I know we're a little bit late. I don't want you really too worried about time. You can go a little bit late if you want to. Don't worry.
Well, all right.
Cool. I have you. I can see your notepad. I can see your face. I can hear you. I'm going to get out of the way. It's your turn.
Well, very good. Well, then let me start with good morning, good afternoon, good evening, traders. Let's get something going here. MetaStock, thank you so much for having me. The great presenters before me and the ones you will see after me, I hope will help you in many ways. What I'm going to do with you is something slightly different. I've got no beautiful presentation to show you. I'm not going to show you a PowerPoint. What I'm going to do is just explain where markets are, where they're going, why they're going there. I'm going to offer you some tips that you can use to make money going forward. So grab a pen and a notepad or a digital one. You might want to write some notes. And then, of course, I'll show you how to access my Omni trading. But this is about where the markets are going, why they're going there, and simplicity. This is a very complicated industry. It's a very complicated business. And if you are going to pull a complicated system into a complicated business, you are complicating things, my friends. You've got to get simple. Now, I started in 1982 as complicated as a guy could get out of college, right? Into computers, complicating it all. It doesn't get good until you get simple. So what I'll do is I'll show you some simple techniques that will help you right from this webinar moving forward that you can implement. You don't have to buy anything from me. You don't have to even know a system. You will love some of these techniques because they're simple to use. So let's get moving. The Omni is Oscar's Market Navigational Indicator, OMNI. I'm not actually going to present the Omni for you right now. I'm going to show you a bunch of great charts and how you can use them simply without even knowing the Omni. And if you want to find out what the Omni is and how to get to it, we'll talk about that later on. So let's get moving. Take this little ride with me, kids. I think you're going to love it. Where are markets going? Well, there are a lot of people out there that have opinions on where markets are going. And here's what I will tell you about opinions. You shouldn't have them because everything that happens, every government report coming out, every report that's already been released, everything that a company is going to report, third quarter releases, whether they won or lost or a CEO was cooking the books, traders' reaction to all of that information. You know what all of that is? Right there in front of your eyes on a chart. Now, if you can read that chart, you've read every bit of information that happens in that market. You do not need the news. You do not need your friends on the telephone. You don't need anything but the chart and a good read to basically know what's coming next. And that's what I'm about to show you. You are looking at 30-year bond chart. The 30-year bonds went all the way down to 107.12, yanking up interest rates to 5.5%, almost 6%. Since that day, we have rallied all the way to 120.75. You know what that means? Interest rates are going down. When Bonds go up. See this little teeter-totter or seesaw, if you will, if you're at the playground? 30-year bonds going up, the chart going up means interest rates are dropping. So we've got a situation right now where interest rates are dropping, right? Okay. What else do we have? We've got another wonderful situation. Crude oil is dropping. Crude oil was at 95 just a couple of months ago. It's all the way down to it went down to 68.87. Look at this downtrend. You've got bonds going up, meaning interest rates are dropping. You've got crude going down. You know what that is? It's an instant stimulus to everybody on this planet. I don't care if you own an EV car and have solar on your roof. Energy is affecting you in 1,000 ways, whether you're using it or not, especially crude oil. If crude is dropping, every company on this planet, every individual on this planet that uses anything gets an immediate stimulus right in their pocket when crude drops. Now, you can do things, the government can do things to help put money in your pocket. It takes forever to finally trickle to an individual if it ever gets there. But when you drop the price of crude, it's immediate, instant. Now, you've got interest rates dropping. You've got crude oil dropping. What does that do to the markets? That does this. It makes the market go higher. Deflation propels the stock market. There is zero question where this market is going. The chart tells you where it's going. The analysis tells you where it's going. And if you want to look at the fundamentals, bonds going up, dropping interest rates, crude going down, lowering the price of crude, forces markets higher. It's absolute. Just like if you're in bonds and the bonds going up, interest rates are dropping, whether Jerome Powell says a single word, does not matter. Interest rates will drop if bonds go up without government help. So if interest rates are dropping, crude oil is dropping, you better believe that propels the stock market. That is called deflation. So you had a Dow looking at what everyone thought was a double top, top one, top two, it did work, dropped down. We've gotten above that double top. There's not a next one for a few thousand points, don't worry about it. So we got above that double top in the Dow. Does that mean the S&P, NASDAQ, Russell will go too? Let's go find out. So the Dow made it above its double top, and if you ask me, it's built a pennant flag up there. And it will rally out of that pennant flag and stay inside this channel and keep moving, because we've got fundamentals propelling it and technicals telling us where it's going to go. The technicals are the most important because the fundamentals are already in these charts. So you've got the Dow moving up while you've got crude going down and T-bonds moving up, which means rates are going down. It makes perfect sense. Watch what happens next. So if we got above this double top, right, if I extend this line, you'll see that we're above that double top. Let's go to the next chart. That would mean we got to worry about the E-mini S&P getting above this double top, right? But the Dow is the leader. The S&P is not the leader here. The Dow is the leader. And the Dow already got above its double top. So I am telling you now the S&P will get above its double top because it's a follow-up. But check this out. Look at this 18-bar moving average, or algorithm, if you will. Now, an average is actually an algorithm, just very simple, but it's a Wall Street algorithm. People didn't know they were called algorithms 20 years ago, but an average is a form of an algorithm. The 18-bar simple moving average becomes in vogue right here on 526. The market runs up, bounces off the 18, stops at the 18, so the 18's in vogue. That's that. We know the 18's in vogue. Wall Street is using it. Wonderful. So will we. If you want to time your E-mini S&P, write this down. Just use the 18-bar simple moving average. It works like a charm right now in the S&P. Now, this will morph into a different algo and a different average as the markets move. But this moment, top day, this week, use that 18-bar simple moving average, SMA. That will help you time E-mini S&P. Now, will it get past the double top? Yes, because the Dow did. Let's look at another chart. Now, here's the SPY. We looked at the Dow, the S&P futures, the SPY now, the index, the ETF, if you will. It had a double top, but it had a double top reaction already. Look, it hit and reacted. Now, we're in a big bull market right now, so the reaction should be muted just like it was. S&P, the spider, SPY has already reacted to the double top and has started to work its way back and will go through that double top. Why? Because the Dow did. The S&P is. It's a lock. It will. So don't worry about whether or not it's going to. It's going. This proves it to you. So S&P will go higher, especially if you continue to see crude going down, interest rates dropping, the bonds going up. But analysts are good at what they do as well. And the analysis on these charts has been pointing up for months on end. And I've been doing webinars for MetaStock every 2 or 3 months and just pointing out more upside is coming our way. Don't listen to anyone. Listen to the charts. They will tell you what will happen. So we are moving higher. The charts are absolutely showing us that this market will go higher. Nothing goes straight up, but these markets are going higher. Let's look at the next example. The NASDAQ. Look at how the NASDAQ adapted itself to the 22-bar moving average algorithm almost perfectly. It almost never fails at it. And that is what I want you to use right now to time your NASDAQ trades. Go with the 22-bar algorithm or simple moving average. That will help you time your NASDAQ trades. And NASDAQ, if you ask me, is about to break out of this little flag thing higher. But Wall Street knows they bought this average here. They bought it again the next day. They bought it the next day, and they bought it the next day, and they will buy it every time it hits until it stops working. And what I like to do is find out what Wall Street's using and jump right onto it. I don't want to argue with it. I don't want to reinvent the wheel. The wheel's been invented. I just want to throw it on my car and make my car go very fast. So I'm not going to argue with what Wall Street's using, and I'm not going to say, oh, it's just a simple 22-bar. Why would they use that? Doesn't matter to me why. They do. Look at it. Now, it will morph to something different, but for now, every time you get near this average, you get to react. Write that down. That is something that I think you should have in your notes. If that changes, you can come see me at livewithoscar.com, and I'll tell you what algorithm they're attached to now. If it morphs out of this one, I do this every day of my life, sitting in a live trading room. In fact, I'm actually sitting in that live trading room right now. Well, it's me waving to you. There's usually a camera pointed right at me, but I'm using it for the webinar. I'm always here. You guys can just come hang out with me. We'll go over these charts and see what's going where. But these tips are just fantastic. Write them down. Listen, I started at 18 years old, 1982, grew up on the trading floor. I live this. I breathe this. I am this. I am better at this analysis than anyone you'll ever meet. If you just listen to what I'm showing you and follow this, you will really find that simple analysis works quite well. Now, I can say that the analysis I'm showing you is simplified on purpose. My Omni, the Oscar's Market Navigational Indicator, is certainly more complicated than this when it comes to coming up to the buy and sell levels. The chart doesn't look this pretty, right? There's more work on it. So this is sort of what I'm showing you as my analysis 101 as I'm laying on my cot in kindergarten drinking warm milk and cookies. You know what I mean? I'm showing you that, but it's powerful and it'll help you, I promise. I could get much more complicated, but I don't want to confuse anyone. Simplicity works. 22-bar moving average on NASDAQ. Use it, it'll help. Let's move on. What else do we have? Oh, yeah, now look at this. The Dow Jones Transportation Average is joining the race. It's joining the race. So anyway, let me slow down. It's joining the race. It's simple stuff, right? It was in a bearish channel, red, got under the 200-bar moving average, started to create bullish upward momentum. So the channel, I made it green, make it simple. Now it's moving up. Well, look at this bull flag. Anyone can see it. Breaks out of the bull flag. It's above the 200-bar moving average. Bottom of the channel, simple stuff. Gets above the 200-bar moving average and creates another bull flag. The last bull flag created this move. The next bull flag should do the same. Repetitive patterns, they work constantly. You'll get 8 out of 10 repetitive patterns to repeat. Not all 10, but if you follow repetitive patterns as often as you see them, you'll get 8 out of 10 of a bull flag. You'll catch that right. So transportation average is joining the race. If you look at the channel it was in, obviously it wasn't a bear market. It is no longer a bear market. Why? Interest rates were going up. Crude was going up. Now interest rates are going down. Crude's going down. The market's reacting as it should. Well, let's continue. There's a bunch of more stuff on here I want to show you. So it's also not only the first few charts I showed you, bonds, crude, energy, of course, and interest rates going in the right direction. Not only is it pushing up the stock market, but it's doing to things like cryptocurrency. look at Bitcoin. Look at the run it's had. And the target is 85,000 on Bitcoin. 2 years, 8 months, we will get there. Anyone that's followed my analysis, last time I put out a Bitcoin target, it went right to the target when it was supposed to. Our next target is 85,000. I'm loaded up on Bitcoin myself. I don't just make this stuff up. We should get there. Nothing goes straight up. And, let's start looking at a few other things here. I'm going to be quick. I'm going to give you guys time for questions. So I'm not going to spend a lot of time on these charts, but I am going to prove to you where we're going and why. Huge component to the stock market is Amazon. All big boats are floating higher. They're all floating towards their previous highs or the last high they ever made, their highest highs ever. Amazon, huge component to the stock market. It's going up. Why is it going up? Well, for every other reason, it's to see all the rest of the markets going up. But fund managers have to keep the Magnificent Seven in their portfolios. So if there's a reason to go higher, the big stocks will go higher. If there's a reason to go lower, the big stocks will start to go lower. Well, this is a big stock, and it's going higher, isn't it? It's not going lower. It's going much higher. So no algorithm on here that I found useful. I'm sorry, kids, I'm going to have to turn that off. Markets are moving. We're actually making profit right now across the trade. Let me get rid of it. Traders, I know I can't send you a flash. Please take 50% of your profits on Russell and move your stops to break even. If you're listening, please do that. I'll get a flash out to you as soon as I can. I got to do that myself. Hold on. Just give me a moment. He picks a profit and we'll finish this thing. Just need to change my stop. Sorry about this, kids. I didn't expect a lot of trade pattern during the presentation. Just need to change my stop. Change price. Now we can do this. All right, sorry about that. Set stops. On the X of my trading room, if you're listening, please move stops to break even. Didn't mean that to happen, but it's a live trade happening before our eyes. Kids, we got to get them out. All right, we're out. So Amazon, huge component to the stock market, heading towards new highs. It is absolutely going to make new highs because all the big boats are floating towards their previous highs. And they've got great reason to. Now, don't forget, you've got three things going on here. You've got crude oil giving us an instant stimulus in our pockets. You've got the bond market rallying up, knocking interest rates down, and you've got December. You know what December is? December is the fund manager's bonus round month. What do you do in December? In December, you kick out all the stocks that aren't performing, and you buy the crap out of the ones that are, so that everyone's portfolio looks cherry in December, and you make your bonus. That's the bonus round. So you've got crude oil helping, you've got bonds helping, and the stock market, Wall Street, wants their bonuses. These kids want their bonuses. This market's going higher. Take my word for it. The charts tell us that. Fundamentals tell us that. We will move higher. Nothing goes straight up, but we're ready to go much higher. Use the 21 bar algo on Apple. It works like a charm. I mean, look at how perfect it is. Look here, 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 here. Tips for you guys, kids. I'm not trying to sell you anything. I'm just showing you what you should be using right now. I am Wall Street. I know what's going on here. This will help you every time you get near that 21 ball moving average in Apple. React. All right, so when you had 3 days ago, you had your moment. You'll have to wait again. It will come your way. Use that on Apple, 21 ball moving average. Simple technique I wanted to show you. And Apple is heading towards its all-time highs. You know how double top sometimes have little reactions, but above that all-time high, we will go. Why? Don't forget it's bonus round month, kids. It's got to go higher. You'll see. Wall Street, these guys want their bonuses. Fundamentals are set up. The technicals are set up. We will just keep moving higher. What else do we have out there? Let's see. Did we look at Microsoft yet? Oh, yeah. Look at this guy. Now, here's another one that just Wall Street is in love with an average on Microsoft. It's the 28 bar. Started right about here. And it just became perfect. I mean, it's just right on the money. And look where we are. Top day. Right at the 28 bar. Write it down, kids. I promise you these things work. Simple. You don't have to pay anyone for them. You don't have to know anything. Just put them on your charts and use them. I've been testing these things and using them for 43 years. This stuff works really well in conjunction, of course, with knowing your formations. And of course, if you knew the Omni, you'd get your Omni arrow. Without any other help is very powerful, very simple, and clearly visual for you to see, which is what I like to do. Simple, no trickery. You know, there's no shell game going on here. I'm showing you exactly what the market is doing and why, because the market shows it to us. I'm just repeating back. I'm regurgitating what I've learned from the market. So Microsoft, 28 bar algo, looking fantastic. Could be a bear flag here, but you know, Microsoft's one of the magnificent seven, if you will. It's going up with the rest of the market. So I would just use that average to time buying or selling every time you see it. I hope that helps you. What else is out there? Google. So Google, another. All boats floating towards their previous highs. It's just what seems to happen. When the market starts to go higher, the big guys are going to go, and it's easier to find good trades in those big stocks than it is in the smaller ones, right? Because the smaller stocks are susceptible to almost any type of movement or volume. These bigger stocks, they are going exactly where the chart says they're going. The whole entire street is involved. No trickery, no manipulation. Stay with the bigger stocks. Your analysis will work really well. So Google is going to try to challenge its previous highs, just like Microsoft and everything else that you've seen Apple. They'll get there. They'll get above. No real average works well, or no algo I can find working well on Google at the moment. Just threw it up for an example to show you it is moving higher, and it will want to go test those previous highs. What else do we have on here to show you? Oh, this guy. So look at Meta. Meta, don't ask me why. It's a strange average. I've never really seen anybody else use it. It's the best I could find. 68 bar algo seems to work, with the exception of every now and then a spurt through. See that? 1 day through, 1 day through, 3 days through. Almost doesn't get past it except for a 1 day excursion. So that's the one that we're going to use for now on Meta. Now, Meta has been a fantastic chart, a fantastic move on the chart. The company itself is great. You'd expect that to go higher without looking at a chart, right? I mean, Meta is the next step or stage of the metaverse, Web3, which is going to go crazy. So Meta is floating higher like all the rest of the big boats. I don't really have a great average for you to write down, but the 68 bar symbol does seem to be working now. What other tips can I offer you before I step off this little presentation of mine? Heating oil. What else is forcing these markets higher? The stimulus coming our way. Look at heating oil. Cheaper energy is a worldwide stimulus. Look at this average, how it is just perfect on heating oil. I mean, just Wall Street knows, you know what I'm saying? They grab onto something, they know. So fantastic average on heating oil. Nobody trades heating oil that I know. I used to trade it every day back in the day when we were in the pits, but no one seems to trade it. I want you to see what's going on here. Not only is it breaking down, which helps everybody, right? Especially in the wintertime across this planet. But, you know, simple techniques like you had a flag here, right? Just broke down from the bear flag. Boom, as your flag's about this right here, and move this a little higher. Right? And your pole you can clearly see, and it breaks down. Simple analysis. I promise you, more of this happens on Wall Street than you might imagine. They don't draw it like I'm doing. They tabulate everything, so it's all in numbers, right? So what they're looking at, basically, is this thing. They're looking at all the numbers. If I can smooth this all up. They're looking at all the numbers that take place, right? And you can have a whole bunch of stuff on here. And all of that is being calculated. But it is no different than what you can see with your eyes which is simpler, needs no calculations, no formulas are necessary, no parameters need to be changed, simplicity. I can literally do analysis on a piece of paper with a pencil and come up with really good trades. I don't need anything. Let's know what the high and low was each day because the chart tells me everything else. So let's look at what else is helping the stock markets go high. You've seen heating oil. Look at natural gas. Don't know what that black thing is in front of us, kids. Look at natural gas. Natural gas is dropping dramatically. I have no idea what's happening. It is dropping dramatically. It's all the way down to the tubes. So deflation helps the stock market go up. Natural gas was 10.02. It's 2 and change now. Could it get any better? It's just amazing. So that is a worldwide stimulus. Absolutely. Heating oil, worldwide stimulus. Crude oil, worldwide stimulus. Bonds going up, worldwide stimulus. It is absolutely going to force the stock market higher. It's what happens. Next chart. Oh, look at gasoline. The gasoline chart, look at how this has come down dramatically. It's in the $2 area now, right? Look at you can see the channel moving lower. More reason why you should know the stock market will go higher. That is what we're set to do. Maybe some of the stock markets in the world will not do that, but the way we're set up now, they almost don't have a choice. They're going to have to go higher. So gasoline moving down, that's going to help us go. That's going to help the stock market go higher. What else do we have? Oh, sorry, it's gasoline. We just saw gasoline. So you've already seen crude. To finish this thought, look at how crude has been dropping, worldwide stimulus. So all the stuff, basically, that creates inflation has been dropping. We don't have to talk about food on the shelves because that's individual companies that keep that up. The fundamental markets that need to go lower to make inflation go away have absolutely taken place. The inflation that's left now is simply companies that were able to raise their prices and are keeping them elevated because, let's face it, the supply chains are back, right? Supply is back, demand and supply is all back to normal. So there's really no reason why you can't get the stuff on the shelves, which means the inflation isn't supply chain inflation, and it's not commodity inflation, and it's not even anymore because we're lowering. It's not bond inflation or interest rate inflation, and it's certainly not energy inflation. So we're out of that inflationary stage, and the markets are picking up on that. So one of the things that will show you that, will illustrate that absolutely, is this. What makes inflation? Well, commodity price index is one of them, right? Here's the Bloomberg Commodity Price Index. This is a measure of inflation and, or in this case, deflation. This type of action will drive the stocks higher. You've got 97.82 versus 140.55 at the height of inflation where our supply chains were all screwed up. We have dropped from 145 to 97.82. There is no more inflation. That's real. It's just priced in inflation at this point. So the markets are absolutely, positively, unequivocally going to react to this. They will react higher, and it's really easy to come up with trades that you need to get in and out. But that, I don't think I'm going to end up showing you here. I think what will happen next is I've got, and I'll take some questions from you, of course. I've got an Omniac who's come out to my Omni camp, which I didn't even talk to you guys about. It's a 5-day session in my home office. I teach people exactly how to call the markets, the way the Omni does, where we go, blah, blah, blah. So I've had an Omniac come out to my Omni camp. He's also been following my Omni trades for quite some time. And he said, Oscar, you do these webinars. You show people great tips, great stuff. You never even tell them where to find you. You don't tell them anything about you. You don't tell them about your Omni. You give them a bunch of stuff and they run off and that's it. You don't see them again. So I think you need to present your Omni to them, but it's not, my plight is to teach people how well charts work the power of technical analysis and what you can do to help yourselves. It's not really in my DNA to sell something to you, right? So I am not going to go near that, but I am going to have a Neil Pacey come out, who's been to my Omni camp, has been following me for a while, came to me a month ago and said, Oscar, I've created some sort of a little bit of a webinar for you. And I would like to present this in your stead, if you don't want to present it for yourself, just to show people where to find you and the power of your Omni. So in a little while, I'm going to let them do that. But let me show you one more thing. You want to see the power of technical analysis. You want to see no one can do this. No one in the world is this good. The chart is this good. Check this out. Let's take a little journey on the gold chart. Now, you want to see simplicity. You see this red channel? All right. Now, with the exception of you being blind, you don't need any other skill to know what to do when you're looking at this. And here's why. It hits the bottom, becomes a buy. Hits the bottom, becomes a buy. What's it do when it hits the top? Becomes a sell. What happens here? Buy sit. Right? The street is watching. Buy sit. What happens when it gets here? They sell it. What happens when it gets there? They sell it. Simple, right? It's just a channel. Oh, Wall Street is watching this stuff. What happens when it gets here? The 200 ball moving average and the top of the channel. They sell it. Another attempt. They sell it. What happens at the bottom? Let me explain what happens at the bottom. Right here at the bottom, I come up with a buy signal. Not only simplicity, of course, it's at the bottom of the channel. I better be looking for a buy unless I'm blind. The Omni went bullish down here. Well, we come up with a buy signal, and literally the next day, the war starts. Oh my God, we have a buy signal go, the war starts. So what do? I use my analysis. Nothing, and I tell you nothing from, if I could grab a rectangle, just grab something here. Nothing from here exists on my chart. Nothing at all. This whole thing doesn't exist. None of this up here has happened yet. Nothing has happened. We are literally down here when I get an Omni buy signal. So none of this has taken place, and here's what we do next. I give a signal. I come out and do a YouTube video, and I said, traders, we're at 1845 right now, but I'm going to give you a target of 1945. We're going to go. The market runs right to 1945, and I give a secondary target. So I give two targets out, 1945 and 2009. Market runs, hits 1945, takes a little breather, runs up, hits exactly 2009, and breaks. Breaks again. When it breaks to down here, I give out a third target. Target is all the way up here. Target calculated. Market runs up, hits the target exactly, and I come out that very night, the night on Sunday night a week ago that we hit that, I come out with a video and said, gold capitulated, get out, it's over, we're done. Watch the downside now. So not only did I give you from the low exact targets, 1, 2, 3, I also let you know once we hit that target, did a video that very moment when the target was hit, we've capitulated. Look at the capitulation that's taking place. You know who can do that with a chart? Nobody. Nobody's that good. No one can do that. These are perfect levels. Everything happened during a war with all kinds of craziness going on. Who can do that? Nobody. The chart can do it. The chart gave these numbers to me. The chart told me where it was going to go. I told my Omniacs where it was going to go. I did a video to say where it would go. And then I did a video each night as we got there. And then I did the video when we capitulated. How could I have that sort of information? No one can have inside information that accurate. I don't have any. I know how to read a chart. And I can teach that to you anytime you want to come out and visit with me. Now, again, I'm showing you the simplicity behind reading these charts. It can be much more complicated if you want it to be, but you'll find the more complicated you make this, the more complicated it's going to become. You'll never get good signals out of your charts. So one thing I will say, the gentleman before us mentioned about overbought and oversold markets. There is no such thing as overbought or oversold. That is a trader's mentality. You know when a market's oversold? When it stops going up and starts coming down, that's when it's oversold, or overbought, I should say. Market's overbought never until it stops going up and then starts to come back down. Then you can call it overbought. So there are a lot of people out there that have an indicator. As soon as it hits the indicator, they say it's oversold or it's overbought. That's ridiculous. It is never overbought or oversold till the market turns it tells you. So it's a trader's mentality. They tell the market it's overbought or oversold. I've never found the market overbought or oversold in my whole career. It just makes moves, and I try to jump on its back like it's a thoroughbred horse. I try to get on its back, take a little ride, get back off, and then follow the analysis again. So you can't do analysis like this. You can't have this information beforehand, and you can't develop it in your mind. And there's no fundamental that could have told me in 1945, 2009, and then 2020, 2120. Nothing could have told me that. Just a good chart read. So it is easy and it's possible to be very good at reading these graphs. What you got to do is realize that the graph does tell you everything you need to know. You just got to believe in it. Gold is breaking the 200-bar moving average today, or probably got even lower today. That tells you, by the way, when it got above, it exploded, right? It just got back below. Not only are you back below, but now you're breaking what Wall Street will recognize as major trend lines, because even though they don't draw the line, it's calculated. They see this trend line right here. They know now we're below the trend line. We're breaking trend. We're below the 200-bar moving average. Sellers will continue. Reading these charts is not that difficult. You just have to know what to look for. Is there any questions that I can help traders with before I turn this over to Neil Dacey?
Yeah, we have some questions for you, Oscar. Okay. Let's see. You talked a lot about gold. Alex and B were both asking about silver, other minerals, and agriculture.
So silver is always a dog. We go to, I'm sure I have a silver chart. In fact, let's just do a fresh one. Silver is always a dog. It has been my whole life. I'm going to tell you a story about it. So, get this. Once the chart comes up, I'll show it to you. So, this is the chart. That's not the chart. So, There's H2. That's the all right. So, this is silver. And something was told to me about silver the day I started in this business. Very interesting. Here's what I was told. Silver is a dog. What do you mean, boss? Dominic Orsiello, my mentor on the trading floor, one of the best traders to ever grace the exchange. Thank God I ended up working for him. He says, look, silver's a dog. Every time silver sticks its ugly head up, take out your lawnmower and chop it. What does that mean? He said, you'll see. I've been doing this. Now, this is my mentor speaking to me, 65. I've been doing this for almost 40 years when he started on the floor. And the price of silver was around $21. He said gold was $65, platinum was $100, copper was 65 cents, silver was about $18 to $21. 40 years later, gold is $700 an ounce, copper $65 an ounce, platinum's $1,000 an ounce, silver's in the same place. So that's what he said to me when I started 42 years ago, right? Well, I've been telling this to people since I started. Silver is a dog, because as long as I've been in this business, 43 years, it does exactly what Dominic Orsiello told me it would do. Every time it sticks its ugly head up, take out your lawnmower and chop it off. That's what I'm going to tell you about silver. It's the best advice that was ever given to me. It never goes up. It's always in sympathy with gold. And when gold shows the slightest bit of weakness, silver will fall apart much sooner. So gold goes first, silver follows. And as soon as gold falls, silver goes quicker on the downside. So keep your eyes on it in that vein of thought.
All right. B wants to know why you don't use candles.
So if we turn this into, all right, so right now we're looking at a daily bar, right? So it's got an open, a low, a high, and a close. Simple information. But if we take this and we turn it into a candlestick, now I've got wicks, I've got full bodies, I've got empty bodies, I've got things that are, look at this little guy right here. He's got a little full body with a long wick. Then there's another one with a full body and a little wick. That's too much information. I don't want to know that much information on a daily bar. I want to know what was the opening, what was the close, what was the high and low. I don't need any of the rest of the information. And there's one more thing about candlesticks that seems to drive me insane. And the thing about candlesticks that I have found I don't like, and I'll just put any candlestick works, is that if you see this candle right here, it might mean something. But the next day, this candle makes the one behind it have a new meaning. I don't need to know ever what happened in the past, right? It's gone. I need to know tomorrow's meaning. So if today's bar makes yesterday's bar something different, I'm trading off yesterday's bar's information. Today's bar made yesterday's information incorrect. If you ask me, candlesticks is like chasing your tail around. There is no way to get them right. I don't use them. I was a candlestick guy, guru, if you will. Back in the 80s, 90s, I even wrote programs to show people what each candle was. Before anybody ever did this, we wrote a computer program. I could go upstairs and show it to you in the 80s. What the candle meant, every single candle, formation above it, little words above it, tells you what it meant. And it took me a year to do it. And by the time I was done writing the program for them, I told them I'd never use candles again. And I haven't used them since. Too complicated, too much information. Should be much simpler.
All right, let's see. A couple questions about moving averages coming in. Alex wants to know, do you think 20 or 28 is considered a short-term moving average? And Raymond wants to know how you determine the moving average.
So, in fact, yes. Let me get rid of this. That's going to be, it's probably not good to see. Let me pull up a fresh chart with nothing on it, anything at all. You know what? I'll just pull up the S&P. So we'll do SC3. And that's not ESC3 by any means. So you've got, let's just we'll get rid of any averages that are on here. 200's fine. So what I'll do normally is, don't know what Wall Street's using, don't have a clue what they're using. It's always different from week to week, month to month. But I like to know what's working on the outsides of the market, right? So any average I can find, and we'll just pull up any average for now and just see what we can do. But any average that I can find that's on a chart, in fact, let's undo that. Let's take an average and we'll make it a different one. If I can find it working on the outsides of the market, I like it. So of course, Wall Street loves the 50-ball moving average, right? And we want to see if that's got anything to do with anything. Now, if you take a look at this, it actually is working kind of well with the market, right? 50, here it works, here it works, here it works, works here. It's a little bit fuzzy up here, works well again down here, but now it's out of vogue. Nothing to do with where we are now. So they're using a shorter term. All right, what are they using? Are they using something ridiculous, like a 21? Simple, I mean, that obvious? All right, not a 21. And you move around until you find out what it is these cats are latching onto this month. So maybe it's something little like an 18. I tend to not use averages like that unless Wall Street's using them, but if they're using them, I'm using them. So I like bigger averages, 200 bar, I like that. It stays out of the market's way. I like the 100 bar average, stays out of the market's way. But Wall Street likes to get complicated. They'll actually take this down to, sometimes you'll see them literally with like an 11 bar average. I've seen this before. And they'll use that for months on end, even though we don't realize they're using it. So what you want to do is make sure that your average is not getting hit very often. Anything that's not being hit often is something that can be used. So you move your average around till you find one that literally just floats along the top, and you'll find it. You want it to float along the top, right? And if it gets through the top, it starts to turn, and maybe it'll float along the bottom, but never really go through much. You don't want it to go through a lot of stuff. That's the type of average that works for me. It's also the type of average that works on Wall Street. So you can literally just experiment till you find one that's working, and when you have it, lock in until you see it walk away. And in the last presentation I did for traders, I think, in fact, we had this. Watch this. I can do it right before your eyes. MQZ 2-3 on this guy, or just 3? Should be 3. All right, so watch this. I did a webinar for you guys 2 months ago, and if I remember right, NASDAQ was using like an 18-bar average. Let's see what this one is. I think it was using an 18-bar average. It wasn't 18 on this one, it might have been 21. It's going to be a moment, I'll show it to you. All right, so I think it was the 21-bar average. And they were using it, and it was really, really good. And right around here, it just changed a little bit. I want it to be perfect. So I said, okay, what are they using now? And they literally just moved it out a little bit. It's like an 18. No, the other way. They moved it out a little bit. It's like a 24 right now. Maybe a 25. And it's a 24, like I thought. So what I want you to do is just experiment until you find what they're using and then latch on. Because they won't know you're using it, but I promise you, you'll know you're using their work. So as you can see how many times the 21 stopped working, the 18 stopped working, it morphed up to a 24, they're using the 24. It will move. A lot of times I'll find it'll actually move further than, it'll go from the 18 to like the 50 or the 70 or the 100. But in this case, it only moved out a little bit, which means the market's tight. They're using the average like crazy, and it's in everyone's systems right now. In fact, you can tell when they pull them out of their systems because they just stop working as well. Is there anything else I can help you with?
Yeah, I think we have time for, we have time for one more. Tammy wants to know if you can look at the FTSE 100.
FTSE 100. Now, I know I have a FTSE chart saved here, so let's just go. Oh, you know what? It's got a strange symbol. What's the FTSE symbol? You remember?
I think it's .FTSE, if I remember right.
It's not? I'll just try it, see if that comes up. Because I had a nice chart saved that I've been using for a few years. And there it is. Beautiful.
Yeah, okay. I was right. Woo! I'm going to write that down. So don't forget.
You know, this used to be part of our everyday trading, the FTSE. I don't know, about 8 or 10 years ago, they just kind of stopped giving us the quotes. It stopped being part of American trading. I don't know anyone that bothers trading it anymore, at least here in the US. So, all right, so simple analysis. Let's get simple. If we just connect the highs, in fact, I like connecting that high to this high and pulling through there. That's the first high that took place. Then I would literally just do another one and pull it above these highs, and it's a guaranteed lock that Wall Street has these two lines in there. It's a guaranteed lock because they're looking at the highs and the next high. They're extending out tabular form, yes. So it's, you know, it's in numbers, but they're looking at the same thing. Why? You cannot draw this trend line from here to here unless you know this exact mathematical point and this exact mathematical point. What is the difference if we see it visually or we see it in numbers? It is the same thing. Visual is easier. It doesn't take as much thinking. So FTSE right now, it's looking all right. What kind of average that is? This looks like the consumer average. It's probably the 50 because no one's using it right now. Maybe not. Try the 100. So I don't really see anything that I love about the FTSE except for that it's above this first trend line. And of course, you can see it's in a channel moving higher. All right, let's just do it this way. We'll connect that, keep it parallel. And you can see it's in some kind of a channel here. So it's in a channel moving higher. I like that. I like the fact that it's above this average. That's given it trouble many times. And I like the fact that it's above this first resistance. We'll make it red so you can see this resistance. I like that it's above that resistance, but I don't really like this market at all. I mean, looking at that chart, the problem for me is that this chart goes in the wrong direction, right? Parallel of this, you've got a chart moving down, not up. I like charts that are moving up. This is a upward trend in a downward bigger trend, right? This is an upward movement. This one here, we'll just cut this out of the way. This is an upward movement, but you're really in a down trend. So for me, I don't love this chart. We call it a stock for all I care. I don't really love it. It probably will move in sympathy with the US market, but I wouldn't take a trade off this chart. I would just ignore it fundamentally. Anything else, Jeff?
Let's see. Richard wants to know why the SMA, not the EMA. And Raymond wants to know lots of questions about moving averages. How do you feel about the value of the slope of a moving average when looking at price action? So a couple of moving average questions for you.
So the value of the slope to me means absolutely nothing because it's getting its slope from the value of each daily bar that comes up. So you may be creating a formation, bullish flag, whatever you find. You might be creating a formation while you've got an average sloping. I rarely use an average unless it's away from the market and we get to it. So in other words, averages aren't part of my analysis unless it's at an extreme moment and we get to it. Then it matters to me. I don't go looking for averages and force them to fit. I try to find something that skirts along the outside and then I ignore it until we get to it. And when we get to it, it's always meaningful. So I don't really care what direction the average is going in as long as it's outside of the market, above or below. Smaller averages simply mean that the market is more volatile, it's moving quicker, and the bars are kind of the same size, so the averages get smaller. When you see the market start to gain larger bars, all right, so let's see these bars right here? These bars that can fit in this little circle? Well, when you have bars moving like that, usually an average barely goes anywhere, right? It just kind of stays there. But then once the big movement starts, like we started dropping down, we see how quickly the average starts to take a toll to the downside. So for me, it's like driving a car. The average is just part of the trade. Don't worry which direction it's going in. When you get to extremes, use your average. When you're not at extremes, leave it alone.
All right, cool. That's the questions.
What? I got this weird sign at the bottom telling me to activate something, and I can't make it go.
Yeah,
it's just.
Okay. Yeah. Let's see. Should we have? I think you said you wanted to have Neil speak for a minute.
Yes, Neil. So once again, what I never really show anybody is how you can find me. I mean, it's free. You can just come hang out with me for absolutely free. So Neil basically wants to let people know, A, what goes on here and how to find me, and I would love to have him present to you.
All right, and let's see. Let me kind of turn on his mic. He should be able to talk now. And I'll make him
unmuted, but now I need to share. Show which screen? You see a screen with my picture on it?
Yeah, it's coming through.
Okay. All right, be patient with me. I am a GoToWebinar newbie, so hopefully I won't mess this up too bad. Thanks, Oscar. Thanks, Jeff. I've come to a couple of these webinars over the past, and after I graduated out of Omni Camp, I asked Oscar, I says, hey, why don't you do some explanation of the Omni, the way these other presenters share their stuff? And he said, elaborate, put me together a deck. And I said, okay, here it is. And he said, that looks great, present it. So here I am. I'm not employed by Oscar. I'm just an Omniac who went to his camp, and I want to help him share his knowledge with other and experience with other traders. Okay, is it working? Next screen. I'm in the IT business. I've been doing that for about 40 years, and my trading up until now is pretty much limited to shuffling around 401k allocations and things like that. I got drawn to Oscar's daily videos back in 2006 or 2007, where he'd get on and he'd say, this is what I see in the market and this is what's going to happen. And then the next video comes out and says, see how it played out. And I thought, that's just amazing. One of my favorite movies of all time is Trading Places with Eddie Murphy and Dan Aykroyd and Jamie Lee Curtis. And after them watching them clean up in the frozen concentrated orange juice, I wanted to know how they did it. They got into market at the right time. They caught the daily range before they exited. And how did they know which way the market would go? And well, in Hollywood fashion, they cheated. And how did they know when to enter and when to exit? Well, they relied on Lewis's experience as a trader. I needed to find out a way to trade and how to trade it, where to get in, where to get out. And I've learned since then, you no longer need to have a seat on the floor to be able to do that. You can trade from your home office right on your laptop. And this is where Oscar was willing and ready to help me. So in any day, you can see that there's more than what goes on in the open and close. There's the entire high and low. So how do we know? Is it going to go up, down, sideways? What's it going to do? So then I've learned that Oscar has refined this process, and he calls it the Oscar's Market Navigational Indicator, and it'll project direction any instrument for the upcoming session, whether it be a day, a week, a month, a quarter. It recommends entry and exit prices. It uses a combination of market indicators and technical analysis to come up with those entry and exits. It works on any instrument, works on any time frame, but a key to the Omni process is to put your stops in first in order to manage your risk. On the livewithoscar.com website, if you go out, you'll see that on the Daily Omni page, there's two blue boxes there, the chat room and the Get the Daily Omni. If you go to the chat room, you're going to see where the Omniacs hang out all day. That's where you can talk to Oscar, see him on his screens and everything. Also on the Daily Omni page, you'll see this is where you can see whatever the current recommendations are, what the Daily Omni is, and that's what's down the left-hand side there under the 1208. And the right-hand side is where the flashes are going to get posted, and that's where the meat really hits the pan. So let's see. If you scroll down on that Omni page, you're going to see where the current chart analysis that accompanies those videos up top. You can also see the trade recommendations for any dates going back 15 some years. If you look at last week, you'll see that we had 3 winners, 1 loser, and 1 push. But today I just want to go through real quick a recent trade from last week, specifically that Russell short that we took on Wednesday, December 6th. So after the markets close at 5 p.m., we analyze the data. We typically trade in the CME index markets, and those close at 5 and then they reopen at 6. So somewhere around 6 o'clock is when Oscar posts the Daily Omni. And you can see here where he says what we're looking at and if there's a new video out. In this particular session, there was no trade that came in when the initial flash came out, but when it does come out, it'll be over on the right-hand side in the real-time flash update. So this first flash update came out at 9:30 in the morning. The overnight was pretty quiet, and the trade was to go short Russell at 1881, all the way up to 1885, and also make sure to get your stops in somewhere above 1899, and that he would keep us informed on that. Notice that these flash updates are stamped Eastern or New York Omni time. In this example, you'll see the chart on the bottom right. It shows Central Time where the CME is located. So following that flash, we put our buy stop in. We went short at the red dot. These screenshots may be a little tough to read, but you don't have to take my word for it. Pull up that historical trade and you can track it yourself. The next flash update came out right when the market right after the market opened at 9:36. It was at 1886, and he gave us what the targets were on what we're going to be looking for. You see that right after it came out, the Russell dropped way down to almost to our first profit objective. He also gave us all the profit objectives for that trade for the rest of the day. Over the next hour and a half, the market went against us, but it never threatened our stop. Eventually, it came back down through our entry. So you see that he reminded us where we were filled and what the current price is at the yellow dot. And this was a chance. If you didn't want to be in, this was your good chance to get out and not take a loss. After another hour of grinding down, we were advised to tighten up our risk. So at 1873.86, that other yellow dot, we pulled down our stops to just outside of the break even. 4, 5. Most Omniacs trade multiple contracts, and approaching profit objective 1 at the blue dot is where we were advised to just what Oscar said earlier in this call, is to take half your money off the table and then move your stops. Moving stops is managing risk. That's huge. This final flash update, Oscar had to take off to UNLV. I don't know if everybody followed what happened at UNLV last week, but Oscar was a little busy last Wednesday. But as he was gone, we already had our profit objectives, and it turned out that through the rest of the session, the Russell dropped through all of those profit objectives, and as long as we had our buy orders in place, we cleared out at the total down at 1854. So in a summary, the market, the Russell closed that day on a down 4.9 points, but on a range of 42 points, but we caught 27 of those 42 points. So if you exited at the first profit objective, that was $650 on a Russell, all the way up to $1,350 on a single contract of the Russell. If you go out to the page, you can also get out and you see that there's the home, about us, all the other stuff on a standard website. Come and hang out in the room. It's free to register. Oscar mentions that before. You just got to give a name, but you do have to register. If you want to get the YouTube's videos, update those. The flash updates come to platinum members, and that does require a fee. And Oscar can tell you all about that if you want to. I'm a platinum member, and I tell you what, it just about every trade you make, it pretty much pays for platinum membership for a year. Sign up for the Omni Trading Academy if you want to learn how to do this. Join a select handful of people who Oscar personally has brought into his home and taught how to do Omni analysis. You'll be able to do these same analyses on any instrument that has a chart to be analyzed: index, futures, forex, stocks. And don't just take my word for it. Check out historical trades, winners and losers, out on livewithoscar.com. Back to you, Oscar or Jeff.
Well, thank you, sir. Can anyone hear me?
Gotcha, Oscar.
Can hear you. Yes. Thanks, Neil. We appreciate it.
Neil, thank you for that. I appreciate that. Neil put that together himself, decided he wanted to present it. I thank you for doing that. Thank you so much. If anyone does want to find me, Neil told you where you can find me. It is at livewithoscar.com. Really easy to get to. If you go to Live with Oscar, it'll look like this. And for me, I make it so simple. All you have to do is hit register, come up with a username, password.
We can't see your screen.
Oh, you can't see my screen?
No. I can send it to you. Not a big deal.
You get it?
Okay, now I can see it.
Really easy. I'm sitting in a live trading room, right? And you can get to Live with Oscar just by going to livewithoscar.com.
I like to pronounce it Live with Oscar.
Yeah, it is Live with Oscar. I mean, I do this 24 hours a day. You live with me. So if you remember, you log in. If not, you hit register. There's nothing to fill out, right? We don't ask for credit cards or anything. You will get an email. It will go to your spam. That's just what happens these days. Check your spam. Click the email back. You get a verification code, and then come join me in my live trading room where we can do what I'm doing right now every day and night for the rest of our lives. And it doesn't cost you anything. You can line up with everybody else in the trading room. I put on a microphone and a camera on my end. You don't have to put one on your end. It's not even allowed. So it's simple, it's easy, free, and I can help you in 1,000 ways if you want me to.
All right. Great job, as usual, Oscar. I appreciate you.
Well, thank you. I appreciate everybody who looks at analysis, and I love MetaStock. I've been with them since 18 years old. I'll be with MetaStock probably after you're gone, Jeff.
Ooh. Well, hopefully that's not too soon. Every day's a good day when you wake up on the right side of the grass, right?
No doubt.
All right. Thanks, Oscar. Livewithoscar.com, everybody. Thank you again. All right. Let me go ahead and do this. And we'll do this. All right. And every once in a while, I'll just get a really, really big view of my face and can't do anything else. So let me go ahead and share my screen. Actually, let's see. Make presenter, show my screen. Okay, there you go. And Trader SLA says Oscar Escalate. Okay, hold on a second. I'm going to remember how to speak. Oscar says excellent analysis. Nobody does it better. Compliments to Neil as well. Great job. All right. Thank you, everybody, for coming in. All right. We did sit down not too long ago, and we recorded a training package with Oscar, where we spent 3 hours. I was like, how long was it? 3 hours. I put it on the side so I wouldn't forget. 3 hours talking about trend lines, finding support and resistance levels, technical formations, all that kind of good stuff. He did a great job. Absolutely loved it. It was a live class that we recorded. It's available for you. And if you want to get it, it's $349 here at the summit. So you can do that. You can give us a call, 800-882-3040. You can go to metastock.com/sales-chat. You can get it there. It's also part of the Summit Action Pack that we've been talking about that includes Vora Victory, GoNoGo charts, Oscar Carboni, trend lines and toolkits, trend line training, Jake Bernstein's setup and timing and triggers. He's going to come in right after me. Price Headley's Big Trend Toolkit. Such a great collection of tools and some of the best add-ons that we've got all available here. We're going to throw in 3 months of learnmetastock.com as part of this. We're going to give you Unleash the Power of MetaStock. Normally the cost for this would be $3,985. It's part of our Holiday Trader Summit Action Pack. We're going to do $1,692. And you can do that. You can go to metastock.com/summit deal. You can give us a call at 800-882-3040, or you can give us a call or you can chat online with us at metastock.com/sales-chat. So very, very big thanks for everybody that's here today. Appreciate your being here. It's good to see all of you and all of our speakers today. So I do want to spend a minute to kind of throw out to our sponsors. Stocks and Commodities has been a great partner of us for decades now, and they're a sponsor of today's event. So if you're watching this on YouTube and you haven't done so yet, make sure to go to metastock.com/traders-summit. You can fill out a little registration form and get not only a free month of Stocks and Commodities magazine, but there's tons of freebies that are offered by all of the presenters that you can sign up for as well. So we'll also say thank you to CMT, the CMT Association. They've been a strong supporter of MetaStock for a couple of years in our Trader Summits. CMTassociation.org, 646-652-3300. Tyler, who just talked right before Oscar, is going to come back in and talk about the benefits of being a CMT member and using technical analysis and what that can do for you. Stick around for that. He's a very last speaker today, but it was surprising to me. Like if you've got assets under management, if you want to be a money manager, if you want more responsibilities as a money manager, he'll actually kind of talk in detail about how having a CMT. Question from B that actually leads straight into the first thing I want to talk about. But if you're not familiar with MetaStock, I did fix the slide. It now says 30 years in a row. It's been rated the #1 software in its price category. We're going to talk about scanning market,
unmuted,
testing trading ideas, forecasting probable price moves with a patented forecaster. I'm not going to talk about all of this today, but MetaStock's been rated #1 in its price category for 30 years in a row. And if you pay for a month, I'll talk more about how much it costs, but prices do start at about $69 here in the US. If you pay for a month, we'll give you a second and third month today. And you can do that at metastock.com/traders-summit 341. Okay, all right, cool. I'm next. So today, okay, let me talk a little bit. We'll just skip this. Let me read the legal disclaimer. Let me get in a better position so that my feet don't go numb while I'm talking. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather it's guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. MetaStock does not endorse the purchase of any security. It isn't paid for the promotion of any security. No information contained in this presentation should be construed as investment advice or a solicitation to buy any security. So, that's a lot of words, right? Okay, as I mentioned before,
Hey,
I threw my
Jeff.
coffee on the floor.
Jeff, can you hear me?
It's been rated number 30 years in a row. I actually, two of us forgot to copy our slide. But let me tell you a little bit about the company, just a little bit. We started in business about 1980s. I myself started here back in 1997-ish. And it's a great company. When I started, it was owned by Reuters, then it was owned by Thomson Reuters. We bought it back from them about, let's say 10 or 11 years. And in the meantime, we've actually kind of made some really huge changes, updates, upgrades, just released a brand new charting engine. I will say this. Okay, so I started about 27 years ago. It's a great company to work for. I absolutely love it here. And it's a great software program to represent also. One of the things that I like to kind of brag about is this. I've said this many times, but one of the things that I also find is really cool is like we have a support team. They're right over here in our Utah office, like right across the office from us. And we actually keep more people in our support team than we do in sales and marketing combined. And if you ever have any questions, if you have problems, if you need something, you can call them, you can email them, you can chat with them, you can even send them a letter if you want. But they do a great job. In fact, like there's not many, there's quite often we'll get a weekly report of everybody that's answered our support surveys from that week. And it's quite often that they get just 100%. And they do a really, really good job. And so I myself have loved working for MetaStock for a number of years. It's a great software to represent with just like the heritage and the fact that it's been rated so highly. But one of the things I also think that we do better than anybody else, and I am 100% biased. I'll say that right out the gate. But customer support, like I don't know the last time you called somebody for help with any software and just felt really good about that, or would have given them 100% thumbs up or whatever. They do a great job. So in any case, what am I going to talk about today? Good question. Today I'm going to talk a little bit about the hidden gems of MetaStock. I thought it was pretty funny when B asked in the chat, can MetaStock draw support lines and resistance lines, and can it do trend lines, and can it do all that kind of stuff? And that's actually the first thing that I'm going to talk about. So what I'm going to ask you to do, if you're watching this right now, and I know there's hundreds of you in the chat, give me a symbol. What I don't like to do is I don't actually go in and kind of create a whole bunch of pre-chosen indicators and systems and stuff like that. What I need you to do is I need you to help. I need you to give me a couple of symbols. We're going to look at your symbols, and I'm going to show you how we can use MetaStock to, first of all, find breakouts, find support and resistance levels. Give me some symbols, guys. And while we do that, I'm going to go ahead and kind of jump into MetaStock and kind of just clean it up a little bit. You can see I've run the scan here from there. Neil says, keep going. Okay, I will. All right, give me a symbol. I'll keep going. All right, let's see. Okay, this one that we're looking at right now is AMD. Nobody's typing in symbols. Go ahead and type in some symbols. We'll take a look at them. Those will be important as we kind of look at the next section. Since I'm looking at AMD, Apple. Okay, thank you, MetaStock. Let's go ahead and look at Apple. All right, what I'm going to do here is we're just going to go ahead and jump into Apple. And what I'm going to do, welcome, Neil. Glad you made it. Thanks for coming. All right, I'm going to apply what we call in MetaStock a template. Okay, and the template that I'm going to actually apply is one that I created to kind of take advantage of what we call the dynamic trading tools in MetaStock. So let me go ahead and do this. I'm going to right click on a chart here. I'm going to go to apply template. And what I'm going to do is I'm going to go to DT, or actually I think I called it dynamic. Yeah, it's a template that's called dynamic trading tools. Now, I didn't write these indicators. I just built the template that kind of puts them all on a chart in the way that I like to actually see them. And we're going to go ahead and click on no on that dialog box. I'm going to zoom just a little bit out, dragging this little splitter bar on the bottom here, and just kind of show you a little bit about what we're looking at. Now, when I'm looking at this on my screens here, I actually like to kind of look at it a little bit bigger. And so, or I like to see the lines a little bit thicker. And so what I'm going to do is, so you can see it and so that we can both see it, is I'm just going to change the view so that we have darker lines or fatter lines. So let me go ahead and do that. With MetaStock, it's pretty easy to do. If I want to fatten up a line, I can just click on it. And what I'm going to do is I'm just going to kind of ramp up the thickness on it quite a bit so you can see that. Okay, there's another one that's a little bit smaller here. I'm going to kind of make that a bit bigger as well as this one here. And then I'll just kind of talk a little bit about what these lines do. So again, with MetaStock, it's super easy to change things. Anytime you want to change something, where you can right click on it and pick it, or you can double click on it. It's one of the things that we kind of pay particular attention to when we're kind of creating charting softwares, is we try and kind of keep it very similar to like the way other Windows applications work. So if you want to change something, you can right click on it and go to properties. If you want to add an indicator, you can drag it, you can drop it. We try and make the software as intuitive as possible. And I remember that was one of the things that Steve, the person that started MetaStock so many years ago, always was very, very serious about. He wanted something that you could focus on the analysis you were doing and not kind of get lost in what you're trying to do with the software. So, all right, we got everything kind of changed. I'm looking at exactly what I want to see. And let's go ahead and kind of just talk about what's included on the chart. All of these lines are automatically drawn. I didn't draw any of them on the chart. And what they're trying to do is trying to identify trend lines, either up or down, long or short term. So right here, it doesn't see any long term right now, but here it had a longer term trend line that it drew on Apple right here. Here it had a shorter term trend line that it drew right here, right in about the same place. And if I was looking at this right here is where you would have seen a breakout on that longer term trend line, okay? Now the lines that are horizontal, like this line right here, actually there's another one right here. This is resistance. I'm gonna make it a little bit fatter so you can see it too. And support, okay? So the green ones are resistance right here. You had a longer term resistance level that was penetrated a little bit ago. Here you had another longer term resistance area, okay? Here had a shorter term resistance area, shorter term support area, longer term support area, longer term support area. So these are designed to kind of help you find support and resistance and help you draw those on the chart for you. So to answer your question that you asked during Oscar Gabby, we can draw these levels for you, okay? Ooh, thank you for the symbol, JPY equals, Brian. We'll go ahead and add that next time when we do RMO, okay? All right, so now obviously one of the things that we've talked about a lot is like, okay, so if you're looking at support and resistance and you're using support and resistance in your trading, a lot of times what you want to be able to find is, have we broken a support or resistance level, okay? Have we broken up above a trend line? Have we broken down below a trend line? And because these are kind of drawn for you, we can find them. So for example, if I was looking for this trend line to break out, either one of these, this would be the kind of the time I would want to be able to look at that, okay? If I was looking for a support or resistance breakout, obviously right here is where we broke above this support level. And what I want to be able to do is I want to be able to find stocks that are breaking above resistance, down through support, up through trend lines, and that's something that you can very, very easily do with MetaStock. So let me show you how that works. Very quickly, it's super easy to do. So what I'm going to do is I'm going to go in here, and instead of running this BTT3, all of the dynamic trading tools, that's what we call the indicators, are called DT, okay? And so I'm just gonna search for DT right now. And what I'm gonna do is let's look for stocks that have broken up through resistance, down through support, or up or down through trend lines, okay? And we'll just look at the long term. So right here, this is DT support and resistance long term. This is DT trend line breakouts long term. And what I'm gonna do is I'm gonna run both of those explorations, Okay. Now we get our data through Reuters, which is actually refined. Actually, technically, they're going to be called the London Stock Exchange Group, just a little bit. So we get all of our data through London Stock Exchange Group, which was formerly known as Reuters at one point, and some of the best data. And the thing that you can do with MetaStock, one of our key advantages is if you're international, you want to use MetaStock somewhere overseas, we probably have data for you, okay? And we have one of the best, it's an institutional quality data feed that you can have that offers news and information in the US as well. So what you can do with this is you can basically scan any market that you want. We cover several hundred exchanges. If you're in Asia, you can do Asian markets. If you're in India, India's a very big market. You can do Indian markets. If you're in Australia, if you're in Singapore, if you're in Hong Kong, whatever it might be. In fact, if you look at this number right here, there's 323,654 instruments that you could actually technically scan. And so if you wanted to do Bitcoin, you could. Brian, if you wanted to do Japanese yen, you could. If you want to do Apple, MetaStock, you could. It doesn't matter. If you're interested in the markets, it's going to be able to kind of do it for you. So, I'll just, if I wanted to do like the national, let's say I wanted to do just Singapore, okay? I could come in here to Asia, just find the Singapore Stock Exchange, select it, it's gonna run it for me. The scan I'm gonna run right now, I've come into the index constituents list. I've chose the Dow Jones Industrials, the NASDAQ 100, and the S&P 500. Oh, and I've got a scan open. Okay, I'm going, why isn't this open? Why isn't the Explore button? Let me go ahead and close this scan. And now I should be able to just start the new exploration that we want to run, okay? And what it's gonna do is it's gonna go through those 532 issues that I just kind of shown, 510 actually, S&P 500, NASDAQ 100, Dow 30. And it's going to show me all the stocks that have recently broken through either a support line or a resistance line. That's this one here that we're running. Or it's done a trend line, either an up trend line or a down trend line breakout. Okay? And then as soon as we're done, Neil wants to look at Meta. I will look at Meta, actually. And I always like to say that we're the original MetaStock. We're not related to Facebook at all. So not yet. But we've had our name a lot longer than Meta has. So in any case, let me just show you how this works. So very quickly, we were able to run that. Both scans are now done. This long term, basically, we went through and we identified everything that broke through a support and resistance level. So this either broke up, everything that's on this list over here, either broke up through a support, through a resistance level, or broke down through a support level. Okay, and right here you can see the close price. Right here is break up and break down. Okay, so that gives us an idea of how long ago it broke. Okay, and the number here, so if I looked at A.O. Smith, it would be 21 days ago that it broke up through resistance. Okay, broke down is 0. And then when it broke up through resistance, it was on negative 21% of the normal volume. Okay, so that's how you read this. So obviously I can sort if I want to find stuff that's more recently broken through resistance. Let's go ahead and look for that. What I'm going to do is I'm going to sort this based on the breakup number. And I certainly am not interested in 508. Let's just look for stuff that's maybe broken in the last 5 or 6 days. So right here we had FRT. It broke 5 bars ago within the, actually that would be last Monday. Qualcomm broke last Monday. CVS was 3 days ago. Illinois Tools Workshop was 3 days ago. Live Nation was 3 days ago. Autodesk was 2 days ago. So I think you get the idea. If I wanted to kind of take a look at some of these charts, let's just open up a few of them. I've selected a few of them right here. Let's go ahead and open those up. That's going to actually open up a list for me. And I can actually come in here. Here's Autodesk. What I'm going to do is I'm going to apply that same template that I just applied. It was called the Dynamic Trading Tools. It's part of MetaStock 18. I can go ahead and apply that to the chart. We'll go ahead and click on No, and we can see exactly where that breakout occurred. So let's go ahead and kind of let the data load in. And right here, actually, this is kind of interesting. So right here, we had that longer support support level. going to make that a little bit thicker so you can see it. So right here is where it broke up. Okay. Right here, it also, and this wasn't part of the scan that I ran, but you can see this trend line down. It also broke through that as well. So that might be an opportunity for us to buy. It's managed to hold this resistance area, so now it becomes a support level. Not recommending that you buy it, but that's how you could go in and find stocks that are breaking out. So B, there's the answer to your question that you asked just a minute ago. So that's called the dynamic trading tools. It's designed to help you be able to find those stocks that are breaking out of support and resistance. So let me go ahead and kind of talk a little bit about the next system that we're going to talk about. I'm going to look at the time real quick. I'm going to show this one real quick, just because, well, I'm going to have to. It's 1:34. So the next, this is another tool of MetaStock I like to talk a lot about. It was created by Rahul Mohinder. It's called the Rahul Mohinder Oscillator. Okay. If you're not familiar with Rahul, that's okay. I'm going to tell you about him. Rahul was actually, or is actually, I just talked to him just a few days ago. He's our dealer in India. He's actually been a dealer in India for as long as I've been an employee. I think he started about 27 years ago, which is when I started. He started to become a dealer of the software. Rahul's Indian. He lived in India, and right now he's in Dubai, but he has several offices in India. He's been a seasoned trader. He's a panelist on CNBC in India and CNN in India. He likes to talk about trading and show people how to trade. He's got 4 or 5 offices, and what they focus on is teaching people how to trade in India. He does a great job with it. So what happened, the reason this is in MetaStock is, I'm going to say about 15 or 20 years ago now, he was in our office in Salt Lake City, Utah. Not this one, we were in a different office back then. But one of the things that we were talking to him about is like, we do such a great job, and he does. And he has brought so many people over to MetaStock over the years. We're like, we're curious about what you teach people how to trade. And will you show us? And Rahul, of course, said, yeah, I will. And so what he showed us was this RMO oscillator. And we liked it. We've actually bought it from him. And we have included it in every version of MetaStock since version 10. I've shown it all over the place, and there's a couple of reasons I really like to show it. And I actually have a slide that talks about why I like to show it, because it's easy, okay? I could, and I do. There's like lots of different classes I give where we talk about, how to test trading ideas. MetaStock does a great job with trading things, or testing trading ideas, or scanning, or, how to find stocks, the expert advisor, there's how the forecaster works. And one of the things that I like about RMO in particular is my main goal today is, if you're not a MetaStock user, to help you understand enough about MetaStock that you're willing to try it. We're going to do a 3-month trial, and that'll cost you, if you do our lowest cost option for MetaStock, it'll cost you $23 a month for 3 months. Okay, very, very inexpensive. The reason I like to show RMO is this is easy. If you use it on your trading, I think it'll be helpful for you. And it's not very hard to implement. That means you can use it right out of the box. And if it's helping you make money right out of the box, it's going to be something that's going to help you with your attention to MetaStock. Okay. It's also objective. So if I explain it to you well enough, you should understand it. You should be able to do it, right? It uses solid money management. I'm going to show you how to do stops on it. I better hurry though. It works on a lot of different instruments. You can do it on any time frames. And usually what I'll do is say, give me a stock, and we'll look at your stocks. Because it's easy to go in and say, well, look, this is an example of, I found the stock out of the 5,400 stocks that this worked on last year. And here's a really good example for you. I don't like to do that. It's really easy to find perfect examples. I want you to understand that this doesn't work on everything. But it does work on a lot of things. And it works particularly on things that have a trend or that tend to trend, okay? Because it's a trend following strategy. The trend, and I'm sure you've heard like the trend is your friend, or like a rising tide lifts all boats, or befriend the trend. All those kind of things are a little bit of a cliche, but this is another trend following methodology that's designed to kind of help you identify what the trend is doing on a long-term basis, on a short-term basis. And it's not ever going to help you find the exact bottom or the exact top. The design of it is to kind of help you understand where you're at in a trend and take big chunks out of that trend, okay? And so we'll kind of talk a little bit about how it works. And we will use Meta, Neil, just for you, okay? All right, so the first thing that we want to do when we're identifying the trend, or if we're going to trade with the trend, we need to identify it. So that's the first thing that we're going to do. And what I'm going to do is I'm going to pull up the MetaStock, no relation to us, but the old Facebook symbol, and we'll kind of look at that and see how that works. Now, to apply Rahul's indicators, I'm going to do it all in one step. But to apply Rahul's indicators, all I'm going to do is I'm going to right-click on the template here. I'm going to right-click on the chart here. I'm going to go to Apply Template, and I'm going to find the RMO trade model. I'm going to apply that to the chart, and that will kind of put all of the different indicators that we can use with this. Okay. And then I'm going to actually kind of just zero in. I'm going to scroll out a little bit so we can see some history here. Want to see some big history for you. And then we'll talk about kind of what this chart, or how you read this. Okay. So the first indicator that we're going to use to identify what Rahul calls the primary trend. I also refer to it as the long-term trend or the overall trend. Okay. And the way that we're going to do that is we're going to look right here at this Rahul Mohinder oscillator. Okay. And what I'm going to do to show you how to read this, I'm going to actually just make this indicator full screen, and I'm just going to basically tell you how to read it. Okay. And one of the things that Rahul talks about when he talks about the RMO is keeping things simple. Okay. What I'm going to say is I'm going to look at the very end of this chart, and I'm going to tell you that this RMO, the Rahul Mohinder oscillator, is above 0. And I think you'd all agree with me. Okay. As long as this is above 0, that's what we want to read. It's either going to be above 0 like it is here since and has been pretty consistently since December, then the long trend is going to be bullish. Okay. If it's below 0, which it was consistently there for the previous year, then it's going to be bearish. Okay. And that's the only thing we read from that. Okay. He's very specific. If you go through the training, which you can find on our YouTube channel, he's very specific in saying size doesn't matter, shape doesn't matter. Is it above 0? If so, it's bullish. Is it below 0? If so, it's bearish. Okay. I have to hurry. That's okay. We're going to get caught up here. So if it's above 0, okay, as it has been, you can see right here on the screen, it's going to say that the RMO is bullish. There's a trend ribbon. It actually outlines that for you. You can read it. And like I said, right here is where it did oscillate for a little bit, but right here, it went from being bearish, it was all bearish all of last year, to being bullish almost all of this year. Okay, actually, I think that this went from bullish to bearish just at the very end, just about a year ago. Okay, so if it's bullish, this is rule number 1, we're allowed to buy. Okay, we're not allowed to sell, and it's not a trigger to enter. Okay, very simple. So as long as we're bullish, long-term, we're allowed to buy. Okay, we don't short against the trend, so we're not allowed to short. And just because it went from bearish to bullish here doesn't mean we're going to get in. There's 2 other things that we want to look at. Okay, all right, cool. Step number 2 is going to, okay, and then I can reiterate myself right here. If it's bullish, you're allowed to buy. You're not allowed to go against the trend, and it's not a trigger to enter. Step 2 is we want to look at the short-term trend, okay? And to do that, we're going to use these 2 indicators here, okay? Not both of them. We're actually just going to use this pink one. I prefer to change the color. I'm going to change it, and I think you'll like this more too. I'm going to change it to a filled line, okay? Not only that, I'm going to do that with both lines while I'm in here. I prefer these ones to be filled because I want, actually that's a step filled line. Let's just make it a filled line. Okay, apply, okay. So they're a little bit smooth. That way I can kind of see where both of them are, which will be important in just a second, okay? Right now, what I want you to focus on is this pink line, okay? This pink filled in area, okay? You'll notice that it goes either above 0 or below 0 as well, okay? As with the other, you'll notice it's a little bit more erratic. In other words, it has a tendency to move a lot more in conjunction with the trend, and that's because it's looking at a shorter time frame. Okay, so it's a lot more likely to go from high to low. It's a lot more likely to cross down below zero. It's you're looking at a smaller time frame, and so it's going to be closer to price activity. It's going to be more volatile, like current price activity is. Okay, but we read it the same way. So as long as this purple line is up above zero, I'm going to go ahead and delete my vertical line here, then we're allowed to go long. Okay, so if I'm looking at the hard right edge of this chart, okay, long term I was bullish, but short term I'm bearish. That means I'm waiting right now. I'm not allowed to do anything. I want it to match. Okay, but if we're looking kind of back in time a little bit, if we're long term bullish and short term bullish, I'd still be allowed to buy. Okay, so right now we're kind of neutral, but if I'm looking back here, if I'm short term bearish or bullish and I'm long term bullish, I'm still allowed to buy. Right now, if I'm looking at the very hard right edge of this screen, I'm long-term bullish. We got the bullish arrow here, but I'm short-term bearish. So right now, I can just wait. I'm waiting to see if are we going to reverse here? Are we going to go bullish again? Right now, I want to wait until that short-term trend confirms. Okay. All right. Cool. So step number 2 is to identify that trend, that shorter-term trend. The other thing I want to point out before I talk about how to trigger into the trade is the coloration of the bars. You'll notice we dipped down below zero right here, and as soon as we did, it started to paint red bars. Okay, that just means that short term we're bearish. Okay, when we paint all these blue bars, like we have almost all of the year, with the exception of this last part, when we're painting blue bars like this, it just means short term we're bullish. So you can look at the indicators if you want to, but you can also look at the trend ribbon and the color of the bars, okay? And since the size and the shape don't really matter, whatever you prefer is really kind of the right answer there, okay? The last thing, let me just recap on this slide real quick and check my time. If the primary trend is bullish and the short-term trend is bullish, we're allowed to buy. It's not a trigger. We don't want to, we want to trade with the trend, all right? So let me kind of go back in here, and the last thing I want to talk about is the way that Rahul looks at those trigger points, okay? So what I want you to notice right now is that there are buy and sell points that are coming in on this. There's a sell arrow here, a buy arrow here, a sell arrow here, a buy order here. And I want to explain to you exactly what's happening with that, or what's giving you those buy and sell points. So let me go ahead and kind of zoom in on the chart right here. Okay. And we're going to go back to these two lines. This pink line, as I talked about just a minute ago, is a short-term trend. This blue line is actually the medium-term trend. What we're looking for when we look at these two together is we're looking for the correlation. So right here, let me just kind of say it this way. Right here, our swing trend was trading up above the medium-term trend. And at this very point on the chart, it actually kind of crossed down below the short-term trend. Okay. And when that happens, or the medium-term trend. Okay. When that happens, Rahul calls that a change of direction, a change of momentum, or a shift of force. Okay. And if we see that on the chart, we can actually go ahead and sell at that point, but only, only if we're long-term bearish, which we're not, and short-term bearish, which we're not. Okay. In the meantime, since that signal has actually come on, we're short-term bearish, but we still wouldn't be taking a short position, not until it gets short-term bearish as well, which may or may not happen. Okay. So let me back this up a little bit. And what I want to do is kind of show you how you would use this on a trade. Okay. And let's kind of go back into, and we're going to kind of narrow this down into kind of this area where we were bearish. I want to point out one thing before I zoom in, which is too late because I just zoomed in, but I just want to point this out. And actually, Jake's going to talk a little bit when he comes up about this JBXC, which does a really good job of identifying trend and momentum. And I actually really like that indicator as well. But before we kind of start to talk about trades, like I said earlier, for all of this year, we've been bullish, okay? And during that time frame, we've went from about 116 to about 325, Okay, so without even explaining the money management rules, do you think that just going only long while we have this huge run up in price is going to be helpful? Or how about the year before that where we were mostly bearish on Meta, okay? And we were only going and taking short positions. For the most part, we had a couple of pots where we may have had some sideways trades. But if we're only going short when the market's going down, is that going to be beneficial for our trading? Is that going to help us put the odds in our favor? All right, that's all I wanted to say about that. Let's kind of go in and kind of we'll talk about how you trade with this and kind of how you can use it to identify not only where you're going to buy and where you're going to sell, but where your stop loss is going to be, where your risk is going to be, how to move it. And I have to do it very quickly because we're going to get back on schedule right now. Okay, so going back to the first part of this year, we had a little bit of oscillation, bullish, bearish, bullish, bearish, bullish, bearish, right? If I'm looking right here, kind of towards the first part of the year, actually, this is exactly where I want to look at, okay? If I'm kind of watching the chart, what I'm seeing is a lot of sideways activity. Here, I'm bearish long-term, I'm bullish short-term. I have an arrow here, okay? Here on this particular bar, we get that change of momentum or that shift of force I'm talking about, but we're still just barely bearish for that bar, but we're bullish long-term, okay? It's not until the next bar right here, I'm gonna circle the bar, that we go bullish long-term, okay? So if I'm looking at this bar, and to be specific about the day, this is December 30th. This is probably the last trading day of last year. It is, I just checked, okay? I'm bullish long-term, I'm bullish short-term, and I have my change of force that's in my direction, okay? Now there's two things that I wanna do. One, I wanna identify an entry point, okay? And the way that Rahul teaches to identify an entry point, let me go ahead and delete this here, is he says to look at the high of the bar where you're entering and the high of the day before. And this is the higher of those 2 points. You'll put an entry point right above that, okay? And this is kind of nice because we've been in a channel, right? We got over this channel a couple of times in the last things, but we're a bit in a channel. So what we want to do is verify that it's going to keep going up. And to do that, we just want it to break that high, okay? The other thing that you want to do is put in a stop loss because somebody said it earlier in the chat in YouTube. I can't remember who it was, but he's like, I think money management is the most important part of trading. I think discipline is, but money management is a close second. So if I'm looking here and I want to put in a stop, there's a couple of different ways that Rahul teaches when he talks about the RMO method. The first one is to look at the lows. If I look at this low and I look at this low, I could put in a low. I could put in a stop loss right about here. This is the lower of those two values. Put in a stop loss right below it. That's not the way I like to do it. I like to look for a pivot low. And to look for a pivot low, what you're going to look for is a low that's surrounded by two higher lows. Okay. So if you look right here, that would be, let me grab my line. Okay. Let me grab my line. Okay. This right here, this low right here is surrounded by two higher lows, okay? This one too, actually. So I could actually use that level. I like this one better, so I'm gonna use that level. This is gonna be my stop loss, okay? So what I'm saying now is if it goes up above 121.85, 82714 or whatever, it goes above that level, I'm gonna buy, okay? 121.88, okay? If I buy, I'm gonna put in a stop loss, okay? 111, okay? So now, I don't know exactly what my risk reward is because sometimes the stocks gap, but I have a pretty good game plan. If we come up above this level, I'm gonna buy in. If I buy in, I know what my stop loss is gonna be. And I know that before I trade. I have to hurry, okay? All right, for me, that's very, very important because I don't wanna be making those decisions in the middle of things, okay? All right, so we do buy in, okay? Meta had a run last year. Like it was actually one of my best stocks that I bought, okay? And I did buy Meta last year. Don't hold it right now. But here we have that trigger in. I'm not recommending you buy it now either, okay? Here would be your stop loss, okay? And we had a bit of a run up. Gapped really hard into our favor. And then a little bit later, we have that shift of momentum right here, okay? Put a sell arrow on the chart, okay? And when this happens, when you're in a long position, you're going to kind of pay attention more. But for me, I'm still long-term bullish. I'm still short-term bullish with the blue bars, okay? So the market moves up and then it moves back down a little bit. It doesn't go in a straight line. It kind of takes a stair step or a wave approach, right? So we come up, we test a level, it comes back down a little bit and sets up a new support area and hopefully continues to move, okay? Here we have another buy signal because the market starts to go up a little bit, okay? And at this point, if you're in a trade already, there's two things you should do. One, you could consider to buy more, okay, which I don't usually do. I usually buy over here, okay? So that's optional, according to Rahul. The thing that isn't optional is you should move your stop loss. So if I'm looking here, and it makes a lot of sense, okay, we've went up, we've set a new support level. I want to lock in some of those profits. And so if I come down here and I look at the low here, I'm just going to move my stop, okay? Let's go ahead and zoom out a little bit because I do need to hurry. All right. Here we had another sell. Here I'd probably move up the stop just a little bit, okay? Here we have another move up. It comes back. Here I'd move the stop just to right there, okay? That's the pivot low, okay? Let's go ahead and kind of move over a little bit, okay? Here we had a run up, another gap, okay? Here you had a buy. I'd probably put my stop loss right at that pivot level. Okay, although you could put it here. If you put it right here at this pivot low and you stopped out, you'd be looking to buy again. Okay, you can always buy back in if you're wrong. Okay, but regardless, I'm going to move my stop here. That's not optional. I'm going to move my stop with this buy arrow. That's not optional. And I think you get the idea. The system is really, really easy. I'm just going to kind of zoom out a little bit. We would have stopped out eventually. We move our stop here. We move our stop here. We move our stop here, which is where we get out. Okay. Could we buy back in again with us being bullish? We might have bought in again. We might have stopped out a few times. But again, the idea behind this methodology isn't to buy the exact bottom and sell the exact top. One of my favorite technicians to listen to, just because he was the son of a preacher man, would always say, bears will make money. It was Robert Deal, by the way. Bulls will make money, but pigs will get slaughtered. What I want to be able to do when I'm trading is to identify a system that's going to help me take big chunks out of the trend, okay? And lock in the profits as I go. And RMO is a great way to do that. So that's why I like to show it. Fortunately, we're kind of up on a time limit here, but that's a really, really good system that's been included in MetaStock, okay? And you can look at it. If you've got MetaStock, apply that, play with it. If you're new to MetaStock, you want to try it out, it's one of our favorite systems. And we've included it for free in every version of MetaStock. I've probably done hundreds of demos. And for me, I can come in here. This is Haguro. I don't have time to talk about this today. It's also another cool built-in system. But I can come in here and I can say, what stocks do you want to look at? Let's look at this system. And it's objective, it's simple, it's straightforward, and it does a really good job. I'm going to say it again, one more time. MetaStock's been rated #1 in its price category every single year for 30 years in a row. So absolutely awesome. I use it every day to trade. And what we're going to do here, I'm going to explain the pricing for you. So we have a real-time version that comes with what we call Zenith. It's real-time news and data. Very, very professional news service. It's very much like Bloomberg. Actually, just a news engine themselves. They put $1 billion into designing, has thousands of reporters, hundreds of news bureaus. That's included. Didn't even talk about it today. It also includes MetaStock. That's all included at $265 per month plus exchanges. Okay. We have an end-of-day version of the program that does everything I talked about today. It doesn't have that news. That's why it's a lot cheaper. It's only $69 per month. Okay. And what we're going to do here today is we're going to do what we call an extended trial. So if you buy a month, we'll give you your second and third month for free. That means effectively to try the software that's been rated every single year, the best software in this price category for 30 years straight, you're going to pay $23 per month over 3 months. Okay. You'll pay it all now. You'll just get it for 3 months. Okay. That's going to include MetaStock 18. It's going to include the data for the region of your choice. You can do this with real time too, by the way. We're also going to throw in what we call a white glove installation support appointment, where we'll sit you down with somebody. We'll show you how to run scans, explorations, power tools, anything that you might want to learn to do with MetaStock. We started doing this a few years ago because with MetaStock, it's a tool. It's a tool that's I'm going to call it established. It's not like something that they created a couple years ago that you're going to grow out of right away. It's a mature platform. We've added systems to it like RMO and the other methodologies. But what we want you to do is we want you to be able to start finding it as a useful tool, because we understand if it helps you find better trades, it's going to be something that you're going to want to keep. And so we sit you down with one of our support team. They're going to spend up to a couple hours with you. They're going to answer any questions that you have. We call it our white glove installation support. If you ever have questions, you can call us. They're happy to talk to you. You can chat online with them. They do a really, really good job. And that's always included. And we're also going to include a training package we call Unleash the Power of MetaStock. It's normally $99. It kind of talks about RMO. It also talks about all the other systems that are included in MetaStock. And so you can get that extended trial. You can give us a call at 800-882-3040. You can chat online with us at metastock.com/saleschat. Or you can go to metastock.com/traders-summit 3-for-1. So all of those are ways you can do that. It's a great software program. It'll help you. I think there might have been some questions. Hey, Scott, it's good to see you. No, Scott just said hi. So there you go. All right, if you have some questions, type them in the chat. I'll answer them in the chat because we're on time for the most part. Give this a go, though. I wouldn't trade without it. It's such a great toolbox. Give it a go. If you set up that extended trial today, it's December 11th, you'll be running it until March 11th. And by then, you'll know if it's helpful and you'll be ready to keep it. So give it a go. 800-882-3040, metastock.com/saleschat, metastock.com/traders-summit, traders-summit 3-for-1. So some of the things that we can do that I didn't even talk about, scanning. Oh, we talked about scanning today. Testing trading ideas. It's really good. You can test as many ideas against as many stocks as you want. Our forecaster's patented. We didn't talk about that today either. I do like the real-time commentary, the signals, the alerts that you get. Again, in the US, it starts at 69. Overseas, it starts at 59. Get that extended trial. And if you want to, you can get it with our Trader Summit Action Pack, which would include Wins for Us Victory, the GoNoGo Complete, 3 months of that, Oscar Carboni's Trend Lines and Toolkit, Trend Lines and Training, an add-on that we built with Jake Bernstein called Setup and Timing Triggers, 3 months of Price Headley's Big Trend Toolkit, and 3 months of the Premium Learn MetaStock subscription. So normally all of this will be $3,985. At the event today, it's $1,692. Metastock.com/summit deal, 800-882-3040, or metastock.com/saleschat. So I think I talked about CMT last. I do want to say thank you to Stocks and Commodities Magazine for sponsoring the event today. If you're watching us on YouTube, Neil, hi, it's good to see you. Scott, hi, good to see you. Be sure to hit the like and the subscribe. It helps a great deal. We do appreciate it. And we always have some really good events that we're doing. Well, I think they're good. Hopefully you agree. Anyway, if you're watching us on YouTube, make sure to go to metastock.com/traders-summit and register for today's event. You can get a free magazine. You can also get a bunch of free offers from all of the presenters today. So do that. With that being said, our next presenter is Jake Bernstein. And I have Brian Lotta as well, but I don't see Brian in here today. But did you see Jake? Jake's a good friend of mine. I used to live not too far from him, maybe just like a block or two away, and up in the woods of Northern California. Jake, how are you doing?
I'm doing good, Jeff. How about you and the family?
Oh, doing great. One thing I like about Jake before I turn it over, I always try and kind of think of some things that I like. I like Jake's setup, trigger, follow through mentality. He always has a setup for a trade, a trigger, and a way to follow through with it. And I think he'll talk a little bit about that today. He's going to talk a bit about seasonality as well. Let me go ahead and make you the presenter, Jake. Have you
Oh,
heard from Brian? Is he still coming
Yes,
today?
I just heard from him a few minutes ago. He says he's logged in.
Oh, did he log in as an attendee maybe? Let me see if I can find him. Let's look. Yeah, he's in as an attendee. Brian, what I need you to do, I'm sure you can hear me, is I need you to go and log in with your presenter link. I would have sent that earlier today. I'm going to resend it to you real quick. So give me a second to do that. Let's see, Jake. Because you're logged into the web and I can't promote you to presenter. I need you to log in the other way. So Jake, I'm just looking for that message. Maybe you have like a dad stroke you can tell us while I do that, get that over to him.
Well, let me say this. We can't keep on meeting this way. We have known each other for a long time, and I will say that in the 52 years that I've been in this business, I have met very few people that I respect and like and enjoy doing business with as much as you.
I would say the same about you, though.
If you would, then go ahead.
I'm trying to grab this link, though. Let's see, Brian. Okay. All right. We are getting Brian joined in, but Brian is he logged out. So I know I sent you that first thing this morning, but you can never find it at the right time, right? Brian. Okay, Jake. Okay. I have a dad joke for you, though, since we're killing time.
Do you know what happened to my screen?
Oh, here, I can turn it over to you. Make presenter. Okay.
Oh,
Okay, yeah, I can see it. I can see your screen.
But I can't.
Oh, sometimes turn on,
That is
let me do this. I bet if I do this, you can see your screen.
Yes.
Was my big face in the way?
Now let me see if I can change my screen. Hold on a second, please.
You're fine.
There we go. Yeah. Okay.
Well, here's a joke for you while we wait to get Brian in here. This is one from my daughter. I think it's important to say that.
Okay.
Why did Han Solo not like his steak?
Because he had no space sauce.
No, because it was chewy.
Ah, that's very cute. And how old is your daughter now?
Oh my, which one? But I have my bonus. I have so I'm teaching one of them how to drive, and then so she's 15, and then we're raising 4, 15, 14, 13, 12. We've been raising them since they were 1, 2, 3, 4. So
You got your hands full, Jeff.
yeah, just give them a few years, right?
You betcha.
Okay. All right. Do you want me to go ahead and maybe get started, and I'll go ahead and mute myself and get Brian in here. Does that sound okay?
You betcha.
Okay. Thank you. I'm going to turn the time over to you, though, and I'll let you know when Brian gets in here.
Okay, hang on one second. Okay, I am ready to go.
Saw you.
I want to thank everyone for being here today, for coming to see my presentation. It's going to be difficult to cover everything that Brian and I have to cover in 1 hour, but we'll do our best. So we're going to talk about a few other things today that are very important for traders. First and foremost, the importance of being specific and clear in everything we do. If you have a great trading platform like MetaStock, and they certainly have the very important credential of being here for a long time and being better and better all the time, you have fantastic trading tools. But if you're not going to use those tools, or if you don't understand them, it's going to be very difficult for you to make money. In fact, you're going to lose money, I guarantee it. So today we're going to talk about ways to improve that. We're going to talk about a little bit more about specifics such as artificial intelligence, Can artificial intelligence hurt you or help you? Is it going to be of value to you in the long run or in the short run? And what is it about artificial intelligence that's so appealing to people if you're not sure whether it's going to help you or not? And we're going to talk about the expansion contraction indicator that Brian and I developed jointly. And I will say that Brian, whom I will introduce in just a little while, is one of the few people, as well as Jeff, that I've met in this business that I have any respect and trust for, because there are so many people in this business that are sleazy operators. You just have to be really careful. So first, the usual disclaimer, namely saying that you can lose money trading. And I'm going to begin with a slide that's going to make people mad, but I'm going to do that anyway. And that is this. Is this what traders do? Taking risky action in the hope of a desired result. That's what traders do, isn't it? We take risk, we evaluate risk, and we want a desired result, and that desired result is a profit. How are we going to get there from the entry to the desired result? Well, we're going to talk about that and a couple of ways to do that today. But in addition to that, I'm going to show you something else. The same definition that we use for a trader is the definition of gambling. And the part that people don't like to hear me talk about is that trading is in effect gambling. But if you're going to be a gambler, you want to gamble the right way. Think about sports gambling. Think about the statistics they have available, the team, the record of the team, the specific strategies and how they turn out, the plays of the team, the statistics on making a field goal attempt on a certain down. It's all called analytics. And whether it's a horse race or whether it's a football game or a baseball game, they know the numbers, which is why gamblers are better than traders, because they have specifics they deal with and they know the odds of success. And now that we've added to this equation the ability, the tremendous capability of artificial intelligence, we have the ability to be even better at what we do. Now you're going to find that many trading platforms are going to say, we're now using artificial intelligence. Are they really? And what is that artificial intelligence telling them? I want to give you a little demo on how you can get brainwashed into common thinking, whether you're using artificial intelligence or not. So you have to avoid common thinking. And by the way, I'm going to go through these very quickly because I want to give Brian a good amount of time to talk about the expansion contraction. It's a great indicator that is now available on MetaStock. They programmed it beautifully, and it helps considerably because it is very clear. You always know what to do. So if you're going to be a good trader, you always want to know before you get into a trade, what's your risk, what's your reward, and you want to know the statistics behind your methodology. What price to buy at, what price to sell at, when. And you don't want to analyze. You want to have specific and clear rules, which is what has saved me as a trader, and that is clarity, clarity, clarity. I never want to interpret a chart. I never want to look at a chart and say, I think this might be support, or this could go to here, or it could go to there. I want specifics and clarity backed up by history, and I'll show you what I mean by that. And by the way, Jeff, I'm happy to supply you with a copy of this PowerPoint so that if anyone who wants it here, you can send it to them. So
Gotcha.
These are all the things that people do in common thinking. You don't want to think as a common thinking because common thinking will get you into trouble. Common thinking means you're thinking like everybody else. And if you're thinking like everybody else, you're going to have the same result as everybody else. And that result will be, most of the time, you're going to lose money. This game that we play is not difficult. It's primarily a mind game. There are a lot of things that we do that work, but if we don't do them the right way, they're not going to work. It's really, really simple. And we're going to demonstrate some of that to you today. So if you're going to gamble, do it correctly. Do it with the right process and the right procedures. So here's a little bit about me. I've been trading for a long time and I'm beginning to sound like it. But the good news is that even at my age, I trade practically every day. Not because I'm a day trader, but because I love the game. And a lot of my trades were closed out as day trades because they hit their target. But most of the time, I'm a short-term trader. So these are some of my credentials. I won't bother you with that. You can read it on your own. But what I want to do is I want to move on to the next slide. Just one moment, please. I want to move on to Brian. So Brian, I'm going to turn it over to you for a second. And I'm going to list your credentials here, and you can introduce yourself to the folks, and then we'll turn it back to me, and I'll take it over for a while, then I'll turn it back to you. So
Thank
Brian,
you for that, Jake. I'm
Yes.
here.
Okay.
Thanks again for that. So as you can see there, I have been trading since 2000. I did start learning to coach right off the beginning, as I learned from a program that was also teaching coaching on that one. I did start in the retail currency markets and have moved on into stock options and become let's put it this way, I will say not an expert, but a specialist in stock options. So again, you've probably read through all that. I don't need to reread it to you, but I've been around for a little while and will still make this promise today. I'm not going to tell you something I can't prove, and I'm okay with making that bold of a statement. So Jake, back to you.
Okay, Brian, thank you very much. And thank you, Brian, for supporting me in this venture. There are very few people, as I've said, in this business that I enjoy working with as much as I do you, and who I trust. And that's the most important thing. So let's go forward. So, brief word about discipline. People say, Joe, no wonder you can't make money trading. You don't have discipline. Joe thinks about it. He says, you're right. I don't have discipline. Where am I going to get discipline? Someone will say, well, why don't you read a book about discipline? Well, it's not going to come to you out of a book. Should you go to a therapist? Can you get it from magic mushrooms? Where does discipline come from? Discipline comes from knowing what you're doing, which means you have confidence. You can't have confidence in what you're doing if you're constantly looking over your shoulder trying to figure out whether this is a buy signal, a sell signal, how much to risk, does the method work, what's the odds of success, and so forth. You need to know that before you do it, and you need to see it working over and over again. And once you do, you'll get the confidence you need. And from that confidence, you'll have discipline. The discipline will give you more confidence because you get better results. And it's a virtuous circle. So let's talk about this. No matter what we teach you today, no matter what you get from MetaStock, it ain't going to help you unless you have the discipline. The discipline is going to come from knowing what you're doing. You ain't going to know what you're doing unless what you're doing is totally clear. Buy here, sell here, take your profit here, maximize your profit here. Don't look at the chart and interpret anything. It has to be crystal clear. So I like red light, green light, yellow light. Really, really simple. And that's basically what we're going to keep talking about today. So at your leisure, if you get the PowerPoint presentation, you can read some of these examples of emails that I get. And I get many, many emails every week, but they're all pretty much the same. They've been trading for a long time. They keep on losing money. They don't know why they're losing money. They're spending so much money trying to make money. They're buying this software. They're buying that software. They're doing 2 or 3 hours of homework a night. They're looking at stocks. They're looking at charts, and it's not working. Why? Because it's not clear. You can't make money with anything that's not clear. So today we're going to focus on clarity. And how are we going to do that? Well, you can read about this peculiar paradox, which is very simple. And that is this. Commissions are lower than ever. Technology is more powerful than ever. Activity in the trading markets is more active than ever. There's more information than ever. There's algorithmic strategies. You can trade by computer. There are more analytical tools than ever. And so the question is, why is it that most traders still lose money? Again, it's because they don't have clarity. So we're going to give you some clarity today. And here we go. Let me give you an example. When we trade, we know there are facts and there are fictions. Many things are fictions. I could name a few of them, a few of the methods that people follow, but I don't want anyone to get pissed off at me because these days, no matter what you say, someone's going to get mad at you. So let's suffice it to say, most things that traders use don't work. They never worked and they never will work. Therefore, you need to find things that work. And how are you going to do that? You're going to do it with back testing. And when you have a good trading package like MetaStock, you can go back and you can test your methodology. I'm going to show you some true facts that are clear and consistent, and they're indisputable. So there's no way to misinterpret this. I'll show you what I mean. Let's just keep going. I want to get through the psychological stuff. Oh, by the way, in my spare time, I wrote a few books on trading. Now let's talk about solutions. Can artificial intelligence help you? I want you to think about this. Artificial intelligence is transformatory. It is the best, most incredible tool we have ever had that can either save the world or destroy the world. That can either save your trading or destroy your trading, but it depends on how you use it. I want to give you some specific examples because I had a chat with GPT and I wanted to show you what happened. Let's begin this way. I have a trading model, and if there's any one thing that I'd like you to come away with from today's meeting, if there's nothing else I can teach you, it's this: setup, trigger, and follow through. If you use this trading model, you will be successful if your underlying methodology is even slightly profitable. Setup is a pattern. There are many, many patterns in the markets. You've seen the patterns: trendline support, trendline resistance, flags, pennants, breakouts, reversals, key reversals, Fibonacci, Elliott wave, Gann, and so forth. These are all setups. A setup is a pattern, and the good news about patterns is there's many of them. The problem with patterns, most of them don't work. So when you have a pattern, that pattern needs to be triggered, and that trigger is a very simple indicator. It's called timing. Once you have a trigger, you need follow-through. Follow-through tells you where to get in and where to get out. So let me show you something. I'm going to skip all this for just a minute, because I want to give Brian an opportunity. One of the best patterns that you can use is seasonality. Seasonality not only has a huge database behind it, not only can it be researched, not only can it be proven, but it's clear and consistent and has been around for many years. Let me give you an example. Let's talk about pre-holiday behavior. Example of seasonality. In the last 62 years, if you bought the day before Christmas and got out the day before that, let me give you an example. Christmas is the 25th of December. If you bought on the close of trading the 23rd and got out on the close of trading the 24th, which this year happens to be a Thursday and a Friday, your accuracy would have been 69% over the course of many years. It's a fact. It's not a theory. It's a fact. This work, including things like Thanksgiving, has been accurate for many years and was first developed by a man named Art Merrill, who wrote a book called The Behavior of Prices on Wall Street, a book that all traders should read and own, which described pre-holiday seasonal behavior. So because this is a fact, because seasonality is a fact, I wanted to ask the question of GPT chat and see, did it find this pattern? Can we use GPT chat in order to develop trading strategies or to get ideas that will work? Because remember, when you pose a question to the chatbot, it's going to look at 17 trillion, that's trillion with a T, bits of data repeatedly while you're asking that question. So it's going to look at hundreds and trillions and thousands of trillions of pieces of data points to determine if what you're looking for is there. So we can take this seasonality, for example, a seasonal chart, taking all of the years of the Dow Jones from 1901 to 2022, that's over 120 years of data, and making one chart that shows the typical behavior of the stock market with statistics, namely that December has been up 61% of the time in the last 120 years for the first week of December and so forth. So we have these numbers. These are hard numbers. We know, for example, that the first 3 weeks of April have been very bullish, predictably bullish, and the percentages are down here. So because we know this for a fact, we want to be able to test the AI robot and determine, is it accurate? Let me show you what else we know. From our research, not AI, my own research, we have determined that since the start of trading in S&P futures, if you were a buyer on the end of the day, October the 26th, and you got out end of day January 16th, which is for most people a long-term trade, you would have been right 85% of the time with an average profit of 6.3% and an average loss of 5.55%. In other words, all the numbers right over here, max consecutive losses, max consecutive wins, everything you needed to know. This is a hard, cold fact. No interpretation, no disputing, and it even gives you a stop of 12% with this whole strategy. Now, people are going to say every year is going to be different. Well, we had this trade before the fact. What happened? Well, not only did this trade work, but let me show you. It worked to the tune of 12.05% long before the exit date. And this was the entry right over here. And we knew that way ahead of time. Truly remarkable. The question is, were we able to get the chatbot, artificial intelligence, to find that for us without having to go through the coding and the programming and all the rest of that stuff? So I went to chatbot and asked it a question. In the last 50 years, how often has the S&P index been higher at the end of the day, January 16th, than it was on October 26th the previous year? Very simple question. Artificial intelligence went through a whole rigmarole and gave me all kinds of data, gave me all kinds of data sources, but didn't give me the answer. It gave me all kinds of stuff I didn't want until I knew for sure if it worked. Gave me the average increase, all that stuff, which we found by manually. Now, all of this stuff was good, but I needed to ask the question a different way to get the answer. So I went back to the computer and I said, why isn't it giving me the answer that I want? So I asked another question. I know that Alcoa, showing right over here, seasonal chart, has been very strong in the last 2 weeks of December, predictably bullish right over here, starting actually in late October. So I asked the question a different way, and I said, is there statistical evidence to support this? Well, it did come back and it gave me what I wanted and said that 60% of the time, Alcoa stock outperformed the S&P in 30 out of 50 years. So if I go back to the chart, I can see the numbers here between 60 and 70%. So I know I have something. So now it's time to get even more specific. I went back to the computer and I said, show me the pre-holiday effect. And this is exactly what AI was looking for. What is the pre-holiday effect in the stock market for this particular time in Christmas? And it gave me exactly what I wanted. And it said, this means that the stock market was up on the day before Christmas about 76% of the time. And guess what? This research right over here that we did was 69% over the last 100 years. And so the computer came in a very nice, accurate description of what we needed. And we have just now begun starting and asking questions. So the computer found exactly what we wanted. And it only took asking the question the right way to get the answer we needed, as opposed to writing a program that took weeks and weeks to do. So we asked it another question. And that question was this. Thank you, I said. I understand the caveats. Can you give me the same statistics for July the 4th, Independence Day? And it gave me 84%. What does that mean? It means that 84% of the time, if you bought on the close of trading the 2nd of July and got out on the close of trading the 3rd of July, you were profitable. A very small period of time, a very circumscribed period of time, but a very powerful statistic. And this is how we find patterns that work. And now we can ask the chatbot, but here's the important thing. You must ask the question the right way. Otherwise, it's going to be garbage in, garbage out. I'm going to report more on this if I'm invited back to another MetaStock webinar, but right now, I wanted to share that with you. Let me show you what it said for Labor Day. And again, I said, I think I'm finally able to communicate with you and you understand what I want. Can we do the same statistics for USA Labor Day? 83% of the time. So even though this is a short-term trade, we're doing intelligent gambling. We know the odds of success. We know the history. We know the probability. All super, super important. Now, what are we going to do next? Well, today, Brian and I are going to present the expansion contraction indicator, which has been beautifully programmed on MetaStock. So I decided to ask the computer, tell me what you know about expansion contraction. And it gave me this stuff right over here. And it actually said that it was developed by Jake and Brian. Very interesting. But guess what? It gave us all of this stuff right over here. And Brian, when you developed this with my work, was any of this taken into consideration?
No, it wasn't, Jake. So it didn't entirely give an exact answer. It definitely needs to be double checked.
Right, and it had what in AI terms is called a hallucination. It went and found stuff that was not related to what we wanted, but it gave it to us anyway, which could really throw you off course. But the good news is it gave the expansion contraction website and found it on its own. Now, Brian went back and did some further discussions, which I'll let him talk about if there's time. I'm sorry, I'll ask him to talk about it if there's time. But this is a very interesting situation. So what does it mean? It means that if you took the chatbot seriously and you formulated your question the right way, and think about the possibilities, you can ask questions about Fibonacci, Gann, Elliott wave, the golden cross, the death cross, and ask the question. But if you ask it the right way, it will go out there and find the right statistics for you and help you immensely. But if you ask the question the wrong way, it's going to mess you up badly. Now, let's get on with something else. For many years, I've had this methodology called the moving average channel, which has also been programmed very nicely in MetaStock and is part of the package that Jeff is offering today. But Brian Latta and I have been associated for quite some time, and Brian was able to take this concept and turn it into something much more beautiful, because we know that the characteristics of the moving average channel are such that when the channel narrows and when the channel widens, it's predictive, it means something. So Brian was able to take this and put it into actually program language and develop it into a strategy. So I'm going to give this to Brian now, and he's going to finish up, and I'll come back and chime in from time to time. Brian, it's all yours.
Thanks again for that, Jake. And of course, you have control over the slides as they move forward. So if you do want to move ahead on the title slide here, this is a concurrent indicator, unlike most lagging indicators. And that means it does update on each bar. And so it's a concurrent indicator. It clearly displays long-term trends and their short-term swings up or down graphically. And of course, this 10-year chart of the 10-year notes is showing you exactly what we see over time. We can see where the bottom indicator is showing an expanding cloud or cone in the background, which is the green shaded area as the long-term trend. And the short-term swings are the two lines. And then so quite simply, if we're short-term bullish and long-term bullish, it should be the strongest part of a move up. And then this will show us an additional, well, there's 32 tradable characteristics with this, but an expanding market may be bullish or bearish, but it would be the strongest part of a move up or down.
Can I jump in for a second, Brian?
Sure.
So shown at the top of the chart are two moving averages. The blue line is a 10-period simple moving average of the highs. The green line is a simple 8-period moving average of the lows. These two form the channel. When prices are in an uptrend, the bottom of the channel serves as support. So if you know that you're in an uptrend, which is clearly defined here, you want to buy the bottom of the channel. And if you're a short-term swing trader, you get out at the top of the channel, you place a stop at break even and let your profits ride. In the middle of the screen is two indicators, Williams accumulation distribution, which is the green line, and its moving average 57. That's 5/7 simple moving average. In the moving average channel methodology, when you get two complete consecutive price bars above the top of the channel, and Williams is above its moving average, we go into buy mode. The cone, which is either going to be red or green, goes into buy mode when it changes from red to green. And the changeover is generally clean, for lack of a better word, by which I mean it doesn't oscillate back and forth between red and green and red and green and red and green. So Brian did a beautiful job with this, because the one thing that's most important to me is the consistency of the trend. In other words, When the methodologies turned bullish right over here, they stayed bullish for a long time. And that's where the big money is going to be made, no matter what time frame you're trading in. So within the cone, Brian also highlighted these two little lines, which indicate the shorter term trend. The methodology works for you depending on how you use it. In other words, I like to not pay attention to the little trend over here because I'm going for the big move right over here, no matter what the time frame is. I'm going to show the next chart. Brian, it's yours.
On this chart, Jake's actually showing where we were expanding with the rising green arrow, not only an expansion contraction, but up below price, trending higher. And then with the red arrow down, the cone in the background with expansion contraction was getting smaller. And of course, a contracting market is losing momentum. It may be a correction. It may be a reversal. But ideally, of course, we're just looking for those corrections in order to, say, buy the dip at or near support in a defined uptrend and give us clear signals. As the market's either expanding or contracting, the values help tell us tradable information.
Yeah, for me, it's really, really simple. I'm just going to go red to green. When I've been red and I'm green for 2 consecutive bars, I'm long the market. When I've been green for a long time, and then I turn red, I'm short the market or I'm out. It's really simple for me. So let's take a look at another chart, Brian.
And on the E-mini here, this has shown, of course, it's the NASDAQ E-mini, shown a bear trend on here where expansion contraction did start to turn bearish as turned red and continued on lower. Of course, you'd be selling at or near resistance if you weren't already in. And of course, that just gives us clear setups on whether or not we should be bullish or bearish and for how long.
That's right. And the one thing I want to emphasize to the folks that are watching is this. There are very few indicators that will turn direction and stay that way for a long time. And on top of that, give you opportunities to take advantage of the situation. Just think about this. When you first see this, you're bullish. Then when it turns bearish, like so, you're not going to believe it. You're going to say, well, it's going to turn green again. But then after a while, you realize you should have been short. The methodology gives you an opportunity to take advantage of this situation and sell right over here, or sell here, or sell here, or sell here. But eventually, it's too late. So remember, it's a very forgiving methodology because it gives you the opportunity to take advantage of the trend. And you can't take advantage of the trend unless you know the trend. So I'm not sitting here and making a decision. The long term says this, the short term says this, the weekly says this, the daily says this, the hourly says this, the 5 minutes. I'm not doing any of that stuff because believe me, in my 52 years of trading, I've been there and I've done that and it doesn't work. So the bottom line is, no pun intended, find your direction, trade with that direction, know the statistics in terms of entry and exit, know the risk, know the profit target, and it will serve you well. And remember, don't spend too much time on it because the more time you spend looking at the chart, the more interpretations you're going to have and the more your imagination is going to take a hold of itself. It's either in or out or nothing. Let's go to the next slide.
Okay, Jake, on that, first impressions are going to be true. And like the book Blink, I believe it was Malcolm Gladwell, your first impressions are most likely to be right. But on this one, which is showing the green arrows up, the trend is down by the big red arrow falling over time and the cone on expansion contraction being red and bearish. And then we had some short-term bullish corrections. But again, on that, adding to a winning trade is a profit maximizing rule that I'm certainly taken from Jake's, coaching. If you can add to a winning trade and have 2 or 3 or 4 positions building with just the risk of a single trade, that would be ideal. Okay.
Oh, yep.
So
yep.
Definitely. This is just again explaining that it's the strongest part of a move, and this chart that just was up there briefly was showing just about all green, and all that was really showing again was the strongest part of a long-term move up. And there are clear rules based on Jake's trading methods here that I've shown back-tested over time, over 5-year back tests, trading the expansion contraction buy-sell setups that are showing here. Have had approximately 57 to 67% win rate over the last 5 years. with better than a 1 2/3 to 1 profit to loss ratio. And admittedly, of course, we've been in trending markets, so I have to take that with a grain of salt.
Well, that's true. Yeah, but remember, the most important thing is this. I always want to know the trend. And if I know the trend, I know where to buy and sell. And that's what a good methodology will give you. Let's go on to the next slide, Brian, and you can take it from here.
A downtrend in this instance, of course, you can see the red lines below on an expanding cone or cloud. We're just seeing where some of the strongest parts of the move down were on that, giving you opportunities, as I said, to either be in or stay in or add to winning trades long term.
And you'll notice for the purposes of illustration, we've not cherry-picked charts. We're picking charts that are very commonly traded, very widely traded. So we're not just saying, let's find a stock that's been in a big uptrend and look at this expansion contraction. For example, this chart is the NASDAQ E-mini. Here's another chart. This is a 3M. These are all very popular stocks. And again, I want to point out to you that the down move, and by the way, there's a question. Question is this: if you've got two different trading methods that are related to each other, which one do you do? My answer is very simple. Take the one that triggers first. If the one that triggers first is too risky for you, take the next one. But it's very possible that the next one will not give you an opportunity. In terms of risk, the risk is twofold. Number one, you're long over here and you change to short. So the risk is the reversing signal. Secondarily, the risk would be 2 times the width of the channel. So that if I get a sell right over here, I'm measuring the width of the channel, like so. I'm doubling it, and my risk will go up there somewhere, which twice the width of the channel. So over here, for example, we switch from a sell to a buy. This is my buy signal. Here's my opportunity to buy the bottom of the channel. I measure the channel, I double it, the stop goes somewhere down here. The first profit target is the same. You're taking the risk, you're taking the width of the channel, doubling it and adding it to the close of trading on your entry, and that becomes your first profit target, after which point we can get out of danger, take some money off the table, and get on board for the free ride. So what I'm going to do now, Brian, is I'm going to let you take the next few charts and comment on them. And when you want to change the chart, let me know and I'll change it.
Okay, thanks, Jake. So again, we're seeing a downtrend basically with short-term upswings, typically maybe 3 to 5 days. But then those are giving us opportunities to sell at resistance in this downtrend after a weak correction. And then ultimately at some point we get the trend reversal moving over towards the end of October. And the idea is you do want to have clear signals with specific rules, as Jake says, rules to get in, rules to get out at a loss, rules for taking profit. And the rules that at least was mentioning on the back testing, we're using Jake's rules on the moving average channel stop and target. And at least for a little more background, that did actually show on some of the top weighted stocks over the last few years in the trending markets to hit 3 to 1 profit target some 30 to 40% of the time. So it was exciting to see bigger winners more often. Next chart.
Righty, here you go.
And again, that's just a recap again, showing the strongest parts. Again, it's going to identify all that. If you want to go to the next chart, we'll just want to look at charts pretty quickly because we will start to see a little more detail here. Of course, Jake and I have done a couple of webinars on all of the rules and all of the definitions, how to interpret it and how to utilize it. And of course, this again is just showing the strong bull trend on the far left bottom when we were seeing the green cone expanding, changed to a downtrend in August and then continued that all the way till October. So we see 3 trends here, up, down, and then up again. And when the expansion, contraction, long-term and short-term are very narrow over where Jake's pointing, it's a non-trending pattern. It actually is using standard deviation and normal distribution for those who understand the math in there. It's just, is the market normal? It's going to be inside the lines. If it's strong up or down, it'll be above that upper gray line that Jake's pointing to. So it's a strength and weakness indicator too.
And let me say one more thing, if I may. It is very difficult for any trader to stay in a position for this long, unless it's a losing position. Traders love to get out of their profits quickly, but they love to keep their losing trades till they grow hair on them. And none of what we're talking to you about today is going to help you in any way, shape, or form if you're ready to give the market a lack of attention. If you're sitting there and analyzing every twist and turn in the market, you will not be in. You will find a way to get out, and then you'll be very unhappy because you missed the big move. Next slide, please, Jake. Here you go.
There you go. And on that big move too, the trailing stops on, say, ultimately like third targets, they're counterproductive. Time limiting exits. You want to get the big move. Big money is made the big move, like you said, and try to not get yourself kicked out. But did put up the chart, and the second one, of course, showed the first was the trigger to get in, and then the fact that we have gone higher. All of these are measurable moves, and as said with Jake explaining 2 times the moving average channel is the initial risk. On that one, you can see, of course, the next chart will show that this has gone higher since the buy trigger. Again, just to generally show, most of these will have followed through after the buy or sell trigger, just not all of them. So again, a big, a variation here. This is the Japanese yen, and that one did trade higher after the signal.
Let me say one more thing.
Sure.
A lot of traders fancy themselves to be swing traders. So what they will do is they will look at the moving average channel and they'll say, well, this is a wonderful tool. The trend is down. I'm going to sell over here, buy it back over here. Sell it over here, buy it back over here. Sell it here, buy it back over here, and so on and so forth. They will trade, many, many times, only to realize that they made from here to here, maybe they made 16 trades. They could have made just 1 trade and spent their time doing something productive. And that 1 trade made more money than all 16 trades combined. So it's one thing to say you're a trader. It's another thing to say you're a trader who makes money in the long run or in the short run by keeping trades that are winning and getting out of trades that are losing. It's really, really simple. It's all logic. You've heard it a million times before. The question is, are you going to do it? So if you're here to learn short-term methods, that's great, but make sure that the short-term methods are actually giving you something for your return, because if not, you might as well be working at McDonald's. Let's go to the next slide.
Again, we have a buy set up here in mid-October, and the euro dollar that did trade higher, and that's actually still in an uptrend. I've had some comments about with price falling like it is now, that is just a correction so far from a trend. And of course, you can see we are still higher than we entered. Fortunately, that would have had profit targets. There's 2 that are already hit, and it's just at break even. So we can go to the next chart. We're just trying to show some quick practical examples. You get a trigger, and then what happens after the trigger? We get price to go higher. And there have been 4 to 5 add-ons in there since the original trigger. And I will say, if you're willing to add to a winning trade when you have no risk in a big move, you'll take a big gain and make it bigger on the same risk you're already taking.
Let me add one thing into this. In my career, which has been many years in the making, I have made literally thousands of trades, maybe hundreds of thousands of trades. And I have found that less is more. The more I trade, the less I make. The less I trade, the more I make. The more time I have, the more time I have to live my life. But if I'm going to sit in front of that stupid machine all day, I better make sure that I'm learning that I know how to use the methodologies to get the maximum results from my work, because time is very valuable. I have found that the less you trade, the more you make. And think about that. You've probably heard it before, but it is true. And here is another chart, Brian.
Yeah, there's actually a losing trade. We have had, a winning trade. We do have a sell trigger. And right now with the green line dropping down over the last 3 days, we have seen price drop slowly. So this is just up a little bit in Alcoa, which is a little counterintuitive to its seasonality right now. But still looking for a buy trigger here. Take advantage of that.
Correct. And here you go.
Here's the losing trade, right? Have had a sell trigger, and over the last 4 days since the sell trigger, price has gone up slightly. So Eli Lilly right here, although it has had a sell trigger, is down slightly, not stopped out. There's a bigger move in here in Roblox. So again, you can see trade set up way back in the beginning of October. Yep, looks like the middle of September. And then did trade higher since then. That would have hit multiple targets and has several add-ons. Again, these are the ways to take a trade with a single amount of risk and turn it into a big winner.
And if you don't already know this, if you've been trading for a while, you're well aware of the fact that there are very few indicators that are going to keep you in trends for a long time. They're going to jack you around back and forth and cause you to interpret and analyze everything. For me, I don't use the analysis. I just say, look, I am bearish, I'm bullish. You don't need too many of these moves each year to make a huge amount of money. You need simply to do what you're supposed to do. And once it's done, the rules are very simple. If you're trying to figure out exactly what to do every day and you're not sure, then you're using the wrong methodology. This shows you what to do every day. Are you bullish? Are you bearish? If you're bullish, where are you buying? If you're bearish, where are you selling? If you're already in the trade, what are you doing in terms of stop loss and trading stop, etc.? Let's go to the next slide. And that's right.
And you're also in another big move. Sorry, Jake, on that. But of course, I just wanted to make a comment on that too, since, you are saying that if we can get in and stay in, we will get the big moves. And most people will cut those trades short. So if you're not going to stay in and let those play out with some discipline, then you're just going to miss out on the big moves. And how do you find them is the wrong question, because I don't think ChatGPT could answer that either. They happen in what you trade consistently.
That's
Would you
right.
agree?
Absolutely.
So here's another winner.
Yep.
Showing a buy trigger.
That's correct.
And another one. These were just charts you set up, and I just plotted where we basically would have had the last trigger or so and what's happened since. So these weren't cherry picked. They were just presented. A bear trade that's up. Clear entries, clear exits, clear rules. This has been a little wobbly, but still up. Would have hit targets.
That's correct.
That's gold. Bigger move up in Microsoft. Microsoft is one of those tested for over 5 years. Now here we've got a bull move that did turn to a small loss on a bear move at the beginning of December and has turned bullish in the last 2 days. So at least right now, Meta bullish.
And remember, I have a concept called the danger zone. The danger zone is that period of time that you're most apt to get stopped out, which is the period of time from when you get into a trade. Once you hit your first profit target, you're out of the danger zone. So I'm not trading to make money. I'm trading to get out of danger. After that, the money will follow. So if you can consistently get out of the danger zone, after you reach your first profit target, your stop goes to break even, let it go and do its thing. That's the most important thing I can tell you. So even if you don't like the expansion contraction, even if you don't like me, even if you don't like Brian, you will like the moving average channel because it will help you. So remember that by the time this happens over here, you've already had your winning trade from here. You've reached your target somewhere over here. You trail your stop. By the time you get a reversal in trend, you've been stopped out much higher than that and you have nothing to worry about. So that's all there is to it. Once you're stopped out, you're waiting for the next signal. Once you're stopped in, you're waiting for the profit target. It couldn't be more simple. And let's go on with this. I think we still have a few more slides left, Brian.
This is on a buy trigger and what's happened post buy trigger. There have been 2 additional add-on trades on that one. And of course, we would expect Bank of America to continue higher until it gives us a reversal, at which point we'd go short or be bearish on that case. Netflix. Well, currently Netflix is bullish. Didn't get a chance to mark that one up, but you can see we did have a buy trigger back in October, and then that's had a nice move up through November and into December. Right now, we're just in a bearish correction and an uptrend still. Your buyer at or near support in an uptrend. This is another buy trigger. NVIDIA is still showing bullishness. So I did pop this up at the end on here. Obviously, I'm a little bit biased on what the indicator does, but with 32 tradable characteristics and back testing based on Jake's methods, this has just been an enjoyable process to try to get it out to everybody since it has been so consistent in so many different markets.
So if you're interested, you can reach Brian at this address. You can reach me at this address if you have questions. And Brian, you want to tell them about the expansion contraction website?
Expansioncontraction.com has the download page. If you have other broker platforms and you're looking for other versions, it is available for many other versions. And so again, we just wanted to make that available for free. And again, if you are emailing about questions, it's free. We're not looking to get anything out of that except help you become consistently profitable, preferably.
Thank you, Brian. And Jeff, you were saying something about expansion and contraction being included in one of the products you have?
Actually, it's as long as you have MetaStock 18, it's available as a download that you can just grab. And we're working on kind of an enhanced version, but it's not available yet. So get the free version for now. And you can do that at the link right here, right now. So, and it's designed to work in MetaStock. So
great.
18 and higher.
Thank you. And Brian and I are happy to take questions if there are any.
Yeah, if you have any questions for Jake, I don't see a lot of them coming in. Let me just look at the YouTube as well. No, not a lot of them.
Then it must be crystal clear.
Exactly, yeah. Well, I always think you guys do such a great job, Jake. And I really do thoroughly enjoy working with you. So,
and likewise. Thank you. And we try to keep it simple. Thank you, Brian, so much. And thank you, Jeff.
All right. Very cool. I also want to talk a little bit about the setup trigger follow-through methodologies that we designed with Jake. And so let me spend just a couple minutes doing that. Let me go ahead and kind of just make a couple changes really quick here. And let's see, let me make me the presenter. All right, show by screen. And let me just kind of talk a little bit about what's included here. I guess I should probably turn on my lights and my camera and all that kind of stuff. So we did actually kind of sit down with Jake, and we've created a very popular add-on called Setup Trigger Follow-Through, or Setup and Timing Triggers, which uses Jake's methodologies of setups, triggers, and follow-throughs. In total, there's about 33 commitment of trader systems that are in there. So if you're interested in futures at all, you can use us. We also have 6 technical systems that are based on kind of Jake's work and kind of the things that Jake does with his work. Here's a list of them. I wanted to kind of highlight one of the ones that I like a lot. It's called the JBS Power Momentum. So this is one of the 6 that's included, and it looks for divergence between momentum and price. So let me kind of come in here. I ran a little bit of an exploration already, just so we could kind of keep, I already showed you how easy it is to run scans and all that kind of stuff. But right here, what I did is I ran the power momentum signal. And today we had one long. Now this is, I'm not recommending you buy this today, and one short lead us, okay? So let me just kind of come in here real quick. Let me go and I preload a test. You can test these trading ideas as well. It comes with a system tester. But what this is going to look for is it's going to look for a divergence between the price up here and the momentum down here. And if it sees a divergence, it's going to set up and then trigger into a trade. So just kind of zooming into this chart right here, what you've got right here indicated by the diamond. Yesterday we had a setup. And so I'm going to kind of move the commentary one back day. And it really doesn't say anything for that setup. So let's go ahead and go forward. Today we triggered into that trade, okay? And so when it triggers into a trade, it's gonna say new long trade has been triggered. Traders should look to buy this instrument. You should set up a specific dollar stop loss and a profit target for this trade. And here are your suggested stops. So your first profit target would be 143.75. Your second profit target would be 151.31. with a maximum loss of 121. So with this one, then it's going to kind of drill in. It's going to tell you a little bit more about what's kind of what it's looking for that trade. But what I like about Jake is he specializes in objectivity, and he always wants to use a setup, trigger, and then a follow-through methodology. This one's really cool because it looks for divergence. But in addition to that, you've got a 15-minute opening range breakout. You've got a 5-bar MAC, which is kind of like the JBXC. That's what those are defined around. You've got the MAC with AD MA. You've got the momentum versus the moving average. the power momentum and the stochastic pop. So all of those are testable, so you can throw them into MetaStock, you can test them. In addition, you can scan for them, and of course they all do that setup trigger followed by the follow through. So normally it's $4.99. It's a one-time cost. It comes with a 30-day money-back guarantee, so you can try it, evaluate it, see how well you like it. $3.97 here at the summit. Excuse me. Give me just a second. Kind of have to lubricate the voice box after 7 or 8 hours. To do that, you can give us a call, 800-882-3040. You can go to metastock.com/sales chat. And it is actually part of our Summit Traders Action Pack. And just the stuff that's included today, you get wins for us, victory, 3 months of the GoNoGo charts, Oscar Carboni's training on trend lines and breakouts, Jake Bernstein's setup and timing triggers, Price Headley's big trend toolkit for 3 months, 3 months of Learn MetaStock, and Unleash a Power MetaStock as well. So normally the cost on that would be $3,985. Here at the event today is $1,692. You can do that at metastock.com/summit deal. Just going to put this in the chat. You can also call us. We'd love to talk to you. 800-882-3040, or you can go to metastock.com/sales chat. Again, I did talk about this right before Jake went. If you want to try out MetaStock, maybe you haven't tried it before, 30 years in a row, it's been rated #1. Scanning, testing, forecasting, real-time alerts, commentary, signals. You can get an extended trial by giving us a call, or you can actually go to that page as well. So 800-882-3040 or metastock.com/sales chat. All right. Before we finish up today and go to the last speaker, the finale, if you would, do want to say thank you to one of our sponsors, who happens to be our next speaker. CMT Association has sponsored the MetaStock summits and conferences for a few years now. They're a great partner, a great sponsor of the events. We appreciate them. I love being associated with the CMT organization because it's such a well-respected organization. Tyler is about to come in and he's going to talk about how having a CMT might be beneficial for you, might help you, especially if you're looking to get assets under management, if you have assets under management. So we introduced Tyler just a little bit ago. We love having Tyler on. I love this particular talk that he's going to do, kind of the examples that he uses. But Tyler, let's go ahead and get you going again. How are you doing? Did it change between now and a few hours ago?
The day has been a busy one, Jeff, but all in all, very, very good. How have you been? You're busier than anybody I know.
I don't think I've just been sitting here watching people talk. It's awesome.
A great thing to do with your day. So much to learn from so many excellent speakers. And I appreciate everybody who's still on the line checking out this session. What I hope to do in this last hour is maybe summarize, maybe bring together a lot of the ideas that have already been covered. I'm a huge fan of Jake Bernstein. What an incredible mind and an innovator in the space of technical analysis. Jeff mentioned the CMT Association. CMT stands for Chartered Market Technician, not country music television or certified massage therapists or whatever else you might associate with the acronym. And so I'm not speaking on behalf of myself, but on behalf of the whole global community and our board of directors and the many men and women of Wall Street and Bay Street and Dalal Street and everywhere else in the world that have contributed to the body of knowledge that we define for responsible practitioners and professionals in the field. So let's dive right in. The organization exists for two purposes. We're here to help people improve their investment decision-making, investment performance through process and tools. So that might be you. And we're also here to help open up career opportunities, to make sure that the wider financial services industry understands what we mean by technical analysis and how responsible practitioners approach markets using these tools to help differentiate from perhaps some of the less responsible work that's out there. We do that through a number of different things, including professional ethics, a lot of educational content for and on behalf of members, of course, the credentialing program, which I'll talk about a little bit, and then that wide global professional network. And I think for everybody on this line, you've probably already felt that feeling of trading can be a little lonely, it can be isolating, and it's really great to have a network of peers to help you understand what's working, what's not working, test out ideas, get some feedback, be a part of a community that can help elevate your game. So a little background on the association. If you've never heard of the CMT Association, it's actually over 50 years old now. We celebrated the origination, the final filings of a New York State nonprofit from 1973. We had a wonderful event in New York City in April celebrating the practitioners and the money managers who use these tools. It was a great conference, a lot of learning, but that 50 years incorporates a huge dramatic shift, not only in the toolkit, the way people express technical ideas and look at markets today versus what we were doing in the late 1960s, but also the group has expanded greatly. It started with a very small team of equity sell-side research analysts from firms like E.F. Hutton and Smith Barney, and lots of large bulge bracket brokers that don't exist anymore. They've all been gobbled up. And when we look at the organization now, it is a global endeavor, credentialing body incorporating 10,000 candidates in the CMT program, thousands of members worldwide in over 137 countries. We work with universities far and wide. Unfortunately, that program didn't exist when I was going through my MBA program. It was a pretty strict diet of fundamental analysis, but the CMT Association is working hand in hand with academia to help expose the next generation to how these tools can benefit them in their work. So this slide, I could spend all day talking about the history of the organization. We actually wrote a book on the 50 years of both Wall Street history as well as the association's history and the interlinkages there. I'll just point out a couple things to you. The CMT program actually didn't get started until 1989. It was a member organization for the first 20 years or so. So the first class of charter holders were in 1989. And you fast forward to, it was actually 2004, FINRA was starting to introduce a new series of regulatory exams for research analysts. Our board of directors and folks like Ralph Acampora and others stood up in front of the SEC attorneys and just sort of explained to them what the CMT program was about, the rigor, the breadth of coverage, the body of knowledge, the formality of how that was constructed. And now FINRA recognizes two types of analysts on Wall Street, fundamental analysts who carry a CFA and technical analysts who carry a CMT. And so with that recognition from FINRA, it really just expanded the reach and the brand identity for CMT charter holders. And that led to projects that we have ongoing with IROC in Canada and SEBI in India, and the Singapore Monetary Authority, Bursa Malaysia, and on and on and on. So we do a lot of regulatory advocacy work with our members and the governments that oversee the trading in their countries. We did open an office in 2018 in India, in Mumbai. So for those of you who are still online and residing in India, my goodness, it is late, but thank you for spending all night with the MetaStock team. And we have expanded our operations since then. I did mention the 50th anniversary. We were actually invited by the New York Stock Exchange for a wonderful ceremony, rang the closing bell and recognized the contributions of this organization and its members over the years to trading in the United States, but also globally. So that culture of excellence, the kind of impact that the organization has had, I'm probably not doing any justice to the history of this organization in such a short little nutshell approach. But if you wanted to learn a little bit more and learn from some of the innovators in the space, CMT charter holders like John Bollinger, who invented Bollinger Bands, or Luis Yamato, one of the great analysts of our generation. You can listen to some of their inputs and some of their experiences, perhaps learn some of the things that they discovered along the way in a free podcast available wherever you listen to podcasts. And I do mean every app out there, but it's called Fill the Gap. And our goal is to help fill the gap of knowledge from the wider industry and for people who are new to technical analysis, help them understand the utility and the universality of these tools, but also learn from money managers who've been trading and managing money through multiple market cycles, in the hopes that perhaps we pay a little less tuition to Mr. Market and maybe learn from some of their mistakes along the way. So check that out. We're finishing up season 3, and the 36 guests that we have had cover wide range of job roles in the industry, and these men and women have a lot that they have contributed over the decades. So make sure to check that out. The other thing I wanted to invite you all to is our next event that's coming up in Dubai on February 29th. Yes, we're moving it outside of New York City. We recognize the global nature of our membership, and what a perfect centralized location for all of our members across Asia, across Europe, and across North and South America to join together. That will be at the Museum of the Future, an incredible venue from the Crown Prince in Dubai in the United Arab Emirates. So that'll be, we'll kick off on the 28th, full day conference on the 29th, and our gala dinner will be that evening. Meeting face-to-face is, yes, less and less common post-COVID, but we find that the opportunity to do that every once in a while is incredibly powerful and a very enriching experience. So if that's you, feel free to head over to our website, cmtassociation.org. A lot more details about that event, and we'll have that full agenda of speakers up there. All right. That's enough preamble, a little introduction of the organization. My name is Tyler Wood. I am a CMT charter holder, so I've been through this whole program that I'm going to talk to you about. And being a charter holder in the CMT is it's a really powerful experience. I will talk to you a little bit about the link between fundamentals and technicals. It's taken me quite a bit of time to learn that, but in all of the presentations that I give all across the industry and across academia, there's really a very simple agenda. And there's 3 things that I hope we can accomplish here in the next 45 minutes. First of all, we have to define what we, the CMT Association, mean by technical analysis. And it's important that all of us have a shared common understanding of what we define these tools to be, what is the body of knowledge, and how do we use that to our advantage. The second, I'm just going to touch on 3 really simple technical concepts. Not really diving into any one indicator, but hopefully something that's very broad and overarching that could help you in your trading, and perhaps lead you to explore our third item of note today, which is thinking about a credentialing program, an organized and structured way to study technical analysis to help improve your own decision-making and really develop your own process, as opposed to just trading the way someone else has taught you how to trade. Think instead about getting to the root cause of what those indicators are trying to tell you, and then how you're going to make a process, a rules-based, systematic approach to trading. All right, so that's our agenda. Let's dive into the first topic, which is defining technical analysis. And yes, it is very mathematical, but no, we do not use the abacus anymore. In the late 1960s, when this organization got started, technical analysis was done by hand. And I think for almost everybody in the industry, the definition is that it starts with a chart. Technical analysis is a way to gather tons of information, lots of data from the market, and to put it into a visual form that helps our human brain process that information, make sense of it very quickly. So big data and AI, we've been talking about this since really since the 50s. There's been a little bit of an AI winter for some time, and now it's all the rage. Well, the idea of crunching big data actually goes back to the rice pits of Osaka, Japan, to a gentleman named Munehisa Homma, who understood that he could find a trading edge by understanding what trading was happening during the day. The man invented a system of organizing that data and giving himself a visualization that we call candlestick charting. I'm sure many of you look at candlestick charts, may not even recognize that those are hundreds of years old, and we have a gentleman named Munehisa Homma to thank. But when we go to the textbook definitions, I'm going to start with Edwards and McGee. That was sort of the foundational book of note in the 1940s. These gentlemen were writing about technical analysis, about some of the classical pattern studies, the importance of support and resistance, and they were just looking at price action, price behavior, a way of understanding the emotions and the drive of investors in an open, liquid marketplace. And they said that technical analysis is the study of the action of the market itself. So we're using what the market is giving us to help make decisions about what we want to do in the marketplace. And that goes back to some very foundational work, but we also know that they expanded on this idea, and they understood that technical analysis was really about supply and demand relationships for individual securities, for an equity index, for currency pairs, for commodities of all stripes, for fixed income instruments, you name it, across all asset classes, any liquid security. Its price is driven by supply and demand. We understand that price is set where a buyer and a seller meet. Now we're going to talk a little more about the basics of supply and demand, and then we also want to give a little more modern definition. This comes from Perry Kaufman, who's a widely cited author in the CMT curriculum, and he says that it's about the systematic evaluation of price and volume and other materials that are coming out of the marketplace. Now, Perry says that it's for the purpose of price forecasting. And I'm going to take issue with that. I apologize, Perry. I mean no disrespect. And I think taken out of context, many people think technical analysis is about predicting the future. I'm here to tell you that it is not about predicting the future. Nobody can do that. And anyone who tells you they can is probably pulling your leg. What Perry is talking about is using statistics, using probabilities, to position yourself as a trader on the right side of where the market is most likely to go. But we're not trying to predict the future. We don't have an opinion about what the future might be. We're using present information to react responsibly. And as that information changes, so too can our positioning with respect to the securities that we're trading. That term systematic, right? A lot of people give a lot of attention to algos. A lot of young people these days start first by learning how to code in Python and start later follow up with understanding how markets work. And I think the underlying driver for all of those algos, for any sort of quantitative expression, is understanding how the markets work. And most of those quantitative models are taking a lot of technical inputs and probably some fundamental inputs into their multi-factor model. So we're going to talk a little bit about that systematic evaluation today as well. All right, those are some of the textbook definitions. Here's how we say it at the CMT Association. We believe that technical analysis provides the tools to successfully navigate the gap between intrinsic value and market price across all asset classes through a disciplined, systematic approach to market behavior and the law of supply and demand. Now, I got to work with some incredibly smart and very experienced money managers who are on our board of directors and elsewhere in the organization to come up with that positioning statement for technical analysis. And where we really started was with these blog postings from Professor Aswath Damodaran. If you're not familiar with Professor Damodaran, he is a incredibly prolific author, frequent speaker at CFA Institute events. He is a professor at the NYU Stern School of Business, and he is the guru of fundamental analysis. This gentleman lives and breathes discounted cash flow statements. He writes extensively about valuation models and modeling of new IPO entrants to the market. But in his blog writings, he had this nagging question about why the market is so often wrong. Why does the market misprice securities? And that the answer that he came up with was that intrinsic value was driven by a set of variables, accounting side, fundamental side variables. But that market price was driven by other factors that weren't accounted for in those models, things like market sentiment, supply and demand relationships, et cetera. So it was from his curiosity about why the market was mispriced that we came up with this definition. Now, Ralph Acampora, who co-founded the organization, asked me that anytime I was talking to a group of people about technical analysis, that I borrow this slide of his from his decades of teaching at the New York Institute of Finance. And in Ralph's day, the mega cap security of the day was IBM. We're going to use Apple as the example today. Now, thinking about Oswath Damodaran's ideas of value being different from price, and that technical analysis helps us navigate that gap, let's just think about how we analyze a security, right? We could pay attention to the company. And this was everything that was taught to me in my MBA program, right? We want to understand the valuation metrics for any security, and we might look at a number of different ratios, right? Price to earnings, price to book, price to sales, all of those valuation ratios and the models with a bunch of estimates that go into valuing a company. We also care about the quality of the company, right? So we want to know if the shares are expensive relative to this intrinsic value idea, but we want to look at the company, the quality of that company. So we look at the management team. Are they very efficient or inefficient at allocating capital throughout the team? What's on their balance sheet? Do they have a strong cash position? Do they have huge debt, and is servicing that debt going to be a headwind for the firm? We want to look at the growth factors, things like return on equity or margin expansion. We want to look at the quality of those cash flows. And of course, we want to understand their product mix, what's going to generate those future cash flows that we're going to put into our DCF statements. And there's a whole competitive landscape. And I'm not just talking about, is somebody else coming out with something better than the iPhone 15? Of course they are. But we're talking about the regulatory landscape. Maybe in certain industry groups, it's the environment and competing factors around climate crisis. You name it. There's a world of complexity in the top half of this graphic. Now, that fundamental information is critically important. And I am not, by any means, diminishing the value of understanding what's happening inside of companies. If you're an equity investor, by all means, understanding what that fundamental information is telling you, coming up with a way to analyze and value companies is very, very powerful. However, if we are not a gigantic private equity firm, we're not buying the whole company. We are buying shares of that company, right? The stock is also part of our analysis if we're going to have a complete view of what our investments are telling us. And so the rest of the picture comes from analyzing the stock. And that stock has a price at which it is trading, volume at which it trades at any given price. We're going to look at things from, the futures market, like open interest, commitment of traders. There's, back in the 60s, people looked at odd lots. There are data sets from the market itself that are incredibly powerful. Today's options industry is giving us the most valuable data sets and more information to process than ever before. We can look at supply and demand relationships, not just for Apple shares, but for the information technology sector or for growth companies versus value. We could look at supply and demand for US equities versus the rest of the world, or equities versus other asset classes like gold or Bitcoin or commodities, you name it. We have a lot more to analyze down here to get a complete view of our investments. And of course, that last bullet point is the psychology of the market participants themselves. And that is perhaps one of the most powerful things that I have learned in my time at the CMT Association from these incredibly brilliant men and women. This next slide, if there's anything that you take away from tonight's presentation, I hope you pay attention to this part. And I'm borrowing this from David Lundgren, who is my co-host on Fill the Gap, that podcast I was talking about. He's a veteran money manager, a dual charter holder, a CMT and a CFA. And he's also been a professor at Brandeis University. He is a wealth of information, a fountain of great things to understand about investing. Now, he came up with this equation. You don't have to write it down. It's for illustrative purposes. But to understand this unbreakable link between fundamentals and technicals, let's use this equation. And the equation says that price is equal to the fundamentals, the growth factors, and the valuation of the firm, right? Price or technical analysis is simply earnings per share, right? The growth factor alongside the value. You multiply those two, you should get a result in price. Now, every CMT charter holder on the planet will tell you that long-term price trends are always going to be driven by the fundamentals. We all believe in this in one form or another. Now, The other thing that this equation tells us is that the entire industry is in this together. So if you hear somebody saying, I don't believe in the technicals, they're nonsense, that's voodoo, I don't use it. Well, that's unfortunate because the price is dependent on the fundamentals, and the fundamentals are dependent on the price. We both need cooperation from each side of the equation in order to be profitable traders and investors. We need cooperation between the two over the long haul. All right. Now, the other thing to recognize is that price is driven by our growth factors and our valuation estimates, but it's all magnified, emphasized, amplified to the power of investor behavior. And that behavioral psychology is something we could talk all night long about. We could go through the work of Daniel Kahneman, our 2002 Nobel Prize winner in economics. He's an incredible behavioral psychologist. If you haven't read Thinking Fast and Slow, I recommend it. I reread it every year. And some of that groundbreaking work that he and Amos Tversky did in the 1970s around prospect theory has led the behavioral economists of the world to new heights. They're discovering new things every day. Now, we know that in a bear market, right, when everyone is very downtrodden, very despondent on the marketplace, and just think back to how you were feeling about trading middle of 2022, or the end of 2022, I should say. That behavioral element can impact, even if the fundamentals and the valuation are really, really strong. Companies are posting earnings growth, they've got strong balance sheets. It doesn't matter if the investment public doesn't want to own equities. If they're all in cash, then that supply and demand relationship for those shares of stock, it's not going to go up. It's amplified to this behavioral element. We also know that in a raging bull market, right, rampant enthusiasm, irrational exuberance can extend prices well beyond any kind of intrinsic value rationale for the share price of those equities. All right, let's keep going. What are the differences in each side of the equation? Well, on the right side, if we were to click on this F and open it up, right, if we were trying to understand company growth, there is an incredible amount of information there, right? Return on equity or margin expansion. We could look at a dozen different variables, each of which we'd have to clarify, and they're all forward-looking estimates, right? Now, what about on the V? If we open that up, there are a dozen different ways to value a company, and everyone's valuation model is going to look slightly different, and it's also estimated information. And then how about this B? I don't even know any sentiment analyst out there. And there are incredible folks out there who are doing deep work on, you know, the pipeline of social media feeds and frequency of positive or negative commentary and what that might mean about trading behavior and positioning for market participants. There is no clear-cut answer for any of these. They are incredibly complex, and they are often estimated. On the left side of the equation, we have price, which is just price. It's a fact. It's factual. The closing price of any period, whether we're talking about the end of the trading day or the week or the month, it's not an estimate. That's actually where trading stopped and where buyers and sellers agreed on a price. And it doesn't. It's not an estimate, and it doesn't ever get restated. It doesn't get revised. It doesn't change after the fact. And that elegant simplicity, what it tells us is that everything on the right side of the equation can be distilled down to a metric that is stable, and it's factual, and it's consistent. And what we know about investing is that the market itself is one of the greatest fundamental investors on the planet, is the greatest fundamental investor on the planet, because the market is distilling all of the information that we know about, right? All of those valuation and growth estimates. The market is distilling all of the behavior of every market participant in real time. It knows everything that we know about the market, everything that we will admit to not fully understanding. But it also knows things that we couldn't possibly know, right? Market price moving down precipitously for Enron long before anyone understood the kind of shenanigans that were happening with the auditors and accountants. How about Sam Bankman-Fried, the FTX blow up? A week before FTX blew up, the smartest folks in the room, the private equity investors, gave him a check for $5 billion. These are the folks who do due diligence to the T, and they didn't know, didn't understand, couldn't unearth what potentially could go wrong. Price can figure that out. The market can figure that out. So going back to Damodaran's blog post, wondering why the market is so often wrong, or rather approaching the market every day with your opinion that the market is wrong and that it will correct, it will revert towards a intrinsic value estimate that you've come up with, is a very difficult way to invest. It's not impossible, but it's very difficult to come in and hope that the market sees your view. Now, as technical analysts and as trend followers, we believe the market is always right. We don't try to predict the future, but rather react responsibly to what the market is telling us. Okay, so there's a lot of simplicity on the left side of the equation. And we know that we all agree on the importance of those fundamentals. We've just simply hired the market to be our fundamental analyst, okay? And every morning we check in with our fundamental analyst and see whether the value and the growth factors or the behavior have changed from the prior session. And I guess the last point to make is that trend following investing is actually universal. So if you're a deep value buyer and you want to get in on something that's been demolished by 90%, you're also hoping that there will be a trend in price moving in that direction. We simply wait for that trend to be articulated before we get involved. So it's just a timing decision. Now, I've talked a little bit about the behavioral elements and about how markets move. Let's keep cruising past this, and I'll let you all read Daniel Kahneman's book on your own time. Remember when we were talking about supply and demand relationships? If I take you back to your Econ 101 class, you'll remember that at a fixed rate of supply, an increase in demand is going to move us up this price equilibrium, right? Price will be higher with an increase in demand. Similarly, if we increase supply, right? We have a supply increase, price will go lower as we move down the price equilibrium. So when you think about support and resistance levels, or about buyers and sellers, buyers are generating demand and sellers are generating supply. They have an effect on price. And when we come back to that equation, when we think about the fundamental and the value side, we know that demand and supply relationship can put prices well above or well below any kind of intrinsic value. I'm not sure if anybody on this call traded through the meme stock craze of 2021, but AMC, right? A movie theater chain here in the US. We had a pandemic where everyone was sheltering in place, not going out to the movie theaters. But price rose precipitously in the anticipation of crowds going back to theaters. There were buyers when price had really plummeted. But that irrational exuberance, the short squeeze that happened to Melvin Capital, this pushed price well beyond any kind of intrinsic value. And we can see that behavior element can change price dramatically. We also know that over the long term, without cooperation from the right side of the equation, the fundamentals and the growth factors, price will correct. Price cannot sustain these levels of irrational exuberance. How about GameStop, right? I love these meme stocks. These are going to be textbook examples for 100 years from now. And then, of course, the entire cryptocurrency space, which frankly, I'm a believer in. I just don't know how anyone can come up with an intrinsic value, not necessarily for Bitcoin, but think about all those lower level protocols, the coins themselves. I understand distributed ledger technology has a tremendous value, and this is the way to get invested. But what is the intrinsic value of any of these individual coins, right? We're only trading supply and demand. We are trading price action when it comes to asset classes like the cryptocurrencies. Now, why is price so important? Mark Abraham is a celebrated trend-following hedge fund manager. He's been very successful, and he's written a lot of work on his process and approach. I love this quote. He says that ultimately it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down, and that consensus is revealed by analyzing price. There is a tremendous amount of information encapsulated in a very elegant, simplistic, and factual data point. All right, thank you for sticking with me, friends. We've made it through the first section. I'm going to dive into a couple of technical concepts, these tools that can help us with our decision making. You've already learned all day long from some real experts in the field. The three that I like to cover are relative strength, breadth, and divergence analysis. And conceptually, we're going to cruise through these just in the interest of time so that I can share with you a little more about the CMT program. So let's dive right in. Relative strength, I'm pulling this definition right from Martin Pring, but the core concept of looking at charts, right? We can identify trends, we can look at absolute price action, but what if we wanted to compare to securities? What if we're trying to decide which one to put into our portfolio? So for a lot of the asset allocators out there, they're looking at factor investing. Do they want to own growth? Do they want to own value? They might look at market cap, large cap, mid cap, small cap names. But let's just compare growth to value for a second. Still using the COVID pandemic as our textbook example. These are growth shares in this top chart, value shares in the bottom. And if we were just to eyeball the two charts, looking at their price action, we might come to the conclusion that generally they've moved exactly the same, right? They were rallying, they both came into the COVID collapse, they rallied out of the collapse, and maybe there's some divergence here on this right side where we're seeing value outperform growth a little bit. This chart goes through 2022. Well, what we can use is the concept of relative strength. We can look at a ratio of those two charts, S&P growth over S&P value, and when the line is rising, growth is outperforming value, and when the line is falling, value is outperforming growth. Powerful concept. A couple things to point out here. Growth began to outperform value significantly weeks ahead of the index collapse. So the market knows more than we could possibly know about the impact COVID might have, that stay-at-home economy, the K-shaped recovery. Growth started outperforming value into the downtrend and then continued out of that V-shaped recovery. Now, relative performance, here's another note to put in your notebook. It doesn't mean that the security isn't also trading down, right? Just because growth is outperforming value, on an absolute basis, they were both in downtrends. But a rising relative strength line means that this is going down less, right? Growth stocks were outperforming growth. Growth was outperforming value, meaning it was losing less on the way down and gaining more on the way up, right? Rising faster. And we can see at these points on this relative strength line that there was outperformance and underperformance. Interestingly, this underperformance of growth versus value happened as we saw rapid inclines in US Treasury rates. And we'll talk a little bit about that in a minute. But the context for investing, relative strength is about comparing to securities. And that trend of the relative strength line is all important. So let's use another example. Does everybody remember all the way back to February of 2023? Here we are coming to the end of the year, and we're seeing bank stocks outperform. We're seeing the financial sector outperform. You wouldn't think that was the case, right? Emotionally speaking, I think all of us by the end of March were pretty bearish on the financial services industry. And this chart up here is regional banks. It's an ETF proxy for all the regional banks, and this is the XLF, the broad financial services sector group. Now, again, eyeballing, regional banks underperforming, and then they both crashed, right? When we look at the relative strength line, it reveals a little different picture, which is that regional banks were outperforming the XLF, right? You wanted to own regional banks through the end of 2022, and it was here at the end of October 2022. Remember, the news headlines at the end of February for Silicon Valley Bank and Signature Bank, these collapses. And you remember how dramatic it was. It was a run on the banks at the same time that the tech sector was blowing up, right? We're coming into perhaps the worst case scenario of a great financial crisis plus the dot-com bubble bursting. Investors were terrified. But we saw regional banks outperforming the XLF, and then months before that collapse, months before the regional banks had their liquidity crisis, we saw them underperforming dramatically. Again, the market knows all. Somewhere, someone was doing the work to understand the debt holdings on these regional banks and what kind of magnitude move it would take in the US Treasury markets to change the interest rate that on the debt servicing that they had to do, and the fact that they were vulnerable. They were higher risk securities than the rest of the financial sector. So you start to see this underperformance of regional banks against the XLF well ahead of the collapse. What do we want to own in XLF going into something like that? Insurance companies, broker-dealers, technology companies, those were all outperforming the banking sector and regional banks specifically. All right, so another few slides that Dave has used in classrooms at Brandeis and elsewhere. When we talk about how inextricably linked fundamentals and technicals are, this concept of relative strength is really important. I'm just gonna go through one for illustrative purposes, right? We could rank all the industry groups of the stock market, and as we're thinking about what we want to own, right? The market's going to tell us what it cares about from a technical perspective, from a growth metrics, and then from a quality and a value perspective. So in the first column here, we've got the momentum ranking, right? Technically, these are the areas of the market that are outperforming. This is what we want to own. Here's what we don't want to own: underweight these areas or short these areas of the market. But look how they line up with some of the fundamental factors. Well, the midpoint right in here, we want to overweight these, we want to underweight these. And what the market is telling us is that expensive companies, right, their valuation factor, these are the shares that are expensive relative to their share price. Expensive but profitable is working. Investors are allocating to securities that are both expensive but still profitable. And that's context, right? The fundamental factors may change. These leadership groups on a technical perspective might change through time. Value may become a really important factor later on, and it might not be profitability. It might not be, investors might not be looking for growthy companies in certain segments of the business cycle. Let's look at this on a sector basis, right? Let's say we're considering the semiconductors, right? And you're an analyst in that sector group. You're going through the COVID crash, but you're seeing semiconductors relative to the S&P 500, the benchmark. They're all outperforming, every single one. And I've taken the names off because it doesn't matter, right? Every single one of these chips manufacturers, and not Frito-Lay's, semiconductor manufacturers are outperforming the S&P. So if you're a sector analyst, you want to give your portfolio manager some guidance. What do you want to overweight and what do you want to underweight? A generalist portfolio manager might say, well, they're all good. Yeah, everything in that ranking list is just fine. Maybe we leave out the last one. But a sector analyst is going to rank these not only on their relative strength to the benchmark, to the S&P 500, but relative to the semiconductors industry group, right? We want to own the stuff that's outperforming the industry group, that's outperforming the sector, that's outperforming the benchmark. So we could look at a couple of charts. And this is where that data visualization becomes so important, right? Context is key. Yes, both of these companies are in an uptrend, but look at the different context. This was in a defined downtrend, while this was in a defined uptrend ahead of the pandemic collapse. And yes, they're both rising. This chip company number 15 is just in an industry group that's outperforming. And in today's landscape of ETF investing, there are a lot of folks that are just equally invested in every share in that sector group or in that industry group. If we look at this relative to the S&P, it's the blue line. Relative to the semiconductors industry group, it's the red line. It's outperforming both. This is a strong buy. This company number 15, relative to the S&P, it's holding, it's flat, but relative to the semiconductors, it's an underperformer. this is an opportunity for maybe a short or at least underweighting. And there are more in this series that I could go through and give you additional examples. But let's move on to the concept of breadth. I like to talk about the 1990s Chicago Bulls, right? What a powerful team. Everybody thinks about Michael Jordan, right? Star player. And we certainly all wore his jersey and wore his shoes. But it's not a stock market. It's not a single player. It's not just the equity index. It is a market of stocks. And when we look at market breadth, what we're talking about is bench strength. And those 90s Chicago Bulls, yes, they had Jordan, but they also had Scottie Pippen and Dennis Rodman, and they had players in every position who knew how to do their job and had, the greatest rebounds in the league. They had the greatest, they had the greatest defensive players, the greatest offensive players. And of course, they put the ball in Michael Jordan's hands whenever they could. And he was an incredible scorer for the Bulls. When we are looking at markets, it's important to not just look at the equity index, but to think about what's happening under the hood. And tools like the advanced decline line, it's a very simple calculation of up movers and down movers. You can look at on balance volume. There are scores of indicators out there to cover this concept of market breadth. But the bench strength is what I'm talking about. Here again, another example of the pandemic crash. We're looking at the Russell 2000, the IWM ETF. These are weekly candles. And the advanced decline line comes up here and peaks out well ahead of the collapse, right? We see a rapid decline in market breadth ahead of the index rolling over. What does that tell us? It tells us that the average stock within the Russell 2000 had started to underperform well ahead of the broad knowledge of this COVID collapse. So when we see that, when a market index makes a new high on weaker and weaker breadth, when breadth is deteriorating, it's a leading indication of what may be happening under the hood and how that could potentially affect the whole index. Similarly, when we see these areas of stagnation, right? The index is rallying off the lows, but we're not really seeing breadth improvement. Well, holding the index, that's rewarding to portfolio managers and their clients. They've owned the index through a rally. But now, what about this area where the Russell 2000 at the index level is really doing nothing? But under the hood, the expanding advanced decline line tells us that there were lots of new trends emerging, lots of rotation between the different sector groups, lots of new leadership emerging, and that rotation is the lifeblood of bull markets and of returns in your portfolio. So if somebody tells me that, hey, the S&P 500 is going to be at 4,600 or range bound between 4,700 and 4,300 for the next 10 years, I would say, oh, that's going to be really, really unfortunate for the passive investors, for people who are just buy and hold indexers. However, there could be incredible opportunities, stealth bull markets, exploding rallies in lots of different sectors, industry groups, individual names, and there is an opportunity to capture a trend no matter what the index level is performing. Right now, it has been the story of the Magnificent Seven. Going through this year, this rally has been diminished by very bearish minds on the subject, and they have pointed to market breadth as their main cause for concern. Right now, we're seeing some of that breadth expansion. We're seeing the Russell starting to catch up, and I'm certainly seeing that as a very bullish sign. All right, last idea to think about tonight, divergence. And this could be used with any indicator, whether we're talking about breadth studies, momentum studies, volume, you name it. You can think about confirmation and divergence as simply using your suite of technical indicators to help confirm or deny what you're seeing in price action, right? As Edwards and McGee told us, technical analysis is really focused on supply and demand. The price action itself is our paramount indicator, but we can use these other derivatives to give us leading indications of what might be coming next. Now, here's just the classic illustration of bearish and bullish divergence, right? So our security is making a series of higher highs, while in this case, a momentum oscillator is making a series of lower highs. The enthusiasm of buyers in the marketplace as this stock creeps up to ever higher and higher prices, well, that enthusiasm is waning. It's still positive. There's still positive momentum, but it has diverged from the price trend, saying that at some point, this exhaustion will run out and price will struggle to go higher. That's how we think about bearish divergence in an uptrend, or bullish divergence, right? We're in a downtrend, we make a new lower low, and our momentum oscillator makes a higher low. Yes, still negative momentum right here where my cursor is, but it's diverged from the price action, meaning that price may struggle to go lower after that divergence. So a key concept. Now let's think about this in the context of major long-term macro charts. This is a chart of the TNX, the 10-year US Treasury yield. Yours truly was born somewhere right around here. I basically top-ticked the market. Gave way for Reagan era and for my parents to refinance their mortgage every 5 years as it went from 17% down to 0. Now, the divergence on this chart is a decade long, right? The trend of US Treasury rates made lower and lower lows, while the MACD was making higher lows subsequently at each peak. So we've got a multi-year divergence. And of course, what we have seen recently is this explosive move, first reverting to the mean, right? Coming back to that 200 period moving average. These are quarterly bars, by the way. This is going back 40 years. But then beyond the mean reversion to a new secular trend in interest rates. And that's something for everybody to keep in mind when we're thinking about, the narrative or the approach that we take to markets. What are we thinking about scenario planning for 2024 and beyond? For 40 years, nobody has traded through a substantially rising interest rate, right? There were moments, there were multiple years of rates rising, but rising in reversion to that mean, to that long-term downward sloping trend line. This is new, folks, and you got to go back to the 1970s to find corollaries about what has worked. You can look at the 1950s, which was a rising rate environment, but also a bull market for stocks. So I'm not saying that it's all bad news, but it's a very different secular regime that we are in. Enough about divergence, and I'm going to just blast past these two. Talking about money management principles is something that you are going to learn in depth in the CMT program. Here in our last 5 minutes together, I just want to touch on a few of the basics about why I decided to go through the CMT program, why I have seen tens of thousands of others start to apply their free time and their talents and their skills to studying the tools of technical analysis. All right. First things first, it is a living body of knowledge. Technical analysis is a very dynamic toolkit. It has changed dramatically since the organization started in the 70s and continues to evolve and change as new technologies come into the markets, new asset classes emerge, new data sets come out of the markets. And hopefully for anybody who's considering this program, first you're thinking about, well, what is it going to do for me in my career? And that's where we start in creating the CMT curriculum. We go out to all of the hiring managers in the industry. We talk to the head PMs and the CIOs. We talk to the heads of the trading desk, the directors of research, and we ask them, what are the knowledge, skills, and abilities you are looking for in your next hire? If you're going to bring somebody onto the team, what do they need to know how to do? And it's through that survey work that we do every few years, and we survey thousands of individuals, including all of our charter holders, to find out what's most important. And they came back with pretty clearly defined few categories. Number one, you got to understand risk management. And that has been at the top of the list since the great financial crisis. We also know that it's very important for any new hire to understand quantitative systems development. They need to understand how to use evidence-based investing strategies, and they need to be able to quantify what it is they're seeing on the chart. What's the validity? What's the probability of returns 30, 60, and 90 days after a signal is generated? How do you evaluate a trading strategy systematically? What's the Sharpe ratio? Monte Carlo simulations, forward and back testing, you name it, it's in the CMT program. And I apologize for those of you who hate statistics. You will actually learn to love them as you go through all three levels. It's all done in the context of a portfolio manager. So instead of thinking about technical analysis just for single security trading, we go beyond that to think about the correlations between securities in the portfolio, correlated risk or correlated returns, how you can get differentiated alpha out of different kinds of trading strategies, multiple timeframes, you name it. And then there's a lot of application of concepts in behavioral finance. And that is not only how the market works at a macro level, what these behavioral forces are that drive markets, but also at an individual level. Where can we fall victim to overconfidence bias, to looking for confirmation from our market data sets, and where we can combat our own behavioral pitfalls. So I keep talking about this CMT program, Chartered Market Technicians. Here's what it is. It is a global credential recognized around the world by employers and regulators that establishes a level of excellence and professionalism in technical analysis that supersedes all others. Now, it's 3 exams as well as a professional membership in the organization. So everyone abides by the same code of ethics and standards of professional conduct. We actually share that ethics alignment with CFA Institute, Kaya, and other well-respected designations in the financial services industry. Those 3 exams have to be taken in sequence. So you can't move on to level 2 until you've passed level 1, level 3 after level 2, et cetera. And we only allow candidates to take 1 exam per cycle, meaning you're going to need a few months to prepare this material to sit for the exam. And I know some of you may have been doing this for years, and I'm sure you will find the information very familiar, very accessible. But I think, you know, for our candidates, we've had a very diverse set, some 30-year veteran portfolio managers that come into the program, and they're shocked by how much new information, concepts they had not heard of or used before, the fact that they had a way of using something that actually wasn't correct, right? They were misinterpreting some of the tools on their charts. So we do encourage everyone to take those exams one at a time, to dedicate the time that you need to your study. The exam cycles are offered twice a year, once in June and once in December. For any of the CMT candidates who are sitting their exams right now this week in December, wishing you every success. And if you're tuning into this webinar, hopefully you're not going to be up all night studying. But the exams are very academically rigorous. Pass rates on the level 2 exam have been around 50%. Pass rates on level 1 are right around 65, and the pass rates on the level 3 exam are in the low 70s. So the next chance to sit for the exams is going to be in June 2024. For those of you who are thinking about it, you've got plenty of time to study. Registration is actually open right now at cmtassociation.org. We have a long exam window, a couple of weeks in June and a couple of weeks in December. The level 3 exam is actually administered all over the world on the same day, so that we can ensure high integrity on the exams. We've talked a lot about technical tools today, but there are lots of knowledge domains covered over all 3 levels. And you can check out the learning objective statements right on our website and through the CMT program guide that I'm happy to share with all of you. The curriculum itself, it's published by UWorld Finance. They actually just acquired John Wiley & Sons. If you've been watching this presentation for a while, it's a new hyperlink to finance.uworld.com. That's where you will find the official CMT curriculum for 2024. That will be available starting December 14th. So in 3 days' time, you can set your clocks. But the 2023 and prior editions are also widely available online. Just wanted to encourage everybody who's thinking about getting started in 2024, you can pick those up right from UWorld. Now, it's a lot of study. It's a difficult exam. Why would anybody apply all of their free time, their nights and weekends to sitting for this rigorous series of exams? For me, and for a lot of the survey work that we do and a lot of the member conversations I have, the first and most valuable thing is that it is a structured approach to technical analysis. There's a ton of content out there online. You can learn from some real experts, particularly on these MetaStock summits. However, if you are starting from the basics and starting with a very professional and responsible approach, you're going to want to learn a broad range of coverage. And it's not going to be from any one expert in any area. It's going to be across all of the tools and concepts of technical analysis. We also know that people really appreciate the program because it is such a complementary toolkit. And the way that we present technical analysis is for investors of all asset classes and all stripes, even for fundamental investors who want to get some confirmation from price action in their decision making. We know that on the job market, it presents a ton of differentiated value. There is a high concentration of financial planners or of financial analysts with the fundamental background. A lot of folks did an MBA just like I did. But the CMT is still a very unique and very, I guess, elite designation for a few select money managers. And so differentiation on the job market can be really powerful. If they're looking at 10 candidates who are all highly qualified, and you're the only one with the CMT after your name, that presents a different way of thinking that could really benefit the firm. Now, we also do surveys of what happens after you get your CMT. And the survey results from charter holders 1 year after completing and earning their designation include lots of things like promotions and higher salaries and new positions, and they get contacted by recruiters and headhunters and all of the rest of it. This is the data point right here that actually I wanted to point out, and that is a little over 60% of the survey respondents a year after earning their CMT reported having higher responsibility, more responsibility in their fund. And what that translates to is expanding AUM. So whether their firm was allocating more capital to their trading strategy or clients were bringing more money to work inside their investment vehicle, what it tells us is that firms and clients alike can attest to the responsible process that CMT charter holders use to manage money, to capture alpha, and to minimize risk in the marketplace. And that's just a really powerful testament to us that the industry has recognized the value of CMT for their employees and their money managers. Now, for those of you who are CFA charter holders, we did a very long, lengthy exercise of curriculum mapping, and we found that CFA does cover a lot of the same topics throughout the 3 levels of CFA that allows for an exemption on CMT level 1. So if you are a CMT charter holder, you can actually begin your test taking on the CMT level 2 exam. You're still responsible for all the material in level 1, and yes, there are some things that are scaffolded through the 3 levels. So I would encourage you to pick up the level 1 textbook as well. For more information on how investors and analysts think about melding the two and combining fundamental and technical analysis, we've got a ton of testimonial videos and some really interesting interviews on our website under the CMT program, under that link for the CFA waiver. You can hear from money managers all across the industry on why they chose to do both a CMT and a CFA. So that is for our CFA charter holders. For those of you who are students in our academic partner program universities, I appreciate you tuning into this MetaStock webinar as well. I use this little image of Katie Stockton. She actually finished the CMT program while in undergrad at University of Richmond. And it was the University of Richmond that actually was the first school to ever teach a fully accredited technical analysis program. So we have expanded that outreach to over 70 universities around the globe. We do offer scholarships to the students of those schools. If you're currently a full-time undergrad or graduate student, you can reach out to me, Tyler, at cmtassociation.org, or hit us up with admin at cmtassociation.org. Just use that word scholarship in your subject line, and we'll make sure to send you all the information about that academic partner program. So that really brings me to the end of what I wanted to talk about today. I encourage all of you, if you're thinking about, maybe you don't want to hit the gym and go on a diet in January, maybe part of your New Year's resolution is to think about investing lots of your time in studying this material in a structured way to improve your investment decision-making and to expand your career opportunities. So that's the process. We encourage you to enroll in the CMT program. You'll sit for those exams in sequence, and I'll be right there with you to celebrate your success on the other side as you become a CMT charter holder. So by all means, feel free to contact me if you've got any questions. Email's fine. You can reach me on, what is it now, X? or connect with me on LinkedIn. Appreciate you guys sticking with me. I know it's 6 p.m. Eastern, and Jeff is now on hour 10 of online education. But I really appreciate the chance to share this with you, and looking forward to lots more events in the years ahead.
Awesome having you, Tyler.
Yeah, thank you, Jeff. It's good to.
Thank you for coming. Actually, thanks a lot for coming.
Hey, Jeff.
Enjoy your holidays. What's up, Greg?
I just wanted to point out that Tyler had shared a link to the UWorld Finance for a free trial of course reviews or course materials, and I could not get it to work. If people simply type, and Tyler, you might want to go back and look at your PowerPoint and correct this. But if you simply type in, now I've lost it. World.
It's in chat.
The HTTPS, it's in Google Chat as well. The HTTPS and the www in your link were inversed. So they don't, so that's all it was. Anyway, just wanted to let you know. And it's available.
Great technicians make typos, right?
Well, I never do. I don't know about you guys, but thank you, sir.
No typos in mine. I correct mine on the fly. Oh, wait, hold on. Let me fix this for you. All right.
So glad you got that. Thank you, Jeff. Thank you.
All right. Thank you very much, Tyler. Have a good holiday, and I will see you again soon.
Sounds great. Thanks, everybody. Have a good night.
All right. Cool. Let me do this. We're going to wrap up real quick. I do want to say thank you to CMT and to Tyler for participating, sponsoring, all that kind of stuff. Also want to say thank you to all the speakers today. I want to thank you for coming. I hope you enjoyed it. If you're interested in finding out about the CMT, go to www.cmtassociation.org. Great organization. I also want to say thank you to Stocks and Commodities for their unwavering support of the Trader Summits over the years. Really appreciate all the work that they do. If you haven't registered and you're watching on YouTube, it's your chance. You have to do it today, because tomorrow I start sending the prizes out. So go to metastock.com/traders-summit. Sign up for your bonus issue and any of the other prizes that you want, and we'll make sure you get a copy of it. And then finally us, MetaStock. Talked a lot about scanning, testing ideas, forecasting probable price movements. MetaStock has been winner of the Stocks and Commodities magazine for 30 years in a row. You can do an extended trial where you buy a month and get your second and third month for free. I'd also recommend you take a look at our Summit Action Pack, which includes a lot of really cool items from some of our most popular speakers. You'll get Vince Vora's Victory, GoNoGo charts complete for 3 months, Oscar Carboni's trend lines and toolkit, Jake Bernstein's setup and timing triggers, 3 months of Big Trend Toolkit 3.0, 3 months of Learn MetaStock, Unleash the Power of MetaStock, a workbook in the video. You can do that. You can also do the extended trial on that same page, metastock.com/summit deal. You can give us a call if you want to get some more information. Maybe you want us to send you some videos so you can find out why we've been rated so highly for so long. Give us a call. You can reach us at 800-882-3040 if you're in the US or in Canada, or you can chat online with us at metastock.com/sales-chat. I hope you are doing well. Thank you for coming. I hope you learned something. I hope it was good for you. I hope you enjoyed the summit. We'll be doing our next one in January. So we'll see you there. In the meantime, take care. Have a good holiday season, and stay safe. Stay well. See you.
Hi, Kelly Clement here from MetaStock. Before you go, I have 2 quick things for you. 1, thanks for joining us today. We love having you here at our webinars and viewing our videos. So what I'd like to invite you to do before you go is like and subscribe. Like the video, subscribe to the channel. It helps us a great deal, and it helps us bring you more awesome content like today's video. The second thing is we have a great ebook on trading that you can get for free. If you go to metastock.com/YouTubebook, you can get a free copy of The Secrets of Successful Traders. It's a great book with lots of content from traders just like yourself who can teach you some of the secrets that they have learned. Thanks for taking a second with me and learning about those 2 things. Thanks for joining us, and keep on trading.